Thank you, Tanya, and good morning, everybody. My intention this morning is to provide you with an overview of the South African Code for the reporting of mineral asset valuations. So this code sets out a required minimum standard for such reporting. But what do we mean by a mineral asset? A mineral asset can be considered to be any right to explore or mine an entity holding such property or the securities of such an entity. SAM and the GSSA established the SAMCODES Standards Committee some time ago to manage the ongoing development and relevance of our reporting codes. The SSC meets quarterly to present, to review quarterly and annual reports from our respective codes, which in turn, these committees meet as and when required. The GSSA and SAM, they rotate the chair from time to, over every 2 years. This is a brief outline. I'm just going to take you through some history, talk a bit about the basis of the code, principles of the code, the process of valuation. Then we'll talk about risk. It's quite a lot to get through, so I'm going to move quite quickly. The competent valuator, I'll spend quite a bit of time on that. And then the commission entity and valuation reports, table 1. So let's start with a brief history. The process of establishing SAMVAL began at a SAM convened colloquium in March 2002, some 20 years ago now. Comment and mandates were sought on numerous papers and articles that were published. Then further work resulted in the issuing of an initial industry exposure draft in 2006. And after some revisions, the SAMVAL Code was published in April 2008. It was then incorporated in Section 12 of the JSE listing requirements after more amendments in July 2009. A subsequent review of the code was started at an open colloquium in September 2011. And this was necessary to incorporate more detail, align with international standards and international accounting standards. It increased the scope to cover all valuation purposes. The concept of reasonableness was included as a principle. And it was important to align the definitions that we had in the code with those of the SAMREC and other codes. We included market value as the basis of value, increased the disclosure requirements, and also included exploration projects and inferred mineral resources. So there were a number of things that needed to be brought in. That was done, and the update also included sections on independence, valuation reports, reliance on technical reports, etc., and risk. So it was quite comprehensive. Now, numerous stakeholders were involved in developing the codes. SAMVAL maintains contact with the Australian Institute of Mining and Metallurgy, the Canadian Institute of Mining, Metallurgy and Petroleum, the International Accounting Standards Board, and the International Valuation Standards Committee, and numerous others. We also have 2 representatives on the SAMVAL Committee, which looks at international alignment of the various codes. That's ongoing. So what underpins the SAMVAL Code? A number of things. It is applicable to the preparation and reporting of valuations. It is for all types of solid mineral commodities and styles of mineralization. It excludes the valuation of oil and gas assets. These are dealt with in SAMOC. It requires that the valuation be performed by a competent mineral asset valuator. It calls for all relevant and material information to be disclosed. Now that's table 1, which I'll show to you later. It provides consistency, minimum standards and guidance to limit unscrupulous valuations. It is based on best practice and generally accepted valuation standards. The scope is limited principally to the valuation of mineral asset, including evaluation of mineral resources and mineral reserves at any point on the value curve and real and personal property associated with the asset being valued. It applies to public reports prepared for informing investors or potential investors and advisors. Now, I've touched on its relationship with SAMREC and other codes already. So SAMVAL has been aligned as far as possible with other mineral asset valuation codes. With respect to conventions, the word shall should be read as mandatory, while should implies a preference. So you'll see that if you read the code, and that's what I'm getting to at conventions. In terms of limitations on the use of the valuation is defined by the commission entity. The purpose of the valuation must be clearly stated. The valuation is tendered for a specific purpose at a specific time and may not be suitable for another purpose or a use at a later date. So the valuation is only valid at an effective date which you must present. Valuation of companies that include other assets like real property, personal property, or business combinations where other companies are required are considered out of scope. So the purpose of valuations could inter alia include raising debt or equity finance, facilitating negotiations between parties, assessment of government charges and taxes, estate settlements, internal corporate reports, and numerous others. So SAMVAL is principle-based. The fundamental principles cover materiality, transparency, competency, and reasonable. These are 4 important principles to consider. And they talk to the integrity of the competent evaluator. There are 2 other principles, impartiality and responsibility, where the author of a public report should be satisfied that his or her work has not been unduly influenced, and that there's disclosure of all material aspects for an informed reader to make a balanced judgment. CVs should use professional judgment, and they should be comfortable to justify their evaluations to their peers. So let's talk about material. When thinking about materiality, think relevant information for a reasoned decision. For example, one should not forget to consider timing, risks, closure, or other legal liabilities. In terms of transparency, the reader of a public report must be provided with sufficient information, the presentation of which is clear and unambiguous, to understand the report and not be misled. The process and methodology aligned to the purpose for the evaluation should be auditable. The onus lies with the CV to demonstrate competence. For example, do we understand the makeup of the entity that we are putting a value to? Competence requires that the public report be based on work that is the responsibility of suitably qualified and experienced persons who are subject to enforceable professional codes of ethics like those associated with SAM, the GSSA, SACNAS, the Engineering Council of South Africa, Plato, and Psycho, for instance. The reasonableness test asks if the valuation is out of step with industry standards or norms. Are the assumptions and the model relied upon reasonable within the context and purpose of the valuation? Can other appropriately qualified and experienced CVs with access to the same information as at the same effective date also arrive at a broadly comparable valuation range using the same basis of value and the same scope of work? Valuation, I'm talking about valuation process now. The valuation is the estimation of the value of a mineral asset in money or monetary equivalent. The basis of valuation is the monetary value of the mineral asset being valued. The CV should consider the intrinsic value, which is based on the unique technical characteristics of the asset being valued. So when generating some other type of value, like market value, a clear definition should be provided by the CV and highlighted in the valuation report. Appropriate and justifiable market factors, need to be applied when converting intrinsic value to a market value. This table provides some guidance on how to approach valuation. There are 3 generally accepted mineral asset valuation approaches or methods. And these are the income approach, the market approach, and the cost approach. So the income approach relies on the value in use principle and requires determination of the present value of future cash flows over the useful life of a mineral asset. A simple DCF without scenarios is good for valuation in situations of low uncertainty. So looking at different scenarios of performing a Monte Carlo analysis can help in capturing the impact of and importance of high levels of uncertainty. But you must be wary as you do this. Remember the principle of a fellow competent valuator being able to reproduce your results. So the whole process of doing a valuation with a high level of uncertainty needs to be auditable. Decision trees to help the potential of management flexibility, while a real asset valuations approach can be used to capture that value. However, again, it must be auditable. The market approach relies on the willing buyer, willing seller principle and requires that the monetary value obtained from the sale of the mineral asset is determined as if in an arm's length transaction. One would usually have to normalize transaction values by deriving a rand per unit resource variable or rand per unit area to get a yardstick, and then to apply to the property being valued. The rand per unit resource variable generally gives fairly consistent results when enough data is available. Comparable transactions are useful for early stage mineral resource valuations, but the various methods can be highly subjective in their application, and solid experience in the commodity is important. The CV may need to filter transactions that do not apply and must understand the reasons for outliers. It is often also difficult to find enough recent transactions, and market conditions can change relatively quickly. The use of a gross in situ value simply determined from the product of the estimate of mineral content and commodity prices is considered unacceptable and inappropriate. Metal content multiplied by metal price is not an acceptable method of valuation. The cost approach, this relies on historic or future amounts spent on the mineral asset, which is a valuation approach based on the economic principle that a buyer will pay no more for an asset than the cost to obtain an asset of equal utility, whether by purchase or by construction. Now, I'm going to make these slides available to Tanya, so you can read the rest yourself there. So the other important aspects when looking at the process of valuation is the use of mineral, all exploration, mineral assets, mineral reserves and mineral resources. All exploration results, mineral resources and mineral reserves on a mineral property should be considered in the valuation of a mineral asset. The approach later will depend on the confidence in the mineral resources and mineral reserves. Income approach, generally acceptable to use proved and probable reserves, measured and indicated mineral reserves in the following circumstances. Use mineral reserves. Resources and mineral reserves are present and in general are scheduled in the mine plan ahead of the mineral resource, provided that the mineral resource as depicted are likely to be economically viable. These mineral resources and mineral reserves should have been estimated and confirmed by a competent person. They shall be relevant to the effective date of the valuation. It's no good using mineral resources that are 10 years old. They need to be fairly relevant and recent. Mineral reserves should be based on a life of mine plan for an operating mine, or at least a pre-feasibility study for a mine project. Now, this is talking about the income approach again. The technical and related parameters used should be estimated and confirmed again by competent persons or experts, technical experts. They should include a statement of the level of confidence that they apply to that plan and those estimates. A higher level of risk should be recognized if the technical parameters are not at the equivalent level of accuracy and confidence as a pre-feasibility study. Now, while not including mineral reserve estimation, markets attach a value to inferred resources during the exploration phase. Inferred mineral resources may also be mined in an operating mine and need to be taken into account in the valuation. Where a valuation is conducted on inferred resources, exploration properties, or exploration targets, the CV should qualify the valuation with the following: a clear statement of the level of confidence and the risks associated with the valuation, the reason for the application of the approach and method, the reason why the valuation may or may not be based on a SAMREC compliant report, the application of more than one approach and associated methods, and all the modifying factors applied. Where mineral asset valuation is reliant on exploration results or resources and reserves, these should be compliant with SAMREC and other CRISCO affiliated reporting codes and defined by the jurisdiction or commissioning entity. A scoping study or preliminary economic assessment is defined as a study other than a PFS or a feasibility study that includes an analysis of the potential viability of mineral resources and includes appropriate assessments of realistically assumed modifying factors and operational factors that demonstrate that progress to a PFS so that a PFS can reasonably be justified. The scoping study cannot be used to estimate mineral reserves. Only inferred, indicated, or measured resources can be used in the scoping study and not as for exploration results. You cannot use exploration results targets or just general mineralization. When it comes to highest and best use, the IVSC considers the concept of highest and best use to be a fundamental and integral part of market value estimates. Land is immobile and permanent, with each real asset, estate, parcel possessing a unique location. Land will normally outlast any uses and improvements, and each will contribute to the value. The unique characteristics of land determine its optimal utility. The market value of land based on highest and best use reflects the utility and permanence of land in the context of a market with improvements constituting the difference between land value alone and the total market value as improved. Now that's straight out of the IVSC 2007. SAMVAL considers that when undertaking a mineral asset valuation, that extraction is taking place or will take place. There may be circumstances where other uses may be possible, like defunct mines or agricultural ground, and numerous other things. Consideration should also be given to a change in exploration development or operating strategy or potential for leasing to maximize economic potential. Risk. Mineral asset values are inherently risky in terms of our confidence in the inputs or the assumptions and estimates and forecasts that we make. And the CV needs to take account of this in valuation. But what is risk or uncertainty? Risk is a state of uncertainty where some possible outcomes have an undesired effect or could cause significant loss. In a valuation context, risk refers to the probability of a different financial outcome. Uncertainty is a measure of our inability to assign a single value to a possible event. It is defined as the variability of possible outcomes, gains or losses, around their mean. So the quantification of uncertainty is the difference between the true value of a natural outcome and the estimates of its value, and then bias occurs when values are systematically over or underestimated. I'm not going to read on it. I think this is an important thing in valuations. At the end of the day, when you've done a valuation, you'll be able to stand back and weigh up the materiality of what you've done, and having the ability to comprehend risk in the context of mineral assets is very important. So if you're going to spend time on valuations, you need to spend time on this or getting a feel for this. So risk factors to consider can include economic factors, legal factors, financial factors, governance factors, and a host of other things. There are risk mitigation strategies out there, like the use of contingencies. Some companies use hedging, and you could look at option pricing. Qualitative risk assessments, you can use a risk matrix, which plots probable against impact. I'm sure you've all done that. single variability sensitive analysis. This is used to determine how much change in a variable would be necessary to reverse a decision based on the rate of change in outcome relative to the rate of change in the variable. It does not consider downstream effects. Each parameter is independent of the others. Example, a change in capital does not have a change on any other variable. Then there's range sensitivity analysis. Here you use the best case and worst case based on an expected case. Variation analysis over the full range of possible results, utilizing the best engineering and management judgments of people involved. A range of outcomes is bracketed, and then the weakness of this approach remains the inability to combine information from a number of sources into a reliable profit indicator. Then there's probabilistic sensitivity analysis. Here you can use a range of values to describe variables that cannot adequately be quantified by a single value estimates. You need to consider the codependencies of the variables. Then the probability of survival. This refers to the probability that you will not go bankrupt with a given amount of capital to invest with estimated probability of success. It's a financial risk. So let's look at the competent valuator, his behaviors, his responsibilities, and general ethics. A competent valuator is a person who possesses the necessary qualifications, ability, and sufficient relevant experience to value mineral assets. The occupational tasks of a competent valuator could inter alia include the valuation, obviously, but the valuation of mineral asset interests for litigation, disputes, or expert witness statements. Or it can include taking part for that part of a public report. So you can participate in doing common person's report. I just want to say that if we look at SAMREC, a competent person, the CP, usually talk about a minimum of 5 years experience relevant to the style of mineralization or type of deposit that he is considering, or her. While a competent valuator, we talk about sufficient relevant experience. What's important here is the CV should know what they don't know and employ or make use of the relevant subject matter experts. So a team approach is allowed, but the leader of that team needs to sign off, and then if you're doing evaluations, generally the competent evaluator. I want to talk about the competencies of and responsibilities of a CV. So let's talk about competencies first. You should be competent to apply the principles, standards, and requirements of the mineral asset valuation. He or she should be able to identify the mineral assets being valued in terms of the valuation scope and purpose. Should be able to determine the market value of the mineral asset. Should be able to interpret, apply, and incorporate the IFRS hierarchy of fair value inputs in a mineral asset valuation. Should be able to identify the value to be determined from the underlying mineral assets and the associated benefits and costs, and that there's a price determinant by argument, debate, and negotiation. This is the difference between value and price. He should or she should select and apply appropriate valuation approaches and methodologies and justify that the approach is reasonable. Should also be able to justify the selection of such approach to his or her peers and understand the implication and conclusions. Another competency is that the competent valuator should understand, appraise, and analyze modifying factors. And where uncertain, get help. Competent valuator should be able to engage technical experts and should be able to practice across international boundaries and be familiar with the local jurisdiction when doing so. I'm going to move on to responsibilities now. The CV must assess the technical data, information, and interpretations, technical conclusions, any forecasts and parameters, and all the parameters used in the valuation, and must apply judgment to the relevance, reliability, and quality of these inputs. When the CV makes use of a team effort, and there's a clear division of responsibilities within such a team, each of the competent persons or technical experts should accept responsibility for their independent contribution. Another responsibility of the CV is that you must clearly state under what circumstances other people's work has been relied upon, and must identify such persons. The author of the evaluation report must be satisfied that their work has not been unduly influenced by the organization, company, or person commissioning such a report. The author of the evaluation report should ensure that all relevant assumptions, premises, and constraints are documented. The CV accepts overall responsibility for the valuation, whether he's prepared in whole or part, and that permission has to be granted to utilize his work, and that the work of other contributors is acceptable and has been signed off by such a contributor. I'm repeating myself there, but it is important. Another responsibility of the CV is that he should be aware of the requirements of generally accepted valuation standards. You should understand things like goodwill, intangibles. And finally, the CV must ascertain their ownership of the mineral asset, whether the property is held as a right or freehold, whether restrictions on rights and agreements which can influence the evaluation. And he or she should include inter alia issues such as the security of tenure, consider these issues, access to the right, servitudes, royalty payments, joint ventures, and the list can go on. So it's all encompassing evaluation. I just want to touch on registration. A competent mineral asset valuator should be registered with either EXA, preferably any one of these, EXA, the South African Geological Council, SACNASP, or a RPO, a reciprocal professional organization. And we also recognize members or fellows of the SAM or GSSA, or fellows of the SAM or GSSA. But when that is subject to a peer review process. Let's look at governance. We have compliance monitoring through Section 12 and Section 8 requirements of the JSE. There are rules associated with CPR, generating CPR. And then there's a readers panel of experts in their field. And the SAMCODES have multiple tiers of governance. Compliance is a condition of membership of SAM and the GSSA. Compliance via recognized professional organizations. That whole system seeks compliance. Compliance with requirements of other statutory bodies, as mentioned earlier. And then there are the listing requirements overseen by the readers panel on the JSE. All complaints are delivered in writing to the SSC, where an ethics committee decides whether a complaint is valid. And if it is referred to the relevant professional organization for further discipline. Go back, I'm going to talk about ROPOs here. This is a subset of a total list of 31 ROPOs. But what is a ROPO? It is a recognized overseas professional organization. The criteria for a ROPO are that the organization must be self-regulatory, representing professionals in the mining and or exploration industry. It usually admits members primarily on the basis of their academic qualifications and achievements or experience. The ROPO requires compliance with the professional standards of competence and ethics established by the organization. All ROPOs have a code of ethics and a disciplinary code, which includes the power to suspend or expel a member. That's an important requirement. A complete list of ROPOs can be found on our website. The commissioning entity should not unduly influence the outcome of a mineral asset valuation. A public report concerning a competent mineral asset valuation is the responsibility of the company acting through its board of directors. This report should be based on and fairly reflect the mineral asset valuation and the supporting documents prepared by a competent valuator. Sometimes a commissioning entity may require the competent valuator to disclose and display independence, meaning that other than professional fees and disbursements received with respect to the valuation, that the CV has no pecuniary or beneficial interest in any of the mineral assets being valued and is not associated with the commissioning entity in any way. And I close now with providing you with a copy of with a bit of some comments on table 1. If you go into the code, you'll find the table. It's a useful checklist of the reporting and assessment criteria and the minimum level of disclosure to be used in preparing the valuation reports. We all use it a lot. That's it. Thank you, guys. Thank you, Tanya.
Thank you very much, Vaughan. Do we have any questions from the floor? Kevin, go ahead.
Thanks, Tanya. Thanks, Vaughan. For a question in relation to highest and best use. So my hypothetical situation would be that the shareholding entity does hedging, but not at the mine site. They do hedging at a third-party subsidiary. Because in country, hedging is not permitted for either tax purposes or other regulatory purposes and so forth. So highest and best use of the mine site would therefore not have a hedging impact because the hedging is not at the mine site, it's elsewhere. It's a financial hedge as opposed to a deliverable hedge. How does that impact highest and best use? Because in that circumstance, highest and best use would probably be a sales value, not an owner's value.
Look, I think we must, you need to also consider the purpose of the valuation here. So I'm going to assume that the purpose of the valuation is to place a value on the mineral asset for negotiating a sale. In this instance, if the asset in the ground, let's say the guy owns a property and he's got all the got a whole lot of second-hand material on the property. He would consider, well, let's take it a bit further. On the property, he has a dump. In your context, he has a dump and it's full of metal that he can possibly sell. So the hedging argument is different. That talks about the price that he can acquire. And I'd only concern myself with hedging in terms of fixing that price that I'd apply to the asset itself. So could he sell this dump at a forecast hedge price? Or is it arguable that he can auction it? What would the highest and best use value be? I hope I'm answering your question here. Otherwise, you just explain it to me again.
Yeah,
but,
I think
I'm trying to separate the two issues here. That a hedge is simply an option that you're taking for some future time. You've got to differentiate that from placing a highest and best use value on the thing you're trying to put a value to.
Yeah, well, see, in my circumstance, my hypothetical situation, I'd be saying that the highest and best use would be to sell it, because your hedges are running at losses, and therefore your highest and best use is a sale. And given your hedges are not in country signed by the operation is actually hedge free, that the shareholder is hedged, and the ultimate shareholder, i.e. you and I as the shareholder of a listed company, would be subject to the hedging, but the company, but the asset itself is unhedged legally. The hedging occurs on consolidation rather than at mine.
This reminds me many, many years ago of the old South Deep joint venture. It was Western Areas joint venture at the time, and I think JCI owned 50%, and
Barrick.
And yeah, it was Barrick, or Placidome, I think, at the time before Barrick.
I'm that old.
So you remember that, Kevin. All right, but that is a good example of what you're talking about. So the value at the joint venture, which, you know, if you recall, part of it was hedged. In fact, 100% of the gold, or the portion of the gold that was produced every month, that the JCI or the Campbell family owned at the time, or controlled, that was all at a price, and they were also under the water. And then on the other side, Placidome were not hedged. So when it came to mining or using the mineral asset, Placidome, their highest and best use was to mine the whole ore body and use as much of the incremental, take as much gold as possible, so long as it was incrementally viable. Whereas the Kebbles needed, or I shouldn't talk about them, but the JCI, thank you. They needed to deliver into a hedge. So the only way they could do that was go for the choicest bits of the ore body, and therefore destroying it. So there was clearly a dilemma there. Now, in the instance of an independent valuator, I would put the highest and best use at the JV level, and when we did that work so many years ago, we actually came up with something in between, and it really determined where the valuation curve started dropping again. You know, there was a sweet point where you got the best value out of it. So there you go.
Okay. Thanks. I think better get on to others. We could debate.
Thanks, Kevin.
Kevin, you're welcome to give me a call, and we can chat about it if you want further.
No, it's more esoteric, and it's more gearing towards a SAMVAL value with an impairment value, and where does the impairment exist, and where does the SAMVAL value exist, and you know, because
Kevin, we've lost you.
Okay.
No, I've got you there, Kevin.
Okay.
But
look, it's more like reader beware.
I see there's Cheryl Matoy there. Would you like to ask a question?
Yes. Good morning. I was just wondering if there is a regulated, prescribed frequency of how an asset's value should be reviewed, considering how volatile the markets can be. So, for example, if the price of my commodity was to skyrocket, would that affect my reported value on the JSE or SX, for example? I'm not sure if I'm making sense.
Yeah, I think you are making sense. So things are changing. I think I alluded to it in the presentation, where there's more alignment now in thinking around the world. But there was a stage where on the SEC, they'd require a specific price, say the price of the last 3 years or 4 years, and they want that to be used. Whereas if you look into the eyes of a SAMREC or a SAMVAL CV, you'd really apply your mind as to what is the most appropriate long-term value. So you might want to avoid using anomalies in price or loading it with a view of, you can use a spot price, but it wouldn't be prudent. I hope that answers your question.
Yeah, no, it does. Thank you.
Andre,
Hi, how you doing?
how
man?
are you? I'm good, thanks.
I'm good, Lord. Yeah, I just want to quickly go back to Kevin Davies's very interesting and rather tricky question that he posed to you. But when it comes to the valuation, independent valuation, the highest and best use does not consider a specific owner of the property. It is just the highest and best use. So as you, in your example of JCI versus Placidome, it clearly shows that the two different partners had, for each one of their own circumstances, the highest and best use was different. But when you do the valuation, you should not consider that. You just consider the asset in an absolute sense.
Yeah, but you, in your personal, you as an independent third party would consider the highest and best use for that asset, not for the respective owners of the asset. Would that be
Exactly,
right?
yeah. So it's an asset, and you should rather put yourself in the place of the hypothetical
100%
buyer
owner.
who is not encumbered by any other issues.
Correct.
Yeah.
So you'd be looking at the mineral asset on a 100% equity basis. That would be the right way, and then you can split things up after that.
Yeah.
Kevin, does that help?
The way I'm interpreting it is that it's always as if the asset is for sale in an unencumbered position.
Correct.
And ignore anything else around it. So it's back to anyone who's using a valuation report must understand that, and it's reader beware. Read the small print, because the impact might be different.
Kevin, and that also goes to, when you're trying to get clever by using taxes or sunk costs and all sorts of other accounting measures to make an asset look pretty. It's the same thing with hedging and arguments like this. The best is to undress the asset completely and then do a basic 100% equity owned type approach and look at it at the operating level first. Before you even consider overheads. And if you're not making acceptable margins as you move through your valuation, then you're not like, you've got a problem. I'm not talking about a market comparable approach, but generally on a DCF. So you can, and then you can start getting intricate and adding on a valuation, because it may be that one of those owners has asked you to do a valuation for him or her or the company. And you're then obliged to consider those things. But start by looking at the fundamentals and then playing with it from there onwards. I think that keeps us a bit sane.
Yeah, I've got an existing example, particularly in Argentina, where the highest use of the asset is quite good. But given exchange control regulations and everything else, actually no one wants it. So if you could find something inside Argentina, you could do quite well, but then leave your money in the bank. But you can't find any foreign investor to go into Argentina. And so you end up, from an accounting perspective, impairing what is actually a positive cash flow asset, because you couldn't sell it even if you wanted to under the current economic circumstances.
That's correct. You'd advise your client to try and find an investor who's already in the country and using funds from within the country.
Yeah, but then the money's blocked, and therefore you've got to discount it back to see when you might ever get it.
So I'm going to talk more about the philosophy of valuation, what it is. I'm not going to go too much into technicalities. Other people have been doing that And since I know every single one of them personally, I know they've been doing a really, really good job of that. So you would have learned about the technicalities of evaluation of mineral assets quite a lot. So, and this I'm going to try and make you understand what the hell, philosophically speaking, what does it mean? What does value mean in the terms of using it for the valuation of a mineral asset? So for that, I'm just going to carry on. Why? Oh, that's the one. Right. So yeah, the contents will be introduction to value and valuation, and we'll talk a bit about market approach to valuation. I'll mention all the methodologies and things like that, but I'll talk around them and not take you through the details of applying them. And the same with the income approach and the cost approach. And then there'll be some closing comments in the end. Quick introduction of where I come from, with the company I'm leading at the moment, A&B Global Mining, blah, blah, blah. You can read that yourself. I'm not going to bore you with the details on that, but yeah, we do a lot of work, mainly in Africa, but lots of other places as well. Right. Why? Why is there a need for valuation? Why do we do valuation? Well, there are plenty of potential reasons. One is to satisfy the regulatory requirements of stock exchanges. So this may include listing a new company or a material transaction. And it's really that valuation is done to ensure that no shareholders, either on the buying side or the selling side, that no shareholders really gets cheated, because it often works. It sometimes happens in listed companies. It shouldn't, but in private companies, that the management of the company, the directors may have an asset, and they can inflate the value of that asset, sell it to the company that the directors of, which means that the shareholders pick up the tab, and the directors pocket the money for the overinflated money of value in their pockets. That happens so regularly, it's like breakfast. It happens almost every day that the shareholders of companies are cheated like that. Of course, then there's a public offering of shares or any other instrument to solicit investment in a mineral venture. So basically, again, it has to do with public money. Of course, for tax purposes, you need to have a valuation as well, and because assets are accounted for in tax statements as well. Auditing of financial statements, they usually tie up with are required for tax purposes as well, but for other things as well. So how much is the company really worth? But all of those first four ones have to do with dealing with public money, really, because tax is public money as well. It's my money and your money. So so that all of that's really to protect public money. So whatever money you have been willingly or unwillingly, most likely in the case of tax, been made to part with, whoever takes care of that money should not cheat you or waste your money in any unseemly way. Right, then there are other things as well. They could be just for the internal managing of expenditure efficiency for exploration, developing acquisitions, productivity improvement. So it's all internal within a certain company then. And in this case, it's not directly to do with public money anymore. This is now managing the business of the company. So, and knowing the value of things obviously will help you to make sure that if you spend money on something, that that value increases. It can also be for a dispute, for a deal that went sour, or where somebody feels that, well, they overpaid for an asset and they weren't aware of that. Both Vaughan and I have been involved with big international court cases and arbitrations, and although it sharpens the brain a lot when you have various world-class lawyers trying to take you apart, it's also not a very pleasant experience to go through. And of course, it could just be for curiosity. I mean, maybe you're just an exploration geologist, but perhaps you have an inquiring mind and you start thinking, well, this stuff that I'm doing, what kind of value am I adding to this these assets I'm working on, kind of thing. And it's nice to know. It's nice to know that how the world of money works. And I think in everyone who's gotten into a bit more senior position in any business or industry will know that everything revolves around money. It's a driver and a controller of everything. So if you understand the role that money plays in the mining industry, that cannot be bad for your career. Anyway, you see in the red at the bottom, I said, not all the reasons for a mineral asset valuation require the same approach to valuation or the same requirements or standards for reporting of such a valuation. Quite clearly, if it's internal managing of expenditure, you don't need to satisfy all the hoops of a SAMVAL or SAMVAL or Velman. So you don't really have to stick to that. Yet, it is good professional conduct to adhere to accepted best practices. It's the same, don't get into bad habits. If you work with mineral resources and so on, don't get into bad habits. Always do it according to best practices, because that's a great habit to develop in your professional career, to stick, not to take too many shortcuts, if at all. Okay, so what is value? There are many flavors of value. Basis for each type of value is important, being the fundamental measurement assumptions of the valuation. And most valuation codes require that this basis of valuation is disclosed and described. The one that we hear most is market value, which is roughly equivalent to fair value in most codes. The term fair market value is also used in some jurisdictions, and most of the court and arbitrations hearings that I've been involved with, it was used there. And it's nothing different. It's just superfluous. Saying fair market value is the same saying fair value or market value, because fair and market are pretty much the same thing. Okay, we spoke briefly about the highest and best used during the comment or the question series after Vaughan's presentation. And you got to consider in that what use that we make of made of the asset that would maximize the value of the asset to the owner of the asset. That owner is not the current owner. It could be the future owner, it could be the current owner, but it is the owner. And that owner is more of a hypothetical being than anything else. In other words, it could be that a specific owner who can realize more value out of that by using the asset in a different way. Now, normally when we value mineral assets, we consider them as mineral assets, but I think the concept of highest and best use is more to just to keep the valuers or evaluators mind open to the concept that there may be completely different uses, but there have to be these different uses. I mean, you could be looking at a mineral asset, maybe it's a bit of a marginal grade deposit or whatever kind of thing, and hey, if you build a Disney World on top of it, it may be worth a lot more than a mine. But you got to ask yourself, would that be technically feasible? Is it physically possible? Would it be legally permissible? And would it be financially feasible? Because you're in the middle of if you're close to Pitsonderwater, build a Disney World there, maybe it may not be so financially feasible. Anyway, you get the idea. Market value, what is it? SAMVAL aligns with the IVSC, International Valuation blah blah commission, and it says that market value is the estimated amount for which an asset or liability should exchange on the valuation date between a willing buyer and a willing seller in an arm's length transaction, after proper marketing and where the parties had each acted knowledgeably, prudently, and without compulsion. That's a bit of a mouthful. Huh? So let's unpack that a bit. Market value. Okay, the first part is the most probable price reasonably obtainable in the market on the valuation date, in keeping with the market value definition. It is the best price reasonably obtainable by the seller and the most advantageous price reasonably obtainable by the buyer. So you're coming from both sides. This estimate specifically excludes an estimated price inflated or deflated by any special terms or circumstances, such as atypical financing. Kevin, I think that's your Argentinian example would fit into maybe into atypical financing considerations. So what you've got there is not part of the market value, but because the market will consider the market in which the asset is, which is Argentina. So you can get a better price there. But if you are advising your client, you would have to then adjust the market value to a reasonable value for your client, which is not necessarily the market value, but it's a value that makes sense for your client. So you got to keep that in mind. Okay, so no funnies, or the funnies that need to be excluded is atypical financing, sale and leaseback arrangements, special considerations or concessions granted by anyone associated with a sale, or any element of value available only to a specific owner or purchaser. Okay, then and we'll come back to this, the owner and so on later on, when we get to the willing buyer and willing seller considerations. An asset or liability should exchange refers to the fact that the value of an asset or liability is an estimated amount rather than a predetermined amount or an actual sale price. It is the price in a transaction that meets all the elements of the market valuation definition at the valuation date. So the market value definition is very important. If I go back, it is this one here. On the valuation date, brings in the concept that value is time specific. In other words, a value is only correct for approximately a couple of days or so, or whatever, depending on how the big things change. Maybe it may be relevant for a longer time and so on, but it's only valid specifically on the time of the given date. And that is because it is part of the human world, which is changes over time all the time. So markets and market conditions change. The way specific assets are viewed and hence valued by the market change depending on commodity prices and geopolitics and a lot of other things. So the valuation date is quite important. Right, then a willing buyer refers to one who is motivated but not compelled to buy. And he wants to buy, he's not disinterested, but he doesn't have to buy either, which is a nice way of saying that this hypothetical person would be neither overeager or nor determined to buy at any price. Of course, we're all humans, and we're all motivated by all kinds of things, impacts on our lives, and so there is no the hypothetical willing buyer as to defined here probably doesn't exist at all. But you got to try and put yourself in the place of somebody like that. So and any decision you make around the value or how you approach the use of a specific valuation methodology and so on, you've got to bring it back to this to say kind of thing. How would this concept of a willing buyer consider this? So yeah, the buyer is also one who purchases in accordance with the realities of the current market and with current market expectations. Expectations, very important. because a lot of what we perceive to be value is based on expectations. And yeah, how do you actually quantify expectations? I mean, expectations, yeah, it's I've had difficult debates around this with a lot of people over the years. It's easy to write that. It's not that easy to actually fully understand or use that term. Anyway, so current market expectations, rather than in relation to an imaginary or hypothetical market that cannot be demonstrated or anticipated to exist. So you got to tie yourself back to what is reasonable, what's relevant, what's current. The assumed buyer would not pay a higher price than the market requires. So that is the willing buyer, because he's under no compulsion to buy. So he wouldn't, or she wouldn't, pay more than what the market requires. The present owner is included amongst those who constitute the market. So present owner are, presumably would be the seller. So that's a person also part of the market. Right. Then a willing seller is also not overeager, nor a forced seller, prepared to sell at any price, or one prepared to hold out for a price not considered reasonable in the current market. The willing seller is motivated to sell the price at market terms for the best price attainable in the open market after proper consulting, whatever that price may be. The factual circumstances of the actual owner are not a part of this consideration, because the willing seller is a hypothetical owner. I think you guys understand that. It's very similar to the willing buyer, also a hypothetical person. And it's the situation you've got to put your own mind in when you consider the value of a mineral asset. Arm's length transaction is one between parties who do not have a particular or special relationship. For instance, like a parent and subsidiary companies, or a landlord and a tenant, that may make the price level uncharacteristic of the market or inflated. So you got to remove the consideration of any special relationship between a buyer and a seller, because the market value transaction is presumed to be between unrelated parties, each acting independently. After proper marketing means that the asset has been exposed to the market in the most appropriate manner to effect its disposal at the best price, reasonably obtainable in accordance with a market value definition. The method of sale is deemed to be that most appropriate to obtain the best price in the market to which the seller has access. The length of exposure time is not a fixed period, but will vary according to the type of asset and market conditions. The only criterion is that there must have been sufficient time to allow the asset to be brought to the attention of an adequate number of market participants. The exposure period occurs prior to the valuation date. Prior to the valuation date, because after the valuation date, things may have changed. Anything that happens before the valuation date would be a valid influence on the value of the mineral asset, but anything that happens after the valuation date may not be considered. With the later I'll come back to I may come back to that, but a little bit, because I've argued that then there are circumstances in which that may not be applicable. Anyway, but really after proper marketing means that you should when you determine the market value of a mineral asset, you should consider it trading on an open and free market, where enough buyers and sellers have the opportunity to get involved in the deal. So it cannot be a closed sale. Right, where the practice is acted knowledgeably and prudently. Presumes that both the willing buyer and the willing seller are reasonably informed about the nature and the characteristic of the asset. its asset and potential uses, and the state of the market as of the valuation date. Well, I've certainly seen, well, I should say, each is further presumed to use that knowledge prudently to seek the price that is most favorable for their respective positions in the transaction. Prudence is assessed by referring to the state of the market at the valuation date, not with a benefit of hindsight at some later date. That's very true. For example, it is not necessarily imprudent for a seller to sell assets in a market with falling prices at a price that is lower than previous market levels. Why? Because you think it's going to fall even lower. So if you sell it at less 10% now, it's better than to sell it in a week at less 50%. In such cases, it is true for other exchanges in markets with changing prices, as is true for other exchanges in markets with changing prices. The prudent buyer or seller will act in accordance with the best market information available at the time. So yeah, I think you've all read about some mineral transactions during your careers and think, gee, that's a steal, or oh man, are those guys crazy to pay that much for that crappy asset? Maybe because you have some inside information that the buyer and seller was not aware of, or there may be other reasons and so on. So just got to be careful when you look at transactions that you want to use as comparable transactions. That you look at those very carefully to analyze whether there are anything about that deal that would not satisfy this. Often it could be that there may be a specific positive for the buyer or negative for the seller, which will skew the price one way or the other. So you have to ask yourself these rather cynical questions when you look at value. Okay, without compulsion, it just establishes that each party is motivated to undertake the transaction, but neither is forced or unduly coerced to complete it. Oops. Right. The concept of market value presumes a price negotiation in an open and competitive market where the participants are acting freely. The market should consist of numerous buyers and sellers, or could be one characterized by a very limited number of market participants. The market in which the asset is presumed exposed for the sale is the one in which the sale notionally being exchanged is normally exchanged. So if it's a really special deal with just one or two people participating and others are excluded, and there are all kinds of other terms maybe and so on, that wouldn't be a normal way of exchanging an asset. So in a case like that, you would have to be a little bit or query the value a bit more closely. Right, other values that we have: synergistic value is the result of a combination of two or more assets where the combined value is more than the sum of the separate values. In other words, it's a special situation where, but if you are valuing 3 or 4 assets, let's say you've got a package of 3 assets and you've been asked to value it. If the assets are going to be disposed as a package, you have to value the package, because the package is the asset, which means you will value the individual assets, but you will then also take into account the particular attributes of these assets that'll make them worth more than the sum of the separate values. So if, however, there are 3 assets belong to a company, but the company intends to sell them all separately, or they are widely removed from each other in the sense that there are no synergistic values, and it's just the individual assets which will be summed up to come to the complete assets. So because there will be no synergistic value in a case like that. Intrinsic values and lots of others intrinsic value. In mining, the intrinsic value refers to the fundamental value based on the technical inputs and the cash flow projection that creates a net present value. Few of these inputs are market related, except possibly for commodity price, benchmark cost, and the discount rate applied. Intrinsic value will require some adjustment to reflect the market value. And there are at least 12 types of value listed in the various documents I've read over some time that I have in my sort of electronic library. So, and sometimes you'll get different definitions for the same name, same label of a kind of value. So, but in our case, we're going to stick with market value for the rest of this presentation, and not worry too much about the other ones. Then just want to briefly mention valuation versus evaluation. Valuation is concerned with the market value of a mineral asset. Nothing else, nothing more, nothing less. Evaluation is a combination of technical assessment and evaluation of economic performance. It produces a technical or intrinsic value which may not reflect market value. Typical cases of feasibility study. Feasibility, do all the technical work, get all the costs and things, chuck them into a discounted cash flow model, and you get an economic evaluation or assessment of that asset as presented in the feasibility study. That NPV that comes out of that does not necessarily reflect market value. Just be aware of that. There'll be a note later on to underline that again. Okay, then who does the valuation? Right, code compliant valuations. A competent valuator or valuer, or I think SAMVAL has got another term as well. Whatever, a practitioner, the Australians call it. If a valuation is being done for a listed company, i.e. public reporting, at least one of the various codes for reporting mineral asset valuations will apply. These codes all stipulate certain levels of experience that the valuator or valuer should have. Funding equities such as banks usually also require valuation to be done in accordance with an acceptable code. All right. Code compliance is not compulsory. Sorry, Tanya. It's not compulsory. Courts of law often do not rely on the codes, but rather require that expertise be established before the court. Courts, if we give a bad pun, courts are a law to themselves. So they decide what they like or not. Adhering to internationally accepted practices, however, and the codes have become important in this. So in spite of the court ostensibly not relying on the codes, by demonstrating via the codes that you are applying internationally accepted practices in the value that you're putting before the court, helps to establish competence and expertise. And therefore, legal counsel are increasingly referring to codes in cross-examination. Of course, if in cross-examination, the valuer who put a value before the court can demonstrate that they have complied with the requirements of the codes and the guidelines, then that is a great form of protection, because it directly implies that the whole body of expertise in the subject matter, being mineral asset valuation, agree with the way you've done it. It's very difficult for a legal counsel then trying to convince the court that you are talking rubbish. Anyway, that's that. So no compliance. I say compliance is not compulsory. However, I say it's entirely legal in most jurisdictions for a completely unqualified person to compile a very misleading valuation. There's really, if there's no law against it. However, apart from it being really regrettable, and it not helping at all with the professional standing of mineral industry professionals. It is, if you consider yourself to be a professional and you consider any evaluation, it is really just good professional conduct to comply with the codes and comply with the international best practice standards. Right. 3 main codes at the moment. There are probably a few others as well, but just about anywhere in the world at the moment, if you have to do a proper independent mineral asset valuation, you'll be required to use one of these 3. And they're all very, very similar. There's a Canadian one that's got recently updated, the Australian Development Code, which is the granddaddy of all the codes, same as the York Code. And both Australian codes were precipitated into being because of the vast damage that was done to the mineral industry, and especially funding of juniors following the Bre-X or Buseng scandal. And of course, the South African code as well, which is very, very a good code and brought some nice things into the 2016 edition, which was then updated in 2018. And I think the Canadians took some notice of that as well. So. Right. Still on the competent evaluator. Generally speaking, what kind of a beast is this? Person who possesses the necessary qualifications, ability, and sufficient relevant experience in valuing mineral assets. Must be able to face their peers and demonstrate competence in the valuation undertaken. Must accept full responsibility for the form and content of the valuation report. They must be satisfied that the work of other experts is acceptable and signed off accordingly. They still have to take responsibility for the other experts' work as well, in the sense that those experts' work gets incorporated into the valuation report. Things which must be assessed by the competent evaluator include technical data information, technical interpretations, technical conclusions, forecasts and parameters, the valuation approach, which ones to use, valuation methodologies, which ones to use, the risks associated with the asset and the potential impact of those risks on value. So now that was just leading us into valuation a bit. So now we're going to speak a little bit more about the process of valuation itself. And it's based philosophically on these 4 pillars. Materiality, transparency, competency, and independence. Materiality, basically that, if it's material, you got to take it into account. If it's not, don't clutter things unnecessarily. Transparency, this is my favorite. Evaluation report should not be a black box thing. If you cannot follow everything that the evaluator has done and replicate it and understand their reasoning so that you can actually change things in the valuation yourself if you want to, for your own purposes, then that report is not transparent. It should be clear, unambiguous, but it must have sufficient information. For instance, just putting up a slide with different values of unnamed assets, a graphic of unnamed assets, but and then saying, well, the asset I'm valuing fits there in that grouping, so it's got that value. That is not transparent, because the reader does not know where that data comes from. He does not know, they don't know where, how those dots on the graph came to be where they are, what data was used, anything. If you're going to use a graph, you have to supply the data that graph is based on. Otherwise, you are not transparent. You're using a black box. So, I would say that a lot of valuation reports fail on this issue. Competency, yes. The evaluator has to be competent, responsible, suitably qualified, experienced. Independence, clearly. That's the whole point of it. So I noticed in the recent SAMVAL update, they brought in 2 more sort of, they didn't call them pillars, but principles. The one is reasonableness, which is neither mentioned by SAMVAL or MinVal as a principle, but it is discussed in both of them quite a lot. The one that SAMVAL brought in is objectivity. Well, objectivity, independence, not quite the same thing, but certainly they talk to each other. So, but I'm happy to accept that objectivity, because it is important. You have to be objective in it. If you're independent, I guess you should be objective. Anyway, but reasonableness is, in the case of MinVal and SAMVAL, more of a golden thread that's woven through the whole code. That the valuer or practitioner should apply the concept of reasonableness to everything they do, every conclusion they reach. The guiding philosophy on mineral asset valuation should be prepared by or under the direction of and signed off by an appropriate qualified person. Yeah. Reliance on other experts is allowed, but not blindly. You still have to review that. All relevant information is fully disclosed. Professional judgment is allowed. In fact, it's encouraged. Presenting a reasonable range of values from which a preferred value is motivated, and the preferred value is not the midpoint of the reasonable range. If you say that, you haven't applied your mind. Determination of value is based on a specific set of assumptions at a specific point in time, and those have to be clearly stated in the valuation report. Excuse me. Okay, so it must be made clear what is included in the mineral asset as well. So whoever reads your valuation report must be able to understand exactly what you included in the mineral asset. So typically what is included is the mineral right itself, then the use or ownership of the land surface. If it's an operating entity or even defunct entity, are there any mining infrastructure, plant, equipment on site, part of the asset that may still have a value? Note that a company or enterprise is not a mineral asset. It's just a holder of a mineral asset. So enterprise value or market cap from a share for a listed company is not the market value of a mineral asset. Market capitalization does not reflect mineral value. Oops. Where are we now? Go back there. Yeah, 2020 McKinsey reported that DCF based, discounted cash flow based valuations are consistently lower by 40% compared to market capitalization. So that demonstrates that asset value and market capitalization not the same thing. And it's not just always lower by 40%. It can be lower by 5%, can be higher by a certain percent or so. But on average, it's tends to be lower by about 40% compared to market capitalization and the asset value. As I say, why? Well, either the asset values are under estimated. The DCF-based valuations are either underestimations, which may be so, may not be so. In some cases, there may be overestimations. In other cases, there may be underestimations on the DCF-based values compared to market value. But mainly it's because the market capitalization looks into future growth of the company. It considers the management of the company, And therefore, it tends to be, if the company is reasonably well run, it tends to be much higher than the asset value. And if you look at the stellar company like Randall, now part of Barrick, if you track them over time since they started off, you could just see that how the share, the market capitalization just way outstripped the underlying asset values. And that was largely based on their track record of success. So whoever was buying Randgold shares considered that they would have that upward trajectory for quite some time, and bought it on that basis, on the share value, not on the asset value. And it had to do with the track record of success and a really, really good management team, which delivered success regularly. Whereas other companies were trading probably below their mineral asset value for reasons that would be exactly the opposite of. So with a troubled history, the management is not held in high regard by the institutional investors, and so on. So just market capital does not reflect mineral asset value. Enterprise value is not the same as market capitalization, but it still includes a lot of other values apart from the hard asset values. Okay, if a transaction involves a corporate entity holding mineral assets, the mineral assets should be valued by a competent valuator, but the corporate context and opinion on reasonableness and fairness of the proposed transaction will be provided by corporate advisors. And this is where the question on the from Kevin on the, or his comment rather, on the Argentinian asset. This is where the difference would come in between just the simple mineral asset value and then what would be a fair consideration for a corporate deal. And in this case, there are clearly certain corporate contexts and things which come in, which would change what a buyer from outside the country would consider to be a reasonable and fair transaction. Okay, now let's talk about the different approaches. You know, there are approaches and there are methodologies. So there are only 3 approaches. Each one of these approaches have several methodologies underneath them, ways of implementing that approach. The market approach is based on the philosophy that something is worth what someone is willing to pay for it. Willing buyer, willing seller kind of principle. Income approach is based on the philosophy that the value of something is related to the income that can be generated or by it or derived from it. So it's a value in use. The cost approach is based on the philosophy that the value of something is related to the cost of replacing or replicating it. In other words, if your house will cost 3 million to rebuild today, then you could say, well, my house is worth 3 million rands. Of course, it may not be, because when you rebuild it, it's brand new. Your current one may be old, maybe a bit decrepit or not, but it gives you a basis to start a process of estimating the value. So there are those 3 approaches to it. The one at the market is straightforward, compare it with other deals or whatever, try and determine what the market value is. Income, so well, it's only worth as much money as I can make from it. And cost approach, well, if I lose it, how much will I have to spend to get it back? So of these, the market approach is the most direct measurement of market value, and it's generally one of the preferred approaches. The other approaches primarily derive a technical value, which then has to be manipulated to reflect an approximation of market value. Right, so here's a whole list of all those things. Lots of different permutations on the market. The original market approach, the original methodology is comparable sales, which is usually used in lots of other assets, like real estate assets, because like houses, because, well, it's easy. I mean, you just got to take, if you want to know what a house is worth, just look at similar houses in the same or similar neighborhoods in the same area, and you'll get a lot of sales, and it'll be very easy to, from that, to determine a reasonable estimation of the market value. However, on the mineral side, almost every single asset is unique. The geology is different, the mineralization is different, the depth of mining, the differences in geographical spread, sizes, all kinds of things differ. So it's very, very difficult. In fact, it has been said by more than one practitioner that it's impossible to get a directly comparable transaction in the mineral industry. Because even if it's the same asset that's been sold twice, and its asset may not have changed in that time, and I've worked on a case like that. They are still not directly comparable, because in the meantime the commodity prices have changed a lot. So and that changed. So to overcome that restriction on comparable sales, clever people have come up with lots of interesting things to do to create more comparability between sales that are not directly comparable. Okay. Well, the first thing was not so much to make things comparable, it was to just broaden the concept of sales. So the Australians especially started to use option and farm-in agreements as a form of sale, and to analyze them and then express them as a single cash sale. Then people started expressing market value as terms of value per some form of unit. It could be a unit of mineralization, either it could be an ounce of gold or a ton of iron ore. Gold is gold, but iron ore is not iron ore. You get different grades and they have different values. So you see, it gets a bit messy, even if you try and make things more simple. Or could be a value per unit area. That was borrowed directly from the use of this in United States forestry, where instead of, the valuers quickly figured out that if you have one block of trees, another block of trees, and the one is 3 times the size of the other one, it generally sells for 3 times the value, so or price. So from there, it's a very short jump to realize that there's an inherent value per hectare for forests. So, and then the guys in the mining will borrow that. So exploration ground, for instance, where there are no resources or anything like that, very difficult, what the Canadians call moose pasture. So yeah, that's probably, it's one of the methods get used quite a lot to value it per hectare or the square kilometer, whatever unit, area unit you realize. Market capitalization, no, not so much. You'd have to convince me how you derive market value from market capitalization, which is a measurement of something completely different. And then often one still comes across somebody stating the gross in situ value, say like, oh, I do my calculations, I've got this, I've got a meter thick layer of gravel containing so much diamonds, and it's over an area of so many hectares, and therefore there are so many carats contained in that, and the diamond values are so many dollars per carat, and therefore we have here usually stated in billions of dollars. a value of all the diamonds in there. And of course, that's totally not totally irrelevant, but it is not even close to being the market value, because the market value takes the uncertainties in account of the diamonds actually be there, the cost of mining, at cost of processing, retrieving, selling, environmental costs, and all those kind of things get taken into account, and then you end up with a value that is usually a very small fraction of that gross in situ value, and that would be the market value. So income, Vaughan spoke about the DCF on that, which is the most common way of doing it. There's a lot more to consider in discounted cash flow analysis for valuation than just a basic spreadsheet with discounted cash flows. And I think you'd realize that after listening to Vaughan. Another method, which is the real options method, or real options valuation, ROV, based on option pricing. It has its adherents. It's getting used more and more. It has certain good things about it, but it also has some weaknesses in it. And one of the things that I generally do not like about it is that it is used as a black box. In which case you basically have to believe the evaluator who uses that method, when he says, I'm a evaluator, trust me. Monte Carlo analysis, that's often worked into the option pricing method as well. So those are just ways of evaluating not so much as risk as option, as the various options available to a mineral asset, for developing a mineral asset. And then there's also the probabilistic method, which was roughly at the same time developed by myself and a colleague, Dr. Norman Locke, and some really bright guys in Australia at that time, or they used to be, with Etheridge Henry Williams, which is a fantastic geological consultancy in Australia. So good that SRK bought them out and they became part of SRK. And that time I was with SRK as well. And then we happened to further collaborate on this as well. It is seldom used though. So I'll discuss this in a little bit more detail as well. Okay. Cost, there's appraised value, there's multiples of exploration value. They start off at the same place, but then they diverge. And then there's geoscientific rating, which is not used that often because it has a very nice methodology and one very important weakness. Okay. The definitions, I'm not going to go through there. I'm sure that everyone has been showing this slide to you as well. So, and this is from SAMVAL. How the methodologies are used for different approaches at different stages, or not the methodologies, how the approaches are used for different stages. Again, I'm not going to talk you through this because I'm sure it's been done already. Okay, then let's talk about the market approach. Let's sit there are the different types there. On the left, I'm not referring directly to that. I'm talking in general as we go along. So the comparable transaction or comparable sales method. It's also known as a real estate method because that's where it came from. It uses the transaction prices of comparable assets to establish a value for the asset being valued. It's not based on market capitalization. As I said, there are no exact comparables. There are 10 reasons why at least I listed that. So why it's very difficult to get an exact comparable. So an evolution from the comparable transaction was the value per unit methodology. Australians call it yardstick. But this methodology sets out to normalize transaction values against a unit measure. In other words, usually expected as dollars per hectare, dollars per ounce, dollars per pound, or whatever, if it's uranium, whatever, or zinc. And then, but you see, if you express, say, gold as dollars per ounce, that still varies over time because the commodity price varies. So the next step that went on from there was to, and this is the true yardstick, was to express that, say, dollars per ounce as a percentage of commodity price. And that provides a time-independent measure of value. In other words, what it works down to is in gold. If it's a, roughly speaking, if you show me an inferred resource of 200 ounces, I'll say, well, to get to the value of that, the value of that 200,000 ounces multiplied by the gold price right now, and then multiply it by 2%, that's 0.02, and that'll give you a nice time, a nice quick sort of reality check on what that is possibly worth. It won't be exactly that. Okay, I said a reality check. It won't be exactly that. If you're going to do a real valuation, you will take into account a lot more. Things like grade, type of mining, depth of deposit, where it's located, all kinds of other things. But you can see where the guys were going with this methodology is to try and minimize the variables of between comparables by trying to normalize them against something which is more easily controlled. These yardsticks are based on analysis of actual transactions. They're not just a thumbs up. I just mentioned for inferred gold 2%. That's not a thumbs up. It's based on hundreds of analyses by lots of people. However, if you still go through time and you double check that, you'll see it does not always hold true. So you always have to do your own analysis of actual transactions and so on to make sure that whatever value per unit you use, that you have made sure that you benchmark that yardstick that you're using. Here's an example. This is a South African coal project. This is a few years ago, 2016, 17. I compiled this graph, and this expresses it just as rand per ton. If you do it now, it'll be different. And it wasn't not expressed as value per as a percentage of the coal price either. So it's just rand per ton of coal, and you can see that at least it behaves in a reasonable manner, and that as you go from lower grade, lower categories of resource and reserves to higher categories, the value increases, and it increases a lot. You'll see this graph is logarithmic on the vertical axis. So and in where the target, the valuation target for this was had some inferred, mainly indicated, and some measured resources. So a preferred range, they're sort of in a gray area there. So this is an example of how it was done. Now, of course, this is exactly if I present you with this. And so based on this, I conclude that the value of a project that we're referring to is 5 rand per ton of coal resources and reserves. I may be right, but you have no idea of knowing that, because all you've got is this graph. You don't know the background to this graph. You don't know the data. You can't evaluate it for yourself to see whether I'm talking rubbish or not. So and this is where transparency comes in. Right. Just for interest's sake, this is some typical ranges of values per unit that have been reduced to a percentage of the in situ value. So gold typically vary between 2 and 4.5%. Could be outside that, but typically it fits in there. PGS is about 0.5% to 2.5%. Base metals 0.5% to 2.5%. Iron ore 0.5% to 2.5%. Diamonds about 2 to 4.5%. Coal about 2 to 4.5%. Actually, coal often blows out way up on the right-hand side as well, and much higher than 4.5. But firstly, you should notice that there are two things. There are only two kinds of ranges. The one is about 2 to 4.5%. The other one is 0.5% to 2.5%. Why? Why do these things behave differently? So if we had a lot more time, I would ask for speculation from the floor, because normally if I give this as a lecture to university students, that's exactly what I want them to think about why it is. So, but in this case, I'll give you some indications. Base metals, much lower than that. Why? They're very expensive to extract. They're polymetallic mines, fairly low grade usually, with big, expensive concentrator plants, with not great recoveries. You know, if you get 90% on some of the base metals, that's fantastic. Unlike gold, where you can often get more than 95% extraction. So the cost basis for behind a ton of lead or zinc that you put on the market is quite different compared to gold. And diamonds indeed as well. Diamonds also, like gold, you know, the processing is simple, and because highly concentrated, transporting it and so on is not a problem. It's cheap, of a small part of the total cost chain. So, but base metals, say they expensive to process. PGE, although people see them as precious metals, they're actually base metal deposits because they have disseminated sulfides with polymetallic nature. So the things which apply to base metals also apply to PGEs. Iron ore, the processing is usually quite simple, but most iron ore has to be transported over long distances, and that has an effect on it. So it's a low, the iron ore itself, even if it's 67% FeO, it's still a low value commodity, bulk commodity, which you have to travel over long distances. So, and that's why it suffers. Coal, interesting. Coal also often gets transported a lot. It's also a relatively low value commodity. So why does it fare so much better than iron ore? Yes, well, the reason for that is to a large extent in that exploration for coal. Once you found coal, but for after that, the exploration for coal to get to it to resource and reserve status is a very cheap process compared to most other commodities. If you're going to drill, so often with some gold deposits, they may be drilling your holes 20-25 meters apart. Some of the base metal deposits, I mean, some of the big zinc lead deposits in South Africa and Namibia, guys are drilling 25 meters apart. Gold you can drill much further apart. The toll code allows you to estimate the measured resources based on a lot less drilling than on just about anything else. Also, coal generally is mined either open pit or shallow underground, which means that the holes that you drill are not that deep either. So the whole exploration cost of coal per ton of resource is often 10 times less than anything else. And that helps to add some value to it. to coal deposits. All right. Right. So that was the market approach. If we look at the income approach, it's a discount the cash flow method, very well known.
5 minutes, please, Andre.
Okay, it's quite technical, so it often engenders a feeling of being more concrete than some of the other methodologies. However, it's based on a lot of assumptions, and you need to understand that to be able to evaluate the results as well. Inferred mineral resources generally not allowed to be used in the income approach. So you need to be aware of that. Real options valuation, so it's used, not as widely used. It's good at estimating the value locked up in optionality. It's computationally complex, that's an understatement. And it really requires in-depth understanding of the theory and the mathematics behind it. It is still very sensitive to commodity price forecast. DCF uses consensus price forecast, and the only thing we know about a forecast for sure is that it is wrong. We just don't know how wrong. ROV typically uses future prices. Future prices are still estimates of a lot of people of what will happen in the future. And although one may see that as a better way of forecasting future prices, it still suffers from the one big weakness at the DSF as well, in that all these forecasting does not and cannot make allowance for black swan type of events. It incorporates Monte Carlo simulation, probabilistic value. I mentioned that. Not widely used, but it's very well suited to exploration assets, especially if it's a large number of assets. But they have to be in the same geological setting. So there are limitations to it, but it can be very useful in certain cases. Okay, and the income approach. What do you look out for? What are possible pitfalls? The flying spaghetti monster. If you can't understand the Excel spreadsheet, if it's too much of a complicated model and difficult to troubleshoot or audit, then that's a bit of a red flag. Garbage in, garbage out. Whatever you put in or whatever comes out is only as good as what you put in. Be aware of the bit of a digital massage. Often, let's just change that number by 1%, change that number by 1.5% kind of thing. But if you have a few of those, the cumulative effect can push it into the realm of being unrealistic or not reasonable. A lot of, almost all DCF models that I come across do not allow for initial time delays. They all assume that the project starts on day one. This is a discounted model. If you first got to raise funds, you got to do that. You have to do something else. You have to do some value engineering kind of thing. That takes time. You're supposed to maybe drill to get enough measured resources. If you're working on something which is in a pre-feasibility level, all of that takes time. All of that has to be put in before you can start generating cash. So check for those initial time delays when it's and of course, it doesn't hurt to just do a simple model, to do a sanity check where you just use constant money, nothing fancy, and so on, just to see, especially if you get dumped with a very complicated model, run a separate model just as basic as you can, just to check if the numbers, they should be roughly in the same ballpark. And it's the issue of inferred resources which are not allowed. Okay. Cost approach, appraised value, basically just looking at the cost, the money that was sunk into a project, and use that as the value for that project. The Australians then took that and developed it a bit further, where they said, well, let's evaluate the money that was put in there. Was it successful? Was it useful? Was it, does it make sense? And use that in a more intelligent way. And then the geoscientific rating method, which has one big weakness, and that it is all based on a single value, which is the cost of acquisition value, and it's normally a smallish value, and it gets everything built on that. But if you change that a little bit, then you change the outcome a lot. So that's something a weakness to be aware of. This is in a bit more detail what I've just said, so I'm not going to go through that since we're catching up with our time. And come to the second last slide. So, business of mining offers more temptation to the unscrupulous man than almost any other. There are those without the least conscious dishonesty who are tempted to write too favorable a report, to advise an extravagant purchaser, or to continue work where plain hard common sense and good engineering would recommend a more conservative course, or perhaps abandonment of the enterprise. Along with the notices of genuine discoveries and developments, the newspapers are full of lying statements, and there are hosts of sharks around, ranging in size from the great promoter from London or New York to the petty peddler of shares in some backwoods district, each with specimens of ores, glowing prospectuses, reports, and all the paraphernalia of the trade. So what's the French saying about the more things change, the more they remain the same? This was written by Dr. J.B. Porter in the Journal of the Federated Canadian Mining Institute in 1897. So since then, before then, and until now, the world hasn't changed. So when you get a valuation report, I think hopefully after sitting through all this stuff and this whole course, you will be in a position to evaluate it properly so that you don't fall victim to all the kinds of rather flowery descriptions of not such good practices contained in on the slide. And that's it.
Hope you're all doing well this morning. Okay, we're going to have a quick discussion about sort of discount rates, cost of capital, and WACC. And part of the reason that we actually do have this discussion, because often what you'll actually find when you're doing discounted cash flow analysis, the biggest arguments happen around the discount rate. And there's a big argument about what is the discount rate and what should be included, what should be excluded. So we're just going to go through a little bit of theory and practice in terms of looking at how we calculate WACC, and then also just to look at how we use WACC, particularly when we're doing debt financing. Because often what actually happens is I see projects where people actually include all the debt financing, and they've got the debt and they take away the capital, or they include the debt and then they include the interest, and then they use a standard WACC, and actually that's not correct. So what we want to try and do is make sure that people are actually using, when you're using the cost of capital and WACC, you are using it correctly. So obviously when we're looking at WACC or cost of capital, we are talking about the income approach. So we're generally looking at discounted cash flows. So when you're looking at discounted cash flows, I mean, the objective often is to evaluate the economic potential of alternative income producing investments, and so that you select the optimum investments that will maximize your future value. And basically, we do this because basically investment capital, if it's a loan financing or equity capital, yes, I know you can go to the market and you can sell more shares, but generally there are limitations to what you can actually do, and there's limitations to what you can actually borrow. So capital is actually constrained, so you've obviously got to make decisions. And we use the cost of capital so that we can actually improve our decision making. And that's why we call this the opportunity cost of capital, because it actually is for economic decision making. Whoopsie, sorry. Getting ahead of myself here. So again, basically you are actually using the opportunity cost of capital, and you're actually trying to look at what is the return based on alternative investments of an equivalent risk. So your cost of capital should be that cost of capital that you can use for this comparison. Okay, so it's basically based on what are the other opportunities that are in the market, and what is the cost of capital that we would, or what's our opportunity cost in terms of, if I basically invest in this, it means I'm going to forego something else. So that is basically the opportunity that I forego. So that's why we call it the opportunity of cost of capital. But basically, when we're talking about the opportunity cost of capital, we are sort of interchangeably talking about things like the rate of return, the discount rate, and the hurdle rate. So those are the, you know, the terms you'll hear bandied about everywhere. Discount rate, hurdle rate. Companies often have a sort of strategic kind of hurdle rate that they want their projects to meet. But I mean, it's the same, it's basically the same thing. It's their opportunity cost of capital that they want to actually meet in terms of the projects that they invest in. Okay, basically, and if your opportunity cost of capital is greater than your financial cost of capital, then generally you will actually get a better return. So basically, when we talk about financial cost of capital, we're generally talking about the cost of debt, and generally talking about the after-tax cost of debt. So if you can borrow money at 7% and you can earn a rate of return of 7.5%, obviously then you're getting a positive return on your borrowed money. So always, if your interest rate is less than your equivalent cash return, your project will actually bring in incrementally more money. So your rate of return will actually be better. Okay, so when we talk about the weighted average cost of capital, I mean, obviously, again, like we said, we're using this in capital budgeting decisions, trying to trade off different projects against each other. Generally, though, when we talk about this, we're generally talking about projects with the same risks as those that already exist in the business. Now, often that doesn't actually happen, but then we can adjust our cost of capital for that. But just to sort of look at WACC itself, so the weighted average cost of capital is basically your ratio of your debt to your total debt to equity times your rate of your debt. And we generally take off the tax rate, because in most jurisdictions, basically interest is tax deductible. So basically you get the tax benefits. Well, the interest and the principal is tax deductible, so you get the tax benefit. Whereas with equity, so your ratio of your equity to your total debt to equity times your equity rate of return. So if you look down at the bottom here, you'll basically see, so if you've got a company simplistically with a debt to equity ratio of 40 to 60%, and your cost of debt is 9 and your cost of equity is 14, and basically, as you can see, your cost of equity is your 14% times by your 60%, and your cost of debt is 9 times by your 40%, and you add them up and your WACC is basically 12%. But bearing in mind now, what we're talking about now is nominal WACC. We haven't taken into account any inflation or anything like that. And we also haven't taken into account the tax rate on your debt. So simplistically, that's just that's the quick calculation. Okay, so the cost of debt is actually fairly simple, because the cost of debt, you'd be using an interest rate. Now, often what you do with a company, you can actually have a look at their actual loan book and what their cost of debt on that actual loan book is. Or if you're doing a project and there's already project financing at a specific rate, that will be your cost of debt. So cost of debt is generally a reasonably simple calculation. When it comes to the cost of equity, that's not such a simple calculation. And there are various ways of actually looking at your cost of equity or calculating your cost of equity. The one that is mostly used is the capital asset pricing model, which basically is effectively you're looking at your risk-free rate, And then you're looking at a rate of return or your market risk premium, which is basically your market risk rate minus your risk-free rate multiplied by your beta. Now, your beta is your systematic risk of equity. And effectively, all that means your beta is basically a measure, so of a particular stock. It's the difference in the volatility of that stock relative to the volatility of the market. So that is actually also a calculation which you don't generally have to do, because that's information that you'll find you will actually go and source. And there are multiple sources of finding information on betas. So why do I keep doing this? Let me just go back here and just go back here. There we go. That seems to work. Okay, so this is your formula, your risk-free rate, your risk premium, which is your market risk rate, minus your risk-free rate multiplied by your beta. Okay, so we're going to have a look at, in practice now, how do we actually calculate your WACC. So this is an example. This was a project I did. It was an Australian company that had a project in the DRC. And just to basically show you what you actually have a look at. So in terms of your inputs, so you want your risk-free rate. So I think the project was around about a 15-year project. So I looked at the Australian bond market and got the sort of 15-year yield on the bond market. So that was a 2.37. And you can see sources of information. Bloomberg is generally quite a good source of information for that type of information. Then your market rate. This was your average return of the Australian Stock Exchange from 1900 to 2019. So that was 13%. Now I could have used that as your market rate minus your risk-free rate, and I would have got 11%. I did, however, find the market risk, a market risk premium on this website, the Stern University website. Again, I suppose here, I think you must be quite cautious. It might actually have been better to have used the higher rate, because it's a longer period of time. So you'd have a lot more market ups and downs in the market. So if you're looking at a market risk premium, make sure it doesn't only cover like 5 or 10 years, because then it's not necessarily taking into account big swings in the market. And the market does obviously have big swings. So just check when you're looking at those numbers. Don't sort of use like a 5-year rate, because I think it will underestimate it. But nevertheless, I actually did use that rate. Then the beta. So basically, I looked at the company, and you can go and look. There are quite a few places that you'll get this. This came from Infront Analytics. I mean, Bloomberg often does have these. So I mean, there are lots of these websites where you will actually get this information. Obviously, beta, you're not going to calculate yourself. It is information you're going to actually have to look up. So there was the beta. And in terms of the cost of debt, I looked at the prime interest rate. I also looked at the company interest rate. So in fact, there were 2 rates that I actually looked at, because in terms of the model, they assumed a 15% interest rate on the debt. I looked at the company interest rate. The company interest rate was 9.4%. I think I actually eventually used the 9.4. So again, you know what, you always should actually have a look, and you might actually have to have some sort of sensitivity around your discount rate to take into account of things that may not always be that clear cut. And the tax rate, so you can get the after-tax cost of debt. And then the other thing that we actually also looked at, so again, although it's not necessarily part of the actual WACC calculation, what we always do look at in terms of when we're looking at mining projects, and it's one of the things in terms of the SAMVAL code, is you actually should do basically a risk assessment, and you should understand the risks around your project. So what we actually do as well is we add a technical risk premium. So in terms of the technical risk premium, one of the things we looked at, obviously, a country risk premium. And again, you get this kind of information from Stern, Trading Economics. There are a couple of places where you can actually get it. So we basically looked at a country risk premium for the DRC, and then it was a greenfield project. So we added another 2% for the greenfield project. So in fact, there was quite a hefty technical risk premium in terms of the WACC. And then obviously you've got to actually also have a look at the inflation rate, because when we actually do the WACC just on the data that we've got, we're always looking at nominal. So the numbers that you'll get are nominal. So you need to take into account inflation to get it back to real, because normally you're going to be discounting your real cash flows. Okay, and then your debt to equity ratio. So basically in the DRC, the maximum debt you could have was 60%. So we took a 60-40 ratio. Okay, so that I just gave you to actually show you where you can actually find information. Then just quickly, while we're actually just talking about this. So now often with this information, so in particular for this company, it was a listed company in Australia. So quite a lot of this information was available. But often what you're going to actually land up doing is you're going to actually be valuing or evaluating a project that's not effectively a listed company. So what do you do if it's not a listed company? So basically then what I would normally do is if it's like, say, a coal company, I would go and have a look at a number of coal companies that could be similar to the project or the company that I'm actually having a look at, and I'll use that as a proxy. If it's a gold company, I would go and have a look at, say, like a Goldfields or a Anglo Gold Ashanti, and I'd use that data as a proxy. If you're looking at a platinum company, go and have a look at various of the platinum companies. If you're looking at, say, a precious metals company, you could look at something like Sibanye-Stillwater. Now, obviously, I mean, again, you might want to have a look at something that's more appropriate in a country. Then you just have to look for something that's listed that you can use as a proxy, because you won't get this data for unlisted companies. So you always have to use a proxy, a listed company proxy, if you are evaluating or valuing an unlisted company or a project in an unlisted company. And if you're looking at a project within a company, you basically do what I've done here. I've taken the data for that company. Okay, and then once you've got all the data, I mean, basically then the calculation is relatively simple. Your cost of equity, your risk-free rate, your beta, your market premium. And then what we have done here, added in our technical risk premium to get our cost of equity. Then we get our cost of debt. So basically it's your cost of debt, your tax rate, and then you get your after-tax cost of debt. And then simple calculation to get your debt to equity ratio. You get your nominal WACC, discount by your inflation rate, and there's your real WACC. So fairly simple once you've actually got all the information that you need. Okay, now just in terms of this, so this is what I was talking about in terms of when we are actually looking at our cash flows. So effectively, you've got your free cash flow to equity, which means those are your equity shareholders, and then you've got your free cash flow to the firm. So in terms of your free cash flow to equity, you've got your cash flow available that basically goes to your shareholders, and it's generally your common shareholders, so not your preferred shareholders, because that's normally considered debt. And when you're actually looking at just your shareholders, so your free cash flow to your equity shareholders, you would actually then discount basically by your return on equity. So there you're not looking at WACC with debt and equity. You're only looking at your equity shareholders. So you use your return on equity to actually get your discount rate. When you're looking at your free cash flow to the firm, you've got cash flow that's available to your debt holders, your preferred shareholders, and your common shareholders. So this is actually where your WACC is actually the appropriate discount rate to use. So just to give you an example, so when we're looking at our free cash flow to equity, we're basically looking at your revenue minus your cost, which gives you your profit, minus your capital. So that's all basically the same up until that point for your firm and for your equity shareholders. But what's left for your equity shareholders is effectively anything that's after any loan repayments and after interest repayments and the tax payable on that. So that profit after tax already, that cash flow includes your debt. So what is left over is your return to your shareholders. So basically, you only use your equity portion of your WACC calculation. You do not include the debt component. So normally, your discount rate will be higher because you're using your equity discount rate, your equity portion of the WACC. Your free cash flow to the firm is effectively your free cash flow. And this is normally what we refer to as a sort of 100% equity finance model, which is generally what we do, except if we're doing project financing. So basically, you'll have your revenue, your cost, your profit, minus your capital and your tax, and you get your profit after tax. And that's available to, that money is available to all your shareholders and any loans that you would pay back. So it's a different way of looking at your cash flows. But if your debt is included in your cash flow, you cannot use your WACC as a debt and equity component. You only use your equity component. And I can't stress that enough. So often when you're doing, you'll do those cash flows, and often when you're looking at sort of project financing, when your debt is included, then your discount rate has to be higher because it's the equity component of your discount rate. So just to quickly have a look at that. So your free cash flow to equity. So this is basically your discount rate. It's your capital asset pricing model portion of your WACC. So it's your cost of equity. Whereas when you're looking at your free cash flow to the firm, you're actually looking at your WACC. So, and you can see also what we've actually had a look at here. As your debt increases, actually, you will find that your discount rate will actually decrease. But there will always be a limit on the amount of money that you can loan. I mean, generally, you're never going to be able to loan 100%, not for a mining project anyway, well, normally. But as your debt increases, your discount rate will decrease because you get the benefit of the tax deduction. Okay. Right, so just having a look at it at a model to just try and actually see the difference between your different cash flows. So here's a 10-year life of mine model, and then there's a 25-year life of mine model that we'll look at. Damn it, where am I? There we go. Sorry. So assume 120 million in capex. It's paid over. That's a 2-year capital expenditure program. Your debt to equity of 50-50. You start production in year 3. And in terms of your loan, you will take out a 60 million rand loan for 10 years. So you can see the two different cash flows here. So you've got your free cash flow to equity, which is effectively your the black bars and the black line, and that's your discounted cash flow. And then you've got your free cash flow to the firm. So that is the cash flows that don't include any debt or interest payments. And you can see that those cash flows are slightly higher because they basically actually don't include the debt and they don't include the interest payments. And the capital repayments, and also your discount rate is lower, so your discounted cash flow is actually higher. So again, just to reiterate, in your free cash flow to equity, you include in your cash flows your principal and interest payments. Therefore, you use your cost of equity as your discount rate. In your free cash flow to the firm, your principal and interest payments are not included, so you use the WACC. So effectively, by using the WACC, what you are doing is it's an implied level of debt to equity that you are actually using in your discount rate. And it's implied in terms of normally, so you will have worked that based on a company. And basically you're assuming that your fundamentals aren't changing and that your project is the same risk, and it's not fundamentally going to change your capital structure in your firm. So if your project is potentially going to change the capital structure in the firm, then basically you need to take that into account and adjust your weighted average cost of capital to take that into account. Okay, and then just to actually show you the difference here. So if you've got a longer time period, so I've used the same assumptions here that we used before. So you've got a 10-year repayment period on your loan. But as you can see, once you've actually got to your year 10, effectively your cash flows then are exactly the same, because now you've paid back the loan and your cash flows for the same project are the same. But they would have been different to start off with, because your free cash flow to equity would include your loans, and your free cash flow to the firm don't include your loans. But you still get the benefit in terms of your free cash flow and on the basis of your WACC in terms of your returns. Okay, so just in conclusion, I don't know, I think I've maybe whizzed through this a bit quickly, but anyway, but maybe there's time for questions. So I think it's quite important as a competent valuator that you understand the implications of the structure of your model. If you are including your debt and your principal and your interest payments in your model, you need to use your cost of equity. If you're not including that, if you're doing a 100% equity finance model, as we call it, you're looking at your total firm, and then you would actually use your WACC, and you assume then your debt in your discount rate in the ratio of your debt to equity. Again, look at your discount rates. If the project that you're evaluating is say it's a big project relative to the size of the firm, and it has the potential to change the company's capital structure, then you need to actually adjust your WACC to incorporate those weightings or that potential change in the capital structure. Then also the other thing, as we said, I mean, in the calculation that we did for WACC, consider your risks that are outside of your normal WACC, and adjust for issues such as country and or technical risk. So if you're looking at things like new technology, complex metallurgy, a greenfield project versus an expansion or an extension project, those all could have an impact on your risk. And that you need to incorporate into your discount rate as well. But what you can actually do, and I think one of the things I always would suggest, is that you provide a range of NPVs based on a range of discount rates, much like your other sensitivities. But again, I think also apply your mind to where you would actually want to do that, and what are the range of discount rates that you would actually use relative to what you're actually valuing. So, I mean, yes, it's easy just to do a range from like 5 to 15%, but does it make sense to do that range? So again, when you're doing this, apply your knowledge and say, well, this range is a likely range because of this or because of that, etc., etc. So make sure that your range is based on some kind of assessment of why you would use that range. Don't just somehow put in any old range. And then in terms of guidance, there, if you go to the SAMCODE website, there are guidance notes. And in fact, there is a guidance note around this whole free cash flow to equity and free cash flow to the firm. So go onto the SAMCODE website. That's not the only other guidelines that are there. There are quite a few guidelines. So my suggestion is do actually make use of all of those guidelines, because there is useful information there.
Okay, thanks a lot, Tanya. Good morning to everybody online. As Tanya said, that I'm a marine geologist from background, but as being trained by Shell, I was trained both in geology and geophysics. And then also you come into management, you get all management trainings, where I was very much involved in reporting on hydrocarbon quantities and value of them. So this presentation is going about reporting codes and the upstream oil and gas. The course outline of the training discussion outline is describe description of the oil and gas industry and the players. Not a lot of you will know how that is set up and works together. Then you're going to talk about the stakeholders in the oil and gas, sharing information, reporting, and then resource management in general. And then really the crux of it is the petroleum resource management systems and how that all feeds into the security exchange and the SAMREC code. The oil and gas industry in general. And by the way, if you have got questions, I can't see the screen, Tanya, but if you see a thumbs up or questions, you can interrupt me. I don't mind that, because I would hate to lose people on the track going through my presentation.
Will do.
Okay. The global oil and gas value chain. So in essence, in the oil and gas, I think it's like in mining and other places as well. We talk about upstream, midstream, and downstream. Now, the upstream is really hydrocarbon exploration and appraisal. Then you have to develop the field, and then you have to extract it, the production of the oil and gas. The midstream is really hydrocarbons are processed, stored, and transported, and the downstream is really where you make other manufactures and you sell it to the last. And the last two, midstream and downstream, have got quite a big overlap quite often. But we will be only focused at the moment on the upstream oil and gas, as you can see here. So in the upstream companies, they conduct activities relating to the search for, developing, and producing of hydrocarbons. I think it's like in mining, where in the beginning you don't know what is where, and you have to really start exploring to prove something is there. Once you've proven it, it is of course not immediately commercial. You have to see how to make it commercial. And that is then the appraisal, which I have not put here. But once you have determined it to be commercial, you develop it. And then you start producing it. And the last thing, of course, missing here is the abandonment, where you have to put it back into the original state. It is all about drilling wells, building infrastructure, and produce. And after that, of course, abandonment and putting it back into the original state. Where to locate the wells, how to design, construct, and operate and manage them, and then deliver the greatest possible return on your investments to your company or to the owners of the fields. Oil and gas resources are the most important economic assets of an oil company. Without the resources, and I will discuss later what the difference is between resources and reserves. But without the resources, the company has got nothing on the books. The financial strength depends on the amount and quality of the resources you've got. Yeah, and the resources are a source of your future cash inflows and provide a basis for your borrowing. Reserve-based lending is one of the big financial methods in the oil and gas industry. You have got reserves, and then the banks or investors are willing to pay you for your reserves to lend you money to develop them. The problem with the oil and gas industry, it's very capital intensive, contrary to the mining industry, which is also quite capital intensive. But here we talk about some 10 times, 20 times, 100 times more money you need. For example, an exploration well offshore South Africa will cost you between the $50 and the $100 million just for an exploration well. It requires long-term commitments. Once you make a discovery, it can take 5 to 10 years before you get your return on investment because of all the infrastructure to be built. Technologically, it's very demanding. It has high commercial and technical risks, but if you are successful, a high return on investment. The average exploration well has got a probability of success of 20%. That means 1 in 5 wells is successful, 4 wells are failures. And with each well costing you between $50 and $100 million, that's a lot of investment you have to do before you get a success. It has a high uncertainty in asset resources and quantity and value. You never know exactly what's in the underground. You make estimates, and we will talk about that. It requires a lot of specialist employees, both technological and project management. It's highly regulated, and it's impacted by global politics, as you've all seen with the war in Ukraine, how the oil prices shot up. Yeah, just to give you an indication, yeah, this is a very old slide, but in 2015, the oil market is bigger than all raw materials combined. The oil market was $1,720 billion. And you see there in the minerals how much each of them are: 170 billion, 91 billion. The oil and gas market in 2015 was really much, much bigger than any of the metals and the mineral sources. Okay, the industry players and the profiles. In essence, we talk about super major oil companies, and most of you know all the names: ExxonMobil, Shell, Chevron, BP, Total. Total and Shell are at the moment exploring and working in South Africa. The other 3 are not. Then you've got major international oil companies, you've got medium-sized independents, you've got small-sized independents, and you've got national oil companies, such as PetroSA, for example. And then you've got oil service companies, engineering consulting firms like myself, of independent consultants like myself. Yeah, the petroleum industry in South Africa is regulated still by the MPRDA 2002. And as we all know, we have been waiting for the last couple of years for an update on this MPRDA. The current MPRDA has got minerals and petroleum in the same act, and has complete 2 different animals and should be separated, which is the plan in the new act. And we hope that happens, because once that is promulgated, I'm sure that more companies will start investing in South Africa again. You know about the concessions, but in the oil and gas, you've got a reconnaissance permit, a technical cooperation permit, exploration right, and then a production right. And you can apply for all of them. These are the onshore and offshore permits and rights covering conventional and unconventional petroleum resources. I will explain later what that means. The MPRDA makes provision for BEE and participation in the development projects, development and production projects. So here you see a map of all the oil and gas rights in South Africa. It's a little bit of an old map. Petroleum Agency of South Africa updates this map, I think, 3-4 times a year. And you can see here that there are some IOCs, Shell and Total, are still busy in South Africa. The NOCs, Qatar Petroleum, is a partner with Shell and Total on the South Coast. And then you've got PetroSA, of course, as more an SOC in South Africa. A mid-sized company, Sasol, and then many small-sized companies, Sunbird, Africa Energy Corporation, Eco Atlantic. And then you've got some startup companies and BEE companies, Sungu Sungu, Tesingin, Rhino Oil, and Imbogodo. And of course, like everywhere in the world, you've got the big service companies, Schlumberger, Baker, and all the other big companies. So you can see it's still quite impressive how much acreage has been awarded in South Africa to the oil and gas industry. The business is all about sustainable reserve development and profits, of course. You need to make profit, else nobody will invest in it. So you identify hydrocarbon potential, secure funding for commercial and sustainable exploration, appraisal, development, production, and abandonment. Why do we evaluate and classify the resources? In essence, you evaluate all the resources to communicate. Yeah. Without having identified what you've got there, it's very hard to communicate in order to get finances or in order to get the government providing you licenses and areas to explore or to produce. So potential available quantities of oil and gas you've got, resource chance of recovery, There's always a chance you won't recover anything. There are people making discoveries, but they will not recover anything from it for various reasons. The uncertainty in what you have found, that is what we call categories. And then the timing of when you think the reserves will be available. And then, of course, the commercial viability. You also evaluate and classify resources to make the technical, economic, and financial political decisions which are required to obtain and manage continuous supply of hydrocarbons. Especially for countries like South Africa, you can see, for example, with electricity, how important it is to keep the supply coming, to keep the plants operating. It's the same for the hydrocarbons. It's a very nice example, bad example, but it's Petro SA on the South Coast. They were generating oil of gas to oil, so gas to liquids. They produced gas on the South Coast and they made barrels of oil in the plant. They never explored further in the area. And then the fields run out of gas. And now the plant had to close down in 2000 because there was not, 2010, because there was not enough, 2020, I'm doing wrong, 2020, because there was not enough gas left in the fields. And they're now trying to explore, and when they find new gas, they can open the refinery again. So it's all about communication. What types of hydrocarbons do we evaluate? Now, the conventional, that is just American Petroleum Institute oil types. That can be heavy oil, light oil, bitumen, and natural gas and LNGs. That's what we call conventional. But then there's also unconventional oil and gas, and that is low mobility and very poor permeability oil and gas fields. Bitumen, coal bed methane, Caronius shales, underground coal gasification, and methane hydrates. That's what we find offshore. So you see there's quite a lot of different hydrocarbons we evaluate. On top of the hydrocarbons, we now in South Africa also evaluate helium. Helium is a byproduct of some of the methane gas, but helium is a very high-priced gas, and it comes out with methane sometimes. And in certain fields, the helium content can be 10 to 20%, which is very high, and that's much more economic, much more commercial than the gas is. So we use also the SAMREC code for evaluating the helium content and the value of helium. So who are the users of all these reports? Oh, I went the wrong way. The stakeholders in the industry. If you see here, you've got E&P companies, of course, the IOCs, NOCs, small companies. Then, of course, you've got the governments, who regulate the resources and who need to work on the resource management. How much oil and gas do we still have in the country? How much more exploration should we encourage? Should we lower our standards or our take in all the oil and gas to encourage more exploration? Or can we increase our stakes? Then we discourage exploration, but the potential is so high, companies will come anyway. The financial sector, of course, security regulators, standards committees, investors, banks. The contractors, service companies, suppliers, consultants like myself. Customers in the mid and downstream, they want to know, does our business still have got a lifeline? Is there enough coming in for us to continue our business? Research institutions like the Council of Geoscience for skill development and technology. NGOs who look after whether we really stick to what we promise to do. And of course, in general, the public. So use of the resource report is for corporate business processes. Yeah, the corporates want to know, do I have to invest in South Africa or shall I invest in Namibia? For example, Total and Shell both have made huge discoveries in Namibia. And of course, even the big multinationals, they only have got limited resources and they have to see, where should we put our money? Should we put our money in appraising in South Africa, the small discoveries we've made? Or should we put our money in Namibia, where we've made world-class discoveries? And at the moment, you see that they are still exploring a little bit in South Africa, but most of their funds, the Africa budget, goes to Namibia, because these fields have been really big. The Total discovery seems to be the biggest gas discovery ever in deep water Africa, in deep water in the world. But it has got a huge potential. Resource management functions, for the government as well as for independent international observers and financial institutions. They want to know where do we have resources available for the world. That is for plan and administrator of the optimal use for government-owned national resources or for world resources. Energy studies identify and make decisions on future resource activities. Yeah, how much effort should we put in America compared to Australia? And of course, financial reporting, and that's why we've got this training here. Yeah, how to raise funds, and can we raise funds with the resources we've got? What do all these reports have in common? Yeah, they deal with quantity of hydrocarbons, they deal with uncertainty of these quantities of hydrocarbons, and they deal with the probability of recovering these hydrocarbons. So you see here, first of all, is how much do we have? Do we think we have? But we can't give one number. There's an uncertainty. There's a minimum and there's a maximum. We can never say we've got 100 million barrels. We want to say there's a 10% chance to get less than 200. There's a 10% chance to get more than 200 million barrels, or there's a 90% chance to get more than 50 million barrels. The average is 100 million barrels. Yeah, that is what we call the uncertainty. But then the probability is, if you have not drilled yet, you're not sure that the hydrocarbons are there. You've only got your uncertainty range from all your work. But you've got a probability that you are successful. And then it can be technically successful, just finding hydrocarbons. But then, of course, there's another thing. It also has to be commercial successful. Now, if I find 10 million barrels, it's not commercial. So I've got a probability of success to find 10 million, which might be, say, 25%. But then I've got a probability of success to find commercial hydrocarbons that's more than 50 million barrels. That can be 15%. So there's a big variation in that. Yeah, these form part of the quantity and volume reporting of hydrocarbon assessments. All this on top there is the quantity or volume reporting. That's another type of reporting where you look at, you deal with the cost of developing and producing the hydrocarbons. You deal with the expected price you can get for them. You deal with the net present value and the cash flow. This reporting we call value reporting. So in the oil and gas, we've got two different types of reports. One is the quantity volume, and the other one is the value reporting. Yeah. Although closely linked, these two reports are quite different. Yeah. So resource quantity reporting follows something we call the PRMS, the Petroleum Resource Management System. In the world, there are more systems. You've got the Canadian Oil and Gas Evaluation Handbook. You've got Chinese systems. You've got Russian systems. You've got United Nations systems. You've got all different other systems. But we in South Africa follow the PRMS, the Petroleum Resource Management System. Yeah. And in this system, you classify, subdivide really the resource, but the reserves in reserves, the resources into reserves, that's proven, contingent resources and prospective resources, as you see on the right-hand side. Reserves, contingent resources, prospective resources. And I will go a little bit more into that. Yeah, you categorize them in uncertainty in each class. So the classes are the reserves, contingent resources, prospective resources, and the uncertainty is really the probability how much you will find. The uncertainty how much you will find. So resource value reporting, that follows the SAMREC code or the Canadian NI 51101, but we're not following that anymore. In South Africa, we follow the SAMREC code. Or there are American codes, the SX and the SK. There are other codes around the world, the CIM and the SPE, INVAL, reserves as input for the valuation assessment for net future net revenue. So there you need the reserve assessment as input to the value assessment. Value of resources may be reported, but the risk and uncertainty related to these have to be expressed very explicitly. You have to take timing of production and market assumptions into account. So valuation versus evaluation. The valuation is really the estimate of the value of mineral property in money or monetary equivalent. In America, they use the word appraisal for that. The basis for value is market value, fair value, investment value. Evaluation is much broader. It takes physical, legal, economic, and other assessments of the mineral property into account. And it's meant for investment decisions. Evaluation includes feasibility studies, pre-feasibility studies, scoping studies, and strategic assessments. Yeah. Both of these valuation and evaluation make use of quantity reporting, and both makes use of value reporting. So now we're going to go to resource management in general. Yeah, petroleum resource assessments. What is it all about? It's all about predicting the future supply of your oil and gas. Yeah, the quantity of usable resources is not fixed, but changes with progress in science, technology, exploration, and with a shift economic conditions. That was already said by Mr. Kelvy in 1970. And that is incredibly true. You see certain fields being discovered. And in the North Sea, there's a beautiful example of the Brent field. The Brent field over the years have been closed and opened, I think, 3 times. So they discovered Brent, that was producing. Then they couldn't get economic oil out of it anymore. Then they closed the field. Then technology helped them to open the field again and get again more oil out. Then they decided that the oil was not going to be economic anymore. They closed the field for oil. They opened it to produce gas. Then the UK government became very angry because once you produce gas, you can't produce the remaining oil. So they closed the field again. And then with new technology, they got the last little bit of oil out before they transformed it to a gas field again. And you could see that in the beginning, they thought they could only produce 40% of the discovered oil. And in the end, I think they produced 75% of 80% of the discovered oil, pure to technology improvements and other ways of producing than previously was possible in time. Do we need a single international standard for petroleum resource assessment? Preferably, yes, one single one. But each government wants to have their own way of looking at it. Not each, but a lot of governments, especially the Russians and the Chinese. They don't want to have the Western systems. So it is still an idea from the United Nations to get one system in place, not only for oil and gas, but for all resources in the world, mineral, water, wind. They are developing a system at the moment to get there, but I don't see it being operational soon. But I would say that about 80% of the world uses the PRMS. Yeah. The PRMS, the Kelvy box from 1972 is a very basic system of the PRMS. And you can see in the Kelvy box, it's very easy. You've got identified resources on the one side, on the left side. You've got undiscovered resources on the right-hand side. And he just said on the identified resources, you either got demonstrated or inferred resources. And then if it's demonstrated and if it's sub-economic, he called it demonstrated sub-economic resources. If it was demonstrated and economic, he called it reserves. And then if it was inferred, you had inferred reserves and inferred sub-economic resources. So it was a very simple graph. And he really used there a degree of uncertainty and a degree of profitability. So now to come to the system we use nowadays, it's the petroleum resource management system. And the petroleum resource management system, it's a project-based system. So you can only move from one block to another block if you've got an approved project. The classification is based on the project chance of commerciality. The categorization is based on the uncertainty in recovery. The base case uses the best estimate of quantities recoverable under evaluators' forecast of future conditions. Provides a granularity for project management, because in there you can see in a project how you take the different steps. But estimates are based on deterministic and or probabilistic methods. So in the oil and gas industry, we have moved from deterministic to probabilistic assessments, which is quite a nice way of going there. But in some areas, we still use deterministic methods. That applies to both conventional and unconventional resources, and in our case in South Africa to helium. Reserves and resources are estimated in terms of sales products, the final sales products we get. And net resources are allocated based on contractual entitlements. So in this country, like for example, if Shell has got a field, and if it's producing it, the government gets 20% state participation. So the resources for Shell are the field minus the 20% state participation, because contractually Shell is only entitled to 80% of it. And that's an example of this contractual entitlement. Reporting under PRMS. Under PRMS, the reported hydrocarbons and reserves and resources quantities and their uncertainty within the business entity conducting the evaluation. So you report on the whole. Yeah, should not be construed as replacing the guidelines of the government. In South Africa, luckily, the government also follows PRMS, but in other governments, they don't do it. Regulatory agencies and other government agencies might use other systems to report on volumes. But in South Africa, the Petroleum Agency of South Africa also uses the PRMS on reporting oil and gas. There was talk that the Petroleum Agency would move to the United Nations system, but they have seen that the United Nations system is not as fulfilling as the PRMS at the moment. It's not as comprehensive as the PRMS. So therefore, they're still stuck to the PRMS system. Okay, we're going to talk about the PRMS system. The total petroleum initial in place. So whether we are estimating before or whether we have made already a discovery, the geologist, the geoscientist, together with the reservoir engineer, has to estimate how much petroleum is in the subsurface altogether. And that's what we call the petroleum initial in place. Once we have identified how much petroleum is there, we look from which part of it is discovered petroleum in place and which part of it is undiscovered in place. So sometimes you find, if you have got no fields at all yet and you have done no exploration, all your petroleum initially in place you think is there is all undiscovered. But like in South Africa, you might have some fields and there will be discovered petroleum in place and there will be undiscovered petroleum in place. Then in the discovered petroleum in place, you've got either commercial or uncommercial petroleum in place. And the commercial and the uncommercial petroleum in place, I will discuss later what it means. When it's not commercial, what it means. So from there, you've already got petroleum you've produced. From the initial petroleum in place, you have already a certain amount produced, and we record that as well. Then you've got reserves, and reserves are the amount of hydrocarbons you can get out of the ground on a commercial basis. Then you've got resources, and resources are the not yet commercial discovered petroleum and the undiscovered petroleum, that all called resources. So very clear to remember, and you will see in a lot of articles online and a lot of reports that people mix up the words. They talk about reserves. And one very nice example is the Ibobesi field on the west coast. Just this morning, I got a phone call from an investor, and he asked me if it was true that the reserves of the Ibobesi field were a certain amount of million standard cubic feet of gas, a billion standard cubic feet of gas. And I had to disappoint him and say, sorry, the Ibobesi field has got no reserves because it has not yet been demonstrated that it is commercial. So yes, there's a lot of resources there, but until the moment they demonstrate that it is commercial, you cannot call them reserves. And all these third parties start talking about reserves while there are no reserves yet. And then in the resources, you can subdivide them into contingent resources and prospective resources. And you see underneath the contingent resources and prospective resources, you see unrecoverable, because you cannot get everything out of the initial in field. Yeah. So now by talking to you, I've given this presentation hundreds of times, and I've never seen it, but I should have put under produced also unrecoverable, because it's still unrecoverable, still in the field. Yeah, and under reserves unrecoverable. But there is a big part which is not recoverable, and you can't call them, for that reason, it's probably not there. For that reason, you can't call them reserves of produce, because it's unrecoverable. Yeah, and then you've got contingent resources. They are proved, you have drilled it already. So the Iwo Basin field is contingent resources. It's contingent on being commercial. And the undiscovered resources are the prospective resources, because you still have to drill it and prove that they are there. Yeah. Then you've got subdivisions completely. So in the reserves, you can have reserves which are on production. So you've got wells there which are producing, but it is not out of the ground yet. So the moment it comes out of the ground, these volumes move from on production to produced. Then under reserves, you can have approved for development. That means you've got a complete approval field development plan in place, and it's ready to be developed. And you've got all the money available to develop it. Then you can call them reserves. Then there is one called justified for development. That means you haven't got all the approvals yet, but all the other things show it's justified for development. You've got the gas sales agreement in place, but you haven't got the funding yet. Then it is justified for development. It should never be more than 3 to 5 years in justified for development. If it's longer than that in justified for development, it falls back to contingent resources, which is development pending or development on hold. Yeah, of course, they're depending on getting your finances. They're depending on getting a gas sales agreement. They're depending on government approvals. Therefore, they're contingent on these approvals. Development unclarified means that you are not sure yet that you can develop it. You need new technology, or development not viable. That means it is there, but it's impossible to make it commercial, but you have identified they're there. If we go to prospective resources, you've got, of course, the first thing we call is a play. We think somewhere in a play there must be something there. We haven't identified the place where to drill yet, but we think it's there. Once we have identified a kind of accumulation, we call it a lead. And once we have got the lead, and we've done much more work on it to de-risk it, we call it de-risking, we call it a prospect. Yeah, so that is really the classification. Now you see their classification. Now we're going to come. So in principle, what you can see here is that it's a decrease in commercial uncertainty from bottom to top. And it's increasing project maturity from bottom to top. Every time you need another project to move up, to move up, to move up a level. Yeah, that's why it's project-based. Now we're going to talk about the triggers, how you come from. So from the prospective resources, if you make a discovery, it becomes contingent. Then once it's contingent, if the recoverable is commercial, if you've got a development plan in place, then they become reserves. Once you produce it, they become produced. Here you see the thing that you explore, you appraise, evaluate, you design, construct, and install platforms, and then you operate. Now we're going to come to the categorization from left to right in this table. Yeah, for reserves, you've got proven reserves. That's called P1. Yeah, and then that's the amount there. And then you've got the low reserves. That is then an amount that's called the 1P reserves. In this case, the 1P and the proven is the same. Then you've got probable reserves, which is P2. That's only what's in that box there. But then the best estimate of the total is the P1 plus P2. So the 2P is P1 plus P2. Then you got the possible reserve. This is the high, that's P1 plus P2 plus P3. Generally, we say it's a 90% chance to get the proven reserves. Yeah, you're for 90% sure that you will produce that amount. You are for 50% sure that you'll get the best reserve. And you are for 10% sure you will get the high. So there's a 10% chance you get high or more. There's a 90% chance you get low or more. A 50% chance you get best or more. And there's a 10% chance you get high or more values. In the contingent resources, similar way, got C1, C2, C3. which can go in the value of 1C, 2C, 3C. And again, the 1C is C1, the 2C is C1 plus C2, the 3C is C1, C2, C3. And the same in the perspective, but then you call it P90, P50, P10, 1U, 2U, 3U. Yeah, and we saw this already. So now you see the classification is the vertical stacking, that is the maturity of the project, and the categorization is the horizontal axis, which is the uncertainty of how much you're going to get out of the ground. So economic versus commercial. You already said that it's a very difficult definition. A lot of people get confused about it. But economic is that your project must have a positive NPV at a selected hurdle discount rate. Yeah, a project is considered to be economic if its best estimate case has a positive net present value under the organization's standard discount rate, or if at least it has a positive discounted cash flow. Yeah, so you need a positive undiscounted cash flow according to PRMS, or you are, as a company, you're allowed to say, I'm not taking the undiscounted. As a company, I want to have my organization's standard discount rate. But for the PRMS in general, you are allowed to take a zero discount rate if you want to. However, commercial means economic and no contingencies on the project anymore. So now the question is, what type of contingencies can be there? Yeah, so the main difference between commercial and economic is that contingencies. Yeah, reserves must be commercial. Resources can still have contingencies. So example of contingencies. There's technology under development. So you've got the things there, and you can produce it all, but the technology is not yet there, but you expect it to be there very soon. So you expect it to be very soon out of that contingency to go to reserves. Then economic, economic, not meeting the ranking criteria, no project approved to mature. Sub-economic, requires price or production increase or cost reduction. Determined, undetermined, economic status to be clarified. One of the sub-economic examples is, for example, the Ibobisi gas field. Once there would be a pipeline in place, the Ibobisi gas field becomes suddenly economic. Once there's a market there, once, for example, the Eskom power plant there is not burning oil, but is converted to burn gas, then suddenly there's a market. And then if the market is there, suddenly Ibobisi will become economic. And then it will be commercial because you've got a market. And there are non-technical contingencies like legal, regulatory approvals, access to market or political, social licenses. Yeah, if you haven't got an environmental approval yet, it's contingent on getting an environmental approval. Just an example of that contingency. I hope I was clear there. Tanya, I think this is, again, quite a lot. Are there any questions on it? Because this is quite important to understand.
Are there any questions so far?
And I think it's a little bit different than you do in the mining industry.
Yes, it is. And I think people are trying to focus in their minds what the major differences are.
Yeah, it is not easy. And as I said, Tanya, I can send you this again, and you can distribute it if you want to, that they can read over it.
Thank you. Yes, that would be great if you can send me a PDF, and we'll do that.
Okay.
But there are no questions, there are no hands, so you can proceed.
Okay, then let's go to the oil industry and the security exchanges. So in petroleum industry and the security, the IOCs are often listed in their own country of origin, and sometimes listing in a second country if it is required. And they can even move from one to the other. The biggest example is Shell International. Shell International was mainly listed in Amsterdam, London, and New York. And they had the head offices in the Netherlands. That's why they were listed in the Netherlands as well. And they have moved now the head offices to London for various reasons. And they're still listed in Amsterdam, London, and New York, but it wouldn't surprise me if somewhere in the future they would delist in Amsterdam, because there's no need for them to list in Amsterdam anymore since the head office has moved to London. But at the moment, they're still listed there. SAMVAL, which is then not as small, but SAMVAL is also listed in Johannesburg Stock Exchange and in New York Stock Exchange. So they're also listed in 2 exchanges. NOCs are rarely listed on exchanges. The only one I know about is the Norwegian NOC, the old Statoil. They were listed because they were an NOC, but they were still trying to get some shares out as well to get some investments from private equity. But for the rest, the NOCs are normally not listed. Most mid-sized companies are listed only in the country of origin or in a country where the listing is easiest for them, easiest for them to get funding. Quite a lot of oil companies working in South Africa are listed in Canada because Canada was not too strenuous for listing, and there were a lot of people in Canada who wanted to invest in small companies. Same like most small mid-sized companies are also listed in the London side exchange, not the main exchange, but the side exchange. Small size companies might list if they need investments, but quite a lot of small companies are still privately owned. Like startups and BEEs, they might want to list if they can get if they can raise funds on the exchange. What do we in SAMCODES do? So SAMCODES is for the listed companies and also for the non-listed companies, but mainly for the listed companies. They help to attract finances for the company. So attracting for finances is critical in the industry. Assessing private equity is one of the most better options available. Public reports are, of course, essential for investors to make decisions whether they want to invest in you or not. Now, the SAMREC code was set out in 2015 for the first time. That was really to help the JSE to have minimum standards and requirements for reporting on petroleum reserves and resources and value. And at the moment, we are rewriting the SAMREC 2015 a little bit with some changes which took place in the industry over the last couple of years to update it to the new standards. The SAMCODES Standard Committee oversees all these codes, and they're overseeing us as well. So you must have heard this already today, but the SAMCODES Standard Committee develops, maintains, administers, ensures compliance with and promotes the South African codes. The joint patrons of the FSC are same in the GSSA, and the FSC has a broad representation of professional societies and parastatals. So what is our mandate? Our mandate was set up to look after the SAMREC code and ensure that it is in line with the JSE and international standards and guidelines. This committee is a subcommittee of the FSC. The committee members are both local and international experts who have been involved in the resource and reserve estimation. At this present, we've got one person from the United States in the committee, 2 persons from the UK, and myself. I'm living in South Africa, but as you can hear from my accent, I'm a Dutch international. And for the rest, we've got quite some South Africans involved, but most of us are working in the oil and gas industry. Our UK and US-based people are in independent consulting firms, writing reports for the oil and gas industry. And they advise us how with the update of the SAMCODES as well. Yeah, right here, the committee used to work very close with the Alberta Security Exchange. And we had adapted their NI 51101, which is still the case in the old SAMREC code. But in the new code, we will divert a little bit away from it, because the NI 51101 is too complicated to apply and too strenuous. It scares off some of the investors at the moment because there's too many detailed reporting things required, which are not so required within the PRMS anymore. So we're moving a little bit away from it to make it more acceptable to the international community as well. Since petroleum quantity evaluation by QREs is of the essence in the petroleum industry, misleading bookings and evaluations in the past had devastating consequences for major oil companies. The biggest example there is Shell, some 10 years ago, 15 years ago, who had overbooked their reserves. And they had to write down a lot of reserves to contingent resource. And that a lot of trust in the industry disappeared. And now we're trying to get this back. So we've got now recognized professional organizations who really overlook our QREs, that they are signing off reports in international accepted ways and standards. So the SAMREC code itself is at this moment, 2015 edition, provides a basis for the minimum disclosures. It's always minimum. You can always disclose more if you want to, but it is the minimum disclosure. Yeah, public reports. They are reports which are meant for example, some public reports are company annual reports, quarterly reports, other reports, JSE circulars, company act requirements, environmental statements, information memoranda, website postings, expert reports. Yeah. The code applies to, in essence, any report which goes to the public. It can even be newspaper articles. If the newspaper article said that is reported according to SAMREC code, then it should be according to the SAMREC code. You cannot enforce it. If you are on the JSE listed, you are enforced by the JSE to use the SAMREC code. But if you're not listed, but you report and you say in line with the SAMREC code, then we will review it and see if it is in line with the SAMREC code. Yeah, there are some terminologies here. That is different product types. Yeah, so oil and gas activities is the acquisition of properties. It is the drilling for properties. It's the construction of things. Then it is the production of oil and gas. Not included is any activity which occurs after the first point of sale. So after the first point where you get money for it, that's not included in here. Activities to relating of natural resources other than the product types, and in this case, helium is part of product type. Yeah, and extraction of hydrocarbons as consequence of external geothermal steam. So if you get oil and gas coming out with steam, it's not included yet. We talked about this. I'm a little bit conscious of time. Okay, it has to be materiality. The code only applies to reports with information that is material. So 1 barrel more or less, you're not too interested in, but it has to be material information. You have to be transparent in your reporting. Yeah, under the code, a report has to provide sufficient information in a clear and unambiguous way that may not mislead the reader. So if in your report you talk about reserves, it should be really reserves and not contingent resources. Yeah. Competency. Yeah, the report is based on the work that is the responsibility of a suitable, qualified, and experienced person who is subject to an enforceable professional code of ethics. So in the oil and gas industry, you've got the SPE, Society of Petroleum Engineers. You've got the AAPG, American Association of Petroleum Geologists. You've got a few more organizations which have got a professional code of conduct of ethics, and how they stipulate how you should, not how you should write, but under which code and which ethical responsibility you're writing these things, and you set your signature there. Yeah. Oil and gas reserves and resource evaluation that will be disclosed must be prepared by a qualified reserve evaluator. You can be a reserve evaluator if you're registered as professional in good standing with SACNAF and then these other organizations. You must have a minimum of 10 years practical experience. Yeah. And you must be current and competent in methods. And you must be conversant with the content of the SAMREC code, of course. Estimate of reserves and future net reserves. This goes into too much detail. And I think I want to keep 5 minutes for discussion if it's needed. I'm going to go quickly through this. Okay, Tanya, I think that's it. Of course, I want to keep 5 minutes for some discussions or questions.
Joseph, you have a question. Just yeah.
Yes. Thanks a lot, Peter. Would you please go back to the slide? I think they just want you to talk now about 10 years experience. I think it was slide 43, if not mistaken.
Yeah, have a minimum of 10 years experience, practical experience in oil and gas engineering, geology, or geophysics.
Oh, okay. So this is just general, not necessarily that you have evaluated the results, but a total cumulative of 10 years in the industry.
Yeah, that is true. But then if you see the next bullet point, must be current and competent in methods and practices of reserves and resource evaluation. You see the next the bullet point underneath?
Okay, no, I think, yeah.
Yeah. Now, there is a huge discussion ongoing. I think you asked a very good
No, it's
question.
okay. I was just comparing it to.
Okay, that's a huge discussion, because what I say here and what we say is really geology, geophysics, and engineering in the evaluation. But once we want to go to SAMREC evaluation and valuation, we spoke already about it. How many of our technical people have really got expertise in discounted cash flows and the monetary side of it? Yeah, and yes, we do. When I worked for Shell International, I got specifically trained in also the economic and the commercial side of the evaluation and valuations. But where in the world do you find somebody who's really expert in as well geology, as geophysics, as reservoir engineering, as economics? That is very, very rare. So in most cases, the QRE who signs off on the report has got a team working for him with all these disciplines involved. And he or she must have enough experience in the oil and gas industry, and that's why the 10 years comes in there, to be able to ask critical questions to the specialist about this specific subject. And in the end, he or she signs off on the report. Yeah, and he or she has got the input from the specialist. We cannot have everybody signing off, because you need one person who is accountable for the report, and that should be the QRE. That QRE not necessarily has to be the specialist in geophysics, but he has to acquaint himself enough with geophysics that he can ask a specialist that everything in there is still within acceptable levels. And this is really a difficult thing.
Yeah, Peter, Steve Ruprecht here. I just want to comment. I think that commentary is common to all the codes. The comment we say, the days of a single or two competent persons putting a CPR together, a technical report together, I think are gone. I think investors, should demand that the competent persons are reliant on technical specialists, and even having more competent persons signing off on specific areas of expertise. I think that's something that the code is probably we're starting to adapt, but maybe we have to look at formalizing that a little bit more to ensure that some people feel that they can do everything, and like you say, that's impossible.
Yeah.
I think is a valid comment. The second comment, just food for thought, or I see you guys use 10 years practical experience, where most of us are using 5 years. Maybe from a different perspective, your perspective on whether you think 10 is preferable to 5, or perhaps it's not just 10 years of one year's experience, but the fact that one feels competent. But maybe you could make a comment on why you've chosen why oil and gas has chosen 10, and we tend to use 5. I'm not saying one's right or wrong, but maybe from your perspective, a commentary. Thank you.
Okay, that's a very good question. In essence, the PRMS speaks about 2 types of persons. There's the QRA, that's the quality reserves assessor, and the quality reserves evaluator. You got a QRA and a QRE. And the QRA had 5 years, and the QRE had 10 years. That was progressive thing. But the latest PRMS has even, I think, reduced it again to 5 years. I think 3 and 5 years. And that's why we are also rewriting this for the future. So personally, I think 5 years is not enough in the industry to really know what all the ins and outs can be for a QRE. 5 years is good, but in 5 years you've not seen all the angles. And that's where 10 years comes in. What you said earlier, and that's again a little bit, you spoke about more people signing off. In the oil and gas industry, quite often, your reserve reports are compiled by independent consultants, because if you do it yourself as an oil company, investors always think you yourself might be biased, and they ask for an independent consultant to sign off on your reserves and resources. And you won't do the whole company, all the reserves and resources. Every year you'll pick out a few fields and you accumulate them all together. But once a year you get an external auditor coming in to do it. And the external auditor, the QRE, is just one person. And then they've got a specialist team working there. The names of the specialists are also mentioned in the report. But the companies want one person to sign off, because that's the one person who will be called to court if there's anything wrong, and that's the person who's accountable for it. If he would be called to court, and if he will have to answer on the questions, he can call on his specialists to come there to talk as well. Yeah, and there. But it is, the oil companies want to have one person who they say from, that is the 10-year or whatever years experienced person who should know all the ins and outs, who have seen all the tricks people use to change the reserves and all the things, to understand how the things are hanging together, who understands what the market has done over the years. And I think that's why the 10 years was there originally. That it goes to 5 years is probably because the oil industry has become very dynamic. And a lot of old hands have left the oil industry because of the downturns we've had, and they are the first ones who were retrenched. So it's probably very hard to find a lot of 10 years plus people in the active oil industry at the moment. I hope I answered your question.
Yes, fine. Thank you.
Peter, we have a question in the chat before we get to Cheryl, whose hand is up. There's a question from Woni. Just out of interest, what would be the minimum number of positive wells required to report a prospective resource?
A prospective resource, you don't need any well. A prospective resource, what you normally do is you've got your seismic investigation, you've got your seabed analysis, if you can see oil and gas things on the seabed, and you've got all kinds of other models. And then you've got a model there, and then you get a prospective resources. And then with the prospect, if somebody presents a prospect to management, first of all, what management wants to know is what is the range of volumes you see there. So what is your P90, P50, P10? It can be from very small. If the range is narrow, then of course you mean you're very certain about it, and management will not believe narrow ranges in prospective resources. If the range is very wide, then they will look most of the case at the P50, but they will be aware of the downside. And then next to the range, the very important number is your probability of success. So as a geoscientist in the oil and gas, you have to say, what is the probability if I drill a well here, that the well will find hydrocarbons? The probability of success is that you will come on the curve of your prospective resources. So in essence, what we say is the probability of success is the chance that you find your P90, so your low number. And that is what you sell to management. The moment you've drilled a well and you have found hydrocarbons, they move from prospective resources to contingent resources. And they come to the contingent resources, not yet justified for development or not yet commercial, because you still have to do appraisal and all the other things. And then you will decide from how many extra wells do I need before I can declare commerciality. And the appraisal wells are sometimes kept as producers, sometimes not. I hope I answered your question, Woni.
Thanks, Peter. Cheryl, your hand was up. Do you have an additional question?
Yeah, no. I think my question was similar to the one asked by Wani, if I'm saying that right. So I just wanted to understand, considering that I'm in mining, I was just trying to understand what defines the level of confidence as you shift between the categories within the classification. So I was just trying to figure out, does it have to do with how many wells you drill? Is there a certain spacing over a square area? So how do you just quantify or classify around that?
Okay, it's a very good question, and it's very much depending on your field. So the moment you come to, it is limiting your contingencies. Yeah, so the moment you've got prospective resources, you need to drill one well, which then finds out accounts not to move it up to contingent resources. But in contingent resources, to move them up, a field like Ibobisi needed a lot of wells because we discovered there was very little communication between the different wells, we drilled. So normally in a gas field, you should be able to drain a whole gas field with one production well, because gas should flow easily to this one well and come out of the ground. But when we realized that was not the case, the fields where we had drilled the wells, we could move them up into prospective resources justified for development, because we noticed how much volume was there. It was economic to produce this, but we hadn't put the wells in there. But we knew there were blocks next to it, which were not being drained. Then before they can move up, you need to drill another well in there to see if it is movable at all. So it's very much dependent from field to field. And it can even be that in one field, you got reserves on production, you got resources in contingent justified for production, you got resources in not justified for production yet, but depending on justification, you can have them all in one field. So it depends on your project that you then have for work you have to do to bring it up. It can be one additional well needed, but sometimes in appraisal you need 3 or 4 additional wells. I hope I answered your question.
Yes, you did. Thank you.
Thanks very much, Peter. That was an interesting journey around the oil and gas evaluation. Hopefully it will enthuse a number of our mineral geoscientists to mosey over to the dark side.
Thanks for the dark side.
Great, thank you, Tanya, and thank you for the introduction, and hello to everyone on the call. I see that there are 34 participants at this point in time, so it's a large audience. So I have half an hour with you, and I've got about 11 slides, so it shouldn't be a very long discussion. So as Tanya said in the introduction, I work in the issue regulation division of the JSE. The JSE is a self-regulated organization. And so we have 2 regulatory teams within the JSE who are responsible for regulating both the issuers. We refer to the companies that are listed on the exchange as issuers. And we also then have a market regulation team who is responsible for regulation of those participants in the market, the brokers and the various other participants in the market who are trading on the market. So in our listing requirements, you'll see on the slide in front of you, it refers to section 12 and it talks about mineral companies because of the unique nature of a mineral company or a company involved in mining activities or an oil and gas company. We have a specific section in our requirements that deal with the disclosure relevant to these companies. These disclosures are important for investors because it ultimately, similar to financial information which listed companies publish, it allows for price formation and it allows for an investor to have a full and comprehensive understanding of the activities and the assets of the company, so that they're able to make a decision, able to make informed investment decisions. So the disclosures that we deal with in Section 12 are disclosures that were put in place by the JSE in consultation with the market. So it is disclosures that the JSE as well as market participants believe are relevant to companies involved in the mining sector as well as oil and gas. So we can move to the next slide. The purpose of the presentation is to provide you with a summary of the listing requirements applicable to a competent person's report or a Form A report in the instance of an oil and gas company. I've just defined both of those as a CPR for ease of reference. And I will also take you through the process from a JSE perspective regarding the approval of a CPR. So on the third slide, you will see the content that we will cover, which is when a CPR will be required, what is required to be included in a CPR, the content, the approval process for a CPR, and finally the publication of a CPR. Okay, so moving to slide 4, when is a CPR required? So we talk about information or documents published by a listed company or a company applying for a listing on the JSE. And public documentation includes a circular, includes a pre-listing statement or a prospectus. It includes announcements that are put out by listed companies. Basically, it's information that the public can consume as part of their decision-making and understanding of a company. So when a company applies for a listing, we refer to that as new listings. And if this company is either a mineral company, so we've got this distinction between mineral company and non-mineral company, aside from an oil and gas company. A mineral company is one which is primarily involved in the extraction of minerals. And a non-mineral company is one that is not primarily involved in the extraction of minerals, but has substantial mineral assets or may substantially be involved in the extraction of minerals. We've got a definition for substantial. We say that if your revenues, profits, or assets represent 25% of mineral activities, the company is then classified as a non-mineral company with substantial mineral assets. So there is that distinction between the nature of a company and the activities that a company is involved in. So when a company applies for a listing, they either produce a pre-listing statement or a prospectus, which provides comprehensive information about everything relevant to that company: financial, historic financial information, who the directors are, who their shareholders are. It's really very comprehensive to give you a good idea of who this company is, what they're about, what their prospects are, etc. So as part of that document, pre-listing statement or prospectus, a CPR or a Form A report, if it's oil and gas, will have to be included, because that is the minimum standard of disclosure relevant to the mineral activities of that company. And you'll see we also have this distinction between primary listings and secondary listings. So the JSE has a platform. We have companies that are listed primarily on the JSE, and all of our listing requirements are applicable to them. But we also have companies who are listed elsewhere. For example, they could be listed on the Australian Stock Exchange or the London Stock Exchange. We have a list of acceptable exchanges. And if you are listed on a particular exchange elsewhere, you can apply for a secondary listing on the JSE. And what a secondary listing really means is it's an additional trading venue for that company. The primary trading venue is, as I said, either Australia or London, and ours becomes the secondary trading venue. The distinction between the two is important because For primary listing, all of our requirements are applicable and must be complied with. But for a secondary listing, it's not all of our requirements, it's a select number of requirements, and there's a lot more flexibility as it relates to compliance of the company, because they are required, that company is required to comply with all of the requirements of the exchange where they are primary listed, i.e. Australia, London, wherever their primary listing may be. So for primary listing, you'll see we require the CPR to be prepared in terms of the codes, the SAMREC and SAMVAL code, and the SAMOC code if it's an oil and gas company. And all three of these codes, interestingly, could feature. I don't think we have a company like this at the moment, but when I prepared the slides, I realized we could have a company that has interests in assets which attract compliance with the SAMREC and SAMVAL code, as well as compliance with the SAMOC code. At the moment, majority of our mineral companies listed on the JSE are solid minerals. So we see, and we are more familiar with SAMREC and SAMVAL. I think we've got maybe just one or two companies, but a very limited number of companies who are involved in the oil and gas space. The secondary listings, like I said, there's a lot more flexibility in terms of the requirements. So those companies are already reporting in their primary jurisdiction in terms of a code. And you'll see those two codes. We've got the examples listed there, National Instrument 43101 and the Joint Ore Reserves Committee Code, JORC. As long as the company is complying and reporting in terms of those codes, we accept their CPR prepared in terms of those codes. So on listing and as part of the listing application process, we ensure that the relevant CPR has been prepared, has gone through the process of being reviewed and approved by the Readers Panel, which we will discuss later, and is included in their PLS, pre-listing statement or prospectus for publication. The other instance you'll see is the second bullet point, which is a category 1 acquisition or disposal. So what that talks to is where a company makes an acquisition or a disposal of an asset which represents 30% of their market capitalization. Market capitalization is simply the number of shares in issue multiplied by the share price, which gives you an indication of size of the company. So if the acquisition or disposal represents 30% of that company, it attracts a circular, which must be prepared and provide information on that acquisition or disposal to shareholders for approval by shareholders of that acquisition or disposal. And as part of the information presented to shareholders will be a CPR, so that shareholders have a full understanding of the particular mineral asset that is being acquired or disposed of. The next two bullet points deal with the distinction I described earlier between a mineral company, which is primarily involved in mineral activities, or an oil and gas company primarily involved in oil and gas, versus a non-mineral company or a non-oil and gas company with substantial mineral or oil and gas assets. So it could be that you are a company who's not primarily involved in mineral activities, but you either have an acquisition or disposal, or you have, or you're coming to list and you have those substantial mineral assets. And in that case, those will attract reporting in terms of Section 12, and a CPR will be relevant to be prepared on those assets, which are the mineral assets or oil and gas assets of that company. Okay, we can move to the next slide, Tanya. So I think I've already touched on it. So this slide deals with the content of a CPR, and you'll see the first bullet point talks about the nature of a company. So depending on what the activities of the company are, depending on whether they are involved in solid minerals or oil and gas, that will then attract compliance with the relevant codes. Or it would determine which codes they need to comply with. Once the CPR is prepared, and that CPR has an effective date, it is a date on which that CPR has been compiled and signed off. The CPR will be valid for 6 months after that date. And when I say valid, I mean valid for public consumption. So once the CPR goes through the process of being prepared, approved, and is signed off, it is only valid for publication 6 months thereafter. So as an example, if the CPR effective date is the 1st of January, on the 30th of June, that CPR will expire. In those examples, I explained earlier the pre-listing statement, prospectus, or Category 1 circular. If that CPR is then dated 15th of July, we will not allow the company to publish that CPR. We will request for the CPR to be revised, and the effective date of that CPR must then be within 6 months of the publication date. And that just speaks to relevance of information and making sure that shareholders and investors are getting relevant information for consideration. Regardless of that 6 month period, if material information becomes available before the publication of the prospectus, pre-listing statement, or circular, then an updated CPR will be required. And that again talks to the fact that investors and shareholders are required to be given the most relevant and updated information. The competent person or qualified reserves evaluator, if they are not independent of the issuer, the relationship with the issuer must be disclosed. So we don't say that the CP or QRE must be an independent person. They must obviously, you've noted in the previous discussion some of the qualifications that are relevant to these individuals, and they must obviously behave and perform their work in an objective and professional manner, but they are not required to be independent. Investors will simply need to understand if there are any relationships, and that is why we ask for that disclosure. The CPR itself will then be annotated with the specific clauses of Section 12 of the requirements and the relevant codes. So we're still dealing with content of a CPR on this slide. So paragraph 12.10 of the listing requirements deals with minimum information that must be disclosed in the CPR and in the documents that we've discussed, the PLS, prospectus, or circular. And the CPR must contain everything that we refer to in that specific paragraph of the requirements, as well as confirmation that CPR complies with the SAMREC, SAMVAL, and or SAMOC codes, whichever is the relevant. The CPR must contain evaluation section signed off by the competent evaluator in terms of and in compliance with the SAMVAL code. We know that for SAMOC, the Form A report will include evaluation signed off by the qualified reserves evaluator. So there's no, the qualified reserves evaluator for oil and gas really serves both roles of the technical information as well as the valuation information. The CPR must then also include information dealing with expenditure. And there's 3 categories of expenditure there you'll see, which is exploration expenditure incurred to date, planned exploration expenditure that has been committed but not yet incurred, and planned exploration expenditure that has not yet been committed. So this really is to give shareholders an understanding of what the future expenditures of the company will be, which influence the future capital raising activities that the company may undertake. So on the next slide, we then deal with the CPR approval process. So in our department, in the issue regulation department, we don't have anybody who has the qualifications of a CP. So it's a little bit of an outsourced model, if I can call it that, where a readers panel has been put together, and that readers panel includes the people who have the relevant experience and are able to assess the contents of that CPR in terms of the SAMREC, SAMVAL, SAMOC codes, as well as the listing requirements. So the readers have experience, relevant experience as it relates to the codes, reporting, as well as the JSE listing requirements. The company will appoint their competent person to perform the work and compile the CPR. That CPR is then submitted to the JSE for approval. A company is required to, via their sponsor or designated advisor, notify the JSE in advance of submission of that CPR so that we can notify the readers panel that the CPR is coming, and the chairperson of the readers panel can source the readers. So that notification is required to include details about the asset, what is the type of mineral, so that the chairperson of the readers panel can source the people who have the relevant experience to read that CPR. So you'll see it needs to include the name of the CP, the name of the applicant issuer, the commodity, the date of the submission included. So if we take just, for example, the name of the CP and the name of the issuer, that's obviously there also to make sure that there are no conflicts of interest, that the people who are reading are not the same people who are working for the CP firm, as an example. So that notification, we receive it 5 days before submission. The sponsor must then submit on behalf of the company the CPR before 10 a.m. And 10 days later, the JSE will provide comments on that CPR to the company via its sponsor. So what the JSE does is it takes the documentation, it makes sure the documentation is complete, and it provides that documentation to the chairperson of the readers panel. The readers panel then take the 10 days to review and get back to the JSE with comments. The JSE then have a look at those comments. Like I said, we aren't specialists in the field, so it's very difficult for us to necessarily always make sense of all of the comments, but we make sure that those comments are then relayed to the company, and the company will then respond to those and correct or make amendments to the CPR, whatever needs to be addressed, and send that back to the JSE. And that process will continue with a turnaround of 5 days for each submission until all comments and all matters are resolved, until the readers panel comes back to us and says, we are now comfortable, we have now approved this document. So that is the process of approval, which applies also to the qualified, applies to Form A for oil and gas. Once the CPR is approved, it is then included in the document for publication, included in the prospectus or circular, and on the issuer's website. It can be incorporated by reference, so the company can place it on their website and incorporate it by reference. And as an alternative, they can include an executive summary, and the requirements deal with the basics of an executive summary, which you'll see in front of you. It must include purpose, outline, location, legal aspects, description of the geological setting, exploration program and budget, environmental issues, the mineral resource and reserve statement, the risk paragraph, summary evaluation table. So those are the minimum requirements. Any announcement made by the company must include, as it relates to the CPR, as it relates to the mineral resources and reserves, must include a statement from the competent person and competent valuator that it has been approved by those two parties. Must also disclose the relationship between those two parties and the issuer. So the issuer can't simply go out and put any information they feel is relevant. It must have gone through that filter process of making sure that the competent person is comfortable that that information is accurate and valid. Slide 10 deals with what we need to look out for in a circular or pre-listing statement. The circular or pre-listing statement itself includes information and disclosures in addition to the actual competent person's report. So any statements that are made in the circular or pre-listing statement must not contradict information that is disclosed in the CPR. And that is a confirmation that we get from the company and the competent person. And we talked about the 6-month period earlier. Another type of document which features in the listed space is fairness opinion, which is applicable for related party transactions. And it is an opinion provided by an expert on a related party transaction, confirming whether the transaction is fair or not. For these mineral companies where fairness opinion is applicable, and if part of a fairness opinion is always evaluation, we say that the independent expert, the person putting together the fairness opinion, must qualify as a competent valuer in terms of SAMVAL. Again, a statement that the competent person and competent valuer have approved the information in writing, and again, disclosing the relationship between those parties and the company. So that brings us to the end of the slide pack. I see we have a question from Joseph.
Yes, thanks a lot, sir. I think I've got maybe 2 or 3 questions. The first one deals with slide 7, which talks about the timeframes. And I just wanted maybe a comment to say, are these more or less idealistic timeframes that the Readers Panel has, or these are really adhered to, that if you submit your report in about 21 days, you have feedback or the process would have been approved in a way? I think that's the first question, if you can maybe give a comment about that.
Okay. Thanks for that question, Joseph. So generally, from our experience, it depends on the quality of the submission as to how this timeline runs. So this timeline is a fixed timeline, and it allows, so you'll see from the first submission, from the date of first submission, there's a period of 10 days for which the Readers Panel has to review this. And that is a hard deadline. So come the 10th day, we have got to respond to the company. And there's a reason why we've put this timeline in place, because it provides both the company and ourselves certainty about the turnaround of the document, approval of the document, because the company obviously needs to make sure they've got a timetable with respect to their listing or their transaction, whatever it may be, and that needs to be met. So everyone can plan upfront having this timetable in front of them. So it is a commitment in a way that for each submission, for the first submission, a response will be provided on 10 days, and for each subsequent submission, the response will be provided 5 days later. The Readers Panel can come back to us earlier, depending on the quality of the submission. If the quality of the submission is great, Readers Panel can come back to us before the expiry of 10 days and provide us with comments, in which case we will relay those comments to the company. The other thing that features is if things are not being properly addressed, the submissions may go on to 2nd, 3rd, 4th. And then with each 5-day turnaround, that timetable then extends. So quality is really key in that submission process. So I hope that answers it.
Yeah, certainly it clarifies it. Then the second point is, please forgive probably the ignorance in it. Every CPR report or every CP report, it does come through, or it's only as per request, or every CP report that we have, obviously you have to share that, as you indicated, for public consumption. So every CP report has to come through this process.
Correct. So yes, absolutely, that's correct, because a company cannot prepare a CP report and publish that on their website and not have gone through this process. They would have effectively they would have breached the requirements if they did that.
Okay, thank you.
Yeah. So Joseph, if I could just maybe expand on that a little bit. We've got in our requirements specific instances when a CPR is required. So if you are listing, if you're preparing a circular, those instances that I mentioned, the company is obliged to prepare that CPR. But there may be instances where the company voluntarily decides to prepare the CPR. And voluntary information is information that is still available for public consumption by shareholders and investors. And we as a JSE need to make sure that that voluntary information has gone through the appropriate process of being reviewed by the Readers Panel and being approved by the Readers Panel. That gives assurance to the JSE as well as investors and shareholders that the information is appropriate for investment decision-making purposes. And that is why a company would effectively breach the requirements if they voluntarily put something out without that information having gone through the process.
Okay, thank you.
Before we get to Kevin, there's a quick question in the chat from Seth. Once the JSE has vetted or approved a CPR, what is the time limit for the company to publish a CPR other than 6 months, or is there such a directive?
Thanks for that question, Seth. So there is no directive. A company can publish that CPR as soon as it's approved by the Readers Panel, and as soon as the JSE has informed the company that it is approved by the Readers Panel. That 6-month rule, like I said, it's there just to make sure that stale information is not being provided in the market. So it's just a check to make sure that information older than 6 months is not being published.
Okay. Kevin, short question.
Well, actually, I've got 3, but relating to page 7 and page 4. So with regard to page 7, Zachariah, the majors all produce reserve, mineral and resource reporting every year, which fairly similar to a CPR type reporting. But how do those go through any review to give the same assurance that you said investors have? Yes, thanks, Kevin. The approach with respect to, we deem those as annual reporting. So the company generally, together with their annual reporting of financial information, present those resource and reserve statement. The approach we take there is a bit different. It's not, the information is not approved up front. The company takes responsibility for the information that is published. The JSE, on a sample basis, select reports, resource and reserve reports of companies that have been published, review those, and by the way, that's reviewed by the Readers Panel as well. And if there are any deficiencies or weaknesses that are found, the company will have to correct that either in the next reporting period, or if it is something more urgent or serious, they will have to correct it before the next reporting period. Thanks. That then leads very nicely, and I did not intend to trap you, into my next question. The financial statement side of annual reporting of the mineral companies is also reviewed on an annual basis, and the financial reporting review process results in a proactive monitoring annual report, which is great if you're a financial reporter because it gives you some insight where you might have been uncertain, and it can help you improve your reporting. I never see a report of the type of things that the Readers Panel comments might have produced on a non-attributable basis to give guidance to CPs in how to ensure that they do produce at the first time this quality report. Why is that? That's correct, Kevin. That's very accurate. We do have a proactive monitoring report feedback from an IFRS perspective, but we don't for Section 12. There's no specific reason why we don't have that. I think the reality is we have a very small number of mining companies versus all listed companies are required to comply with IFRS. So I suspect, I mean, I don't think there's any particular reason, but I suspect it is a case of saying the communication with the company as it relates to their specifics in terms of the weaknesses and deficiencies is sufficient for that company to correct those matters. And as far as I've been at the JSE for 10 years now, I cannot recall an instance where we have found weaknesses
in a CPR, which are so significant that it was something that needed to be corrected immediately. So from a risk perspective, my sense is that the reason why we don't provide that type of report is because it's dealt with on a company by company basis, and within the portfolio of mining companies as well, there is a limited number that's involved in each of the different mineral classes. So it becomes very fragmented to then report. But I mean, it's something that your question is very interesting. It is something that we could consider. I mean, it would definitely add value, I believe, to the market. But yeah, we just don't do it at the moment.
Yeah, it's the sort of thing I would sort of be questioning, depending on what the solid mineral is and who they all are. Because I've got a solid minerals history, not oil and gas, is the range of pricing that people have used for the respective solid minerals, because that has such an impact on what is a reserve and what is a resource. And sure, the industry might all be talking with each other, but you start getting into the realms then of acting in collusion, which you wouldn't want to open. And it's the sort of thing that there's areas where where you couldn't say these are what we'd want, i.e., a gold price that's within 15% of the 3-year average. You wouldn't want that type of rule, but you would, if someone, gold hit 2000 on Monday, it's now back down to 1930. So if someone's using 1900 and someone else is using 1600 for resources, and they're using 16 and 1400 for reserves, that would be relevant to an investor. And I guess you're investor beware. Do it yourself, because we're not going to give you guidance. Thing that CPs might be interested in, if that's where everybody is, I don't have to start guessing. I know I'm within a reasonable range.
Yes.
But the question, that's just me talking though. The other question I had was on slide 4, where you talk about inward secondary listings. And you specifically said JORC and National Instrument 15 or 13101. What happens if in that foreign jurisdiction where the primary listing is, they actually have a different minerals reporting, i.e. the US one of SK 1300? Would you reject it? Or is it, you only gave those two as an example? And then, and adding on to that, what about actual rules within that foreign jurisdiction? If it's not a well-enforced jurisdiction, is it an easy route to a secondary inward listing?
Yes. So Kevin, those references that I included are references included in the requirements, the section dealing with secondary listed companies, and it's defined up front to say this is what we will accept. And it's very similar to financial reporting. For all primary listings, we use IFRS as the financial reporting framework. But for secondary listings, we allow IFRS for EU, UK GAAP, US GAAP, Australian GAAP, and so forth. But we've defined those two codes, the JORC and National Instrument, as the standards that we will accept. How we deal with it if we get a company who is saying, I am applying for a secondary listing from this other jurisdiction, which accepts a report prepared in terms of a different code, we will then have to consider that code, and we will have to consider whether we are comfortable with that code to be able to accept that listing. So we wouldn't necessarily accept the listing. We may reject the listing, or we may go through this process of considering the code and the various disclosures in that and requirements in that code, and come to a conclusion that we are comfortable with it. So we have a process of, we call it rulings, that a company can make to the JSE to request either a modification or a dispensation from any of the requirements. And that's the process that we would then use to consider this other code that the company is then complying with.
But then you'd need a rule change?
If
it's
we
mandated.
if we have a lot of companies coming from a particular jurisdiction, like say it's a NASDAQ or NYSE listing, and there's lots of mineral companies coming from that side, we would consider a rule change if there are many and it impacts many. But any rule that we have in the requirements, if there is a proper motivation for that rule to be dispensed with, we can consider a dispensation. So obviously the code that we will be considering, other than SAMREC or JORC or national instrument that we refer to in our requirements, we'll have to consider that in conjunction with the Readers Panel to make sure that we are comfortable with that code. But it doesn't automatically result in a rule change.
So what exactly is a CPR? We bandy this term around all over the place. So what is it? Well, it's basically a report on the technical aspects of a project or a mine, which is prepared by a competent person, i.e. competent person's report. And what goes into that competent person's report is very much determined by the nature of the project being reported on. And it can also include a techno-economic model as appropriate for the level of study. All of our competent persons reports are, the contents are defined by SAMREC Table 1, and we are told that we will report on an if not or why not basis. These are documents that are typically compiled for a stock exchange, but that may also be requested by investors. Now, although we're going to be talking specifically in this presentation about the SAMREC CPR, many of the principles are also applicable to a SAMVAL competent valuators report or even a SAMOG compliant QRE report. But we're going to talk specifically about the requirements of a CPR according to SAMREC. The code tells us that a competent person's report has to be compiled and signed off by a competent person. Now, last week, Ken went into quite a bit of detail on who a competent person is. This is just to remind you that a competent person is defined in terms of registration with an acceptable RPO, as well as the relevant experience required by that organization. Right, so the first thing you need to do when you want to write a CPR is become familiar with the code. Make sure that you have read the code, that you know what it requires of you. And it is only the 2016 version of the codes that can be used. Don't go and compile your document according to 2007 or 2009. It's only the 2016 version. If you're doing a diamond project, there are the diamond guidelines that you need to incorporate into this document. Your CPR, it's not a separate chapter, it's not a separate document. And same thing with the ESG. It's got to be incorporated into your document. We'll talk more about that a little bit later. The other things that you can do is to read up in the companion volume and other conference proceedings that you can use as a reference. If you're writing a report on industrial minerals, have a look at PERC because they've got far more guidance related to industrial minerals. And the same thing for emeralds and alluvial gold. Have a look at the Colombian guidelines. The second thing you need to do is to make sure that you're familiar with the JSE listing requirements, or whichever stock exchange you're going to be listing on. make sure that you are familiar with those requirements. If you're listing on the JSE, it's section 12 that Zach has taken us through. If it's any other stock exchange, make sure you know what their requirements are. Okay, just very brief. I'm not going to go over this too much because Zach has gone into it. The JSE listing rules, section 12, are the ones that you need to understand with respect to CPRs as well as for integrated annual reports. And if it's on another exchange in South Africa, note that through our agreement with the Financial Sector Conduct Authority, pretty much all exchanges in South Africa are going to require a SAMCODE compliant documentation for primary listings. So don't think you can get away with it by listing on one of these other exchanges. That's not going to work either. Note here too that there are specific requirements according to individual listing or individual exchanges listing rules. So if you're listing in Canada, if you're listing on the LSE, make sure you know what the exchange requirements are with respect to writing a CPR. These are the exchange requirements that Zach has already gone through with you. So I'm not going to go through them again. You will have these also just for reference. Just to note here that if you are doing a CPR according to the JSE, you need to show which particular section of the code that you have complied with in the margin of your report. Okay, and again, the CPR must include a evaluation section according to SAMVAL. Okay, so there are going to be times when you're not sure how much information to put in and what sort of disclosure is necessary. Remember that we said early on last week as well that the purpose of this report is to inform your investors and potential investors in order to allow them to make a balanced judgment on whether to invest or not. So you want to give them enough information, enough relevant material information to allow them to decide. Don't just dump everything on them. Our report is geared to minimum standards. CPR is not best practice, it's minimum standards. And these two particularly important principles, materiality and transparency, and most speakers have spoken about this in quite a bit of detail. Again, you want to make sure that you give people enough relevant information, and it must be transparent. But don't fall into the trap of just giving them every bit of information that you know about this project and then expect them to wade through hundreds and thousands of pages in order to decide what is relevant. So who decides how much and what is relevant? Well, this is the competent person. And this is very much based on the principle of being able to face your peers. SAMREC doesn't describe or prescribe the amount of information that you need, the detail that you need to go in. But it does give you guidance and the type of information. There's the various guidelines, there's the ESG guidelines, there's the diamond guidelines, there's the SANS 10320 if you're dealing in coal. At all times, your lead competent person is responsible for everything. But obviously that lead competent person needs to be able to rely on various other competent persons, whether they be competent persons per se or technical specialists in their area of expertise. Also, the competent persons report is defined as a standalone document. And so it needs to have in it all of the information that your reader needs to make this decision. It's not a case of making updates so that you write a competent person's report in year 1 and then update that with minimum information for the next 5 years. That is not generally how it is. Each year or each time you do a CPR, it needs to have all the information in it. Obviously, there are going to be exceptional circumstances where updates might be allowed, but you certainly need to get written permission from the exchange to do that. Joseph, you have a question?
Yes, thanks, Tanya. There are 2 questions actually. The first one is traditionally, I've noted CP reports being combined for resources and for reserves, and then it becomes one document. In this case, when we mention that it's a standalone document, are these supposed to be separate or that it really is not relevant for that?
No, a competent person's report can contain resources and reserves. It can have exploration results, resources, and reserves. That is considered one document. Okay,
thank you. And then when we speak about the updates, I think in the first presentation we noted that let's say there is no update in terms of information. There's no new drilling that have happened over the last year, and now I have to write the CP report again. The second statement, that's no updates are just allowed. So I cannot take last year's report and then put an amendment or some of idea, not amendment, like a cover note, just to say that there has been no update, so the same CP report aligns. Am I supposed to redo the same thing, even though the information remains the same? Just taking consideration of our discussion last week.
Remember, there's a bit of a difference here between the annual reporting requirements. So if you did an annual report last year and you're doing an annual report there, it's completely different. We're talking about competent persons reports for the stock exchange. And if you're doing it for an investor, there you can say no further information has been obtained. So the CPR stands as it was last year. Just don't confuse a new CPR with annual reporting requirements.
No, very clear, very clear. Thank you for that. Yeah.
Okay. Right. So in addition to a CPR needing to contain all information, sometimes we come across a situation where companies say, well, this is confidential information. You need to discuss this with the JSE in order to obtain special dispensation. But irrespective of how confidential you, the company, might feel that it is, you're still going to need some useful level of information in your document. And that then becomes a matter of discussion between yourself and the JSE. But what I'm saying here is, don't think you can say, oh, this is confidential, I'm not going to add it in, and that's the end of the story. It's got to go quite a bit further than that. So when it comes to now sitting down and writing your document, You need to keep in mind who your readers are. Are they other experts? Are they non-technical professionals? Are they informed investors? I'd like you to note this quote here from John Grisham. There are 3 types of words: words we know, words we should know, and words nobody knows. Forget those in the 3rd category and use restraint with those in the 2nd. Besides the necessary technical jargon, try to write so that your readers can easily understand what you're writing. Don't try and confuse the issue. It doesn't make you sound intelligent. It generally implies that you don't really understand your topic, or else you're trying to hide something. So use simple and straightforward language. Assume that your reader has a limited knowledge of your project, but don't assume that the reader is stupid. And also don't confuse quantity with quality. When you're writing, make sure that the detail is in the right sections. You don't want to waffle simply to bulk up your document. If your reader is faced with the prospect of reading 1,000 pages, you're not going to keep their attention for very long. Marlon, yes, you have a question.
Yes, Tanya, I hope you can hear me fine.
Yes, we can.
Sorry to put you back to the, but you don't have to go back to the previous slide. I think it's just with regards to the question that Joseph asked before. I think that question is more based on annual updates of reserve estimations. Most companies, they do reserve estimations, but they normally don't do them from first principles on an annual basis. So they might update them every 2 or 3 years, and then in the interim years, they just do their normal production depletion, mining that has taken place. So what do you do in that regard? Because you just do a normal production depletion. Do you issue a cover note and say, refer to the previous full statement, or do you have to redo the new statement from scratch every year if you want to do it that way? I hope you can understand what I'm asking.
Typically, the statement that you put out every year is not based on a new CPR. If it's based on a CPR, the CPR has to be complete. But if it's based on last year's CPR and your statement is updated, then you can just say that in your statement.
Okay, and with the statement, you mean your annual.
Yes, your annual resource reserve estimation statement.
Okay, thank you.
So when you write your CPR, the format is pretty much at the discretion of the competent person. As long as it is written in an essay type form. Contrary to JORC takes table 1 and you just fill out the table. The SAMREC CPR is not filling out table 1, it's actually writing a document. Now, in Appendix 1, we give you some guidance on the chapter headings that you can use. You can also decide to follow table 1 headings, or you might have some personal or corporate preference. Many of the companies have a particular format that they like their CPs to use. That's fine. The other thing to note that if it's a CPR, it must be a full CPR. So this is Appendix 1. This now gives you some idea of the table of contents that you can use. You don't have to, you can move it around. But this is particularly for people who've never written one before and who need to start somewhere to know what sort of information to go into their document. Appendix 2 is a guide, again, to the type of certificate that the competent person needs to put into the document. Their name, the report title, what they've done, whether they are independent or not independent, the fact that they have compiled the report in accordance with the guidelines. And just note, there is a difference between compiling something in accordance with as opposed to compiling it in compliance with. If you're compiling it in accordance with, it means you have taken the code and you're preparing it according to the requirements of the code. If you're saying you're compiling it in compliance, that actually means somebody else has checked it and verified that it is compliant. Note that we prepare our reports in accordance. And then sign and date it. Irrespective of how you compile your CPR, at a minimum, it needs to have a title page, table of contents, an executive summary. If it's going to the JSE, the executive summary must be in accordance with section 12.9. It must have a date and signature page, and then it must have a certificate. If you are doing a document for first-time reporting or for material change reports, then you need to download table 1 and fill it out. These are the only 2 times that is required, but we recommend that you do it as best practice for all reports, just so that you know that you haven't forgotten something. And here we have an example of table 1, looking at it on an if not, why not basis. So what you would do is this is now under geological model. It says describe the model, discuss the sufficiency of data, blah, blah, blah. What we want you to do is in this block here, just say which section in your document you discuss it. We don't need you to write out here what you've said in connection with this. Just point to whichever section it is that you are discussing that. It helps the readers to identify where things are, and it also helps you to determine whether you've done something or not. And looking at the if not, why not? For example, if you go down here to any one of these, and this particular thing asks, describe assumptions and justifications of correlations made between variables. If it's not applicable, that's all we need you to answer, that it's not applicable, so that we know that you've actually addressed that concern, but decided that it is not applicable. So that's what the if not, why not filling out of table 1 requires. Now, with respect to the evaluation report that goes along with the CPR, in most cases, your valuation report is part of the CPR. And so it only needs to refer back to sections within the CPR for the relevant information. You could even summarize it briefly in your valuation report. There are, however, going to be some occasions where the evaluation document is a standalone report. And under those cases, you need to address all the points of the SAMVAL table 1. And again, this is not required, but it is useful for you as a competent evaluator to look at what these requirements are as best practice. ESG reporting ESG is becoming so important in our reporting these days. And one of the important things to remember is that CPRs are not sustainability reports. They're primarily technical reports. And so reporting of ESG needs to be done in that context. And a couple of the things to highlight is the distinction between materiality and data dumping, not only with ESG, but various other aspects of CPRs as well. And just to note that there is an ESG update happening currently, and more information will be available on that, hopefully this year, definitely by next year. Thinking about the financial implications of your documents. Your CPR often feeds into the financial reporting done by accountants, auditors, and analysts. And one of the objectives is to be able to assist them to provide useful information to investors. And one of the key bits of information they want is to understand the realistic potential of that entity to generate a cash flow. So we want to make sure that our reporting is not misleading, it's not promotional or unrealistically conservative. Remember, the accountants, with much apologies to Kevin, they are not authors, they are journalists. They report the facts that we as competent persons provide to them. Another thing to remember is when reporting is that it's essential for people who are going to use them down the line. And so one of the other important things we need to put in our reports are reconciliations, particularly with respect to mineral reserves, because changes in mineral reserves can make a significant impact on a company's bottom line. So once you've written your report, there are a whole bunch of questions that you as a CP can ask yourself. And I'm not going to go through them. They'll be here for you to read yourself. So I want to move on now to, okay, so now you've written it. Now what do you do? A significant aspect of a CPR is attention to editorial issues. Not only a CPR, any document that you write, pay attention to details. Your references need to be in an internationally accepted format. Please use the format of the SAIMM or SAJG, which is the Harvard standard, which is the typical international standard. Check that your figures and your illustrations are legible and compliant with requirements. Include lists of figures, tables, and plates. List your units, your abbreviations, put in a glossary of terms, and don't forget your compliance statements. When you've finished writing it, check your grammar and your spelling, especially if English is not your home language. If you are using ChatGPT or any other AI, please check for inaccuracies, biases, or plagiarism, because while AI is particularly useful, it can introduce issues that you would not consider. So please check for these things. Also look at other editorial issues. Now, it's useful to have somebody look over your document once you've read it or once you've written it. Can be a colleague or a professional proofreader. Please note this. Check they don't change the meaning of the document, particularly if you're using a professional proofreader who might not be technically competent in your field. They might change the English, but check that it doesn't change the technical meaning of that document. The other thing that you need to do is to check that there are no conflicts between your tables or your conclusions and elsewhere in the documents. And if you got the time, put it in your drawer for a couple of days and then check through it again. You'll be surprised at the things that you pick up. Oscar Wilde, I was working on the proof of one of my poems all the morning and took out a comma. And in the afternoon, I put it back again. Don't be afraid to edit and re-edit multiple times. Remember, the document that you put in is effectively your professional reputation. Make sure that it is correct. Then, as Zach mentioned, once you have compiled your CPR, it goes through the Readers Panel. We've got two different Readers Panels, one dealing with solid minerals and the other one dealing with oil and gas. Now, their primary role is to check compliance with the listing rules and with SAMCODES. They're not a free editorial service. I'm not going to go into much more on this because Rob's going to talk us through the work of the Readers Panel up next. I just want to do a punt for this. The end of May, we have a geoscience communication course through the GSSA, where we've got an international organization talking to us on how to make sure that, or how to get the best out of diagrams and maps. We've also got people talking to us about the best type of writing to use. And we're also going to have Tim Rowlands talking to us about building a better CPR. And so that I'm just going to say thank you very much.
Well, good afternoon and welcome to this presentation. Thank you for attending. And I would like to start by taking you through the inevitable disclaimer and acknowledgement of resources, the SAMCODES, the JSE listing requirements, and the mandate can be found on the SAMCODES website, the address given there. Members of the Solid Minerals panel have contributed to the presentation, and the information used in the presentation is derived from multiple sources and believed to be accurate at the time of presentation. The reporting codes are subject to revision from time to time. The views and opinions expressed in this presentation are the author's own and do not necessarily reflect the views of the GSSA, SAIMM, the JSE, the SSC, or members of the panel. So, having got that over with, we can jump right in. We're going to go through what is the panel, what is the panel's mandate, a review of the work done from 2000 to 2023, the review of CPRs and IARs for the past year, comments by readers on recent annual reports, CPRs and valuations, some comments on future challenges, and lastly, report writing, although I suspect you've heard enough on this topic already, but that's not going to stop me. The Solid Minerals Readers Panel, hereafter the panel, is an independent panel of experts established in terms of Section 12 of the JSE listing requirements. The panel was founded in the year 2000 following the adoption of the SAMREC code by the JSE in March of that year. The full title of the panel is the JSE Readers Panel for Solid Minerals. Oil and gas are covered by a separate JSE panel. Currently, we have 16 readers on the panel, including the chairman, myself. The combined years of industry experience of the current panel exceeds 560 years. And the JSE does not employ its own experts to review CPRs. The reader's mandate is to advise the JSE on compliance with Section 12 of the listing requirements and the SAMCODES in respect of competent persons reports as defined in Section 12 of the listing requirements, referred to it by the JSE. Then we have to check compliance with Section 12.13 of the listing requirements in respect of company annual reports and any other technical issues referred to it by the JSE. The role of the panel is laid out in the mandate. In Section 6.6, it states the primary objective of the panel is to verify and monitor compliance with Section 12 of the listing requirements and the SAMCODES. However, the SAMCODES are based on the principles of competence, transparency, materiality, and reasonableness. And should a reader, in his or her opinion, find that these principles have not been observed, then he or she is duty-bound to question the CP or CV's judgment or interpretation. And 6.7, the objective of a review is to ensure reporting that is transparent and contains sufficient relevant information to allow an investor or potential investor to make an informed decision, and that cannot be construed to be misleading or inappropriate. So moving on, the panel was founded in the year 2000. Since inception, 271 recorded CPRs and other reports have been reviewed by the panel, excluding oil and gas, obviously. Some records from early years are incomplete, but based on the information to hand, the following summary tables have been drawn up. This is the total of CPRs reviewed over different periods. From 2000 to 2004, there were 50. From 2005 to 2009, 81. From 2010 to 2014, 64. And then in the following years, 2015, 11, 2016, 5, 2017, 9, 2018, 13, 2019, 3, 2020, 3, and then we bounced back in 2021 with 17 CPRs, and last year, 2022, we reviewed 15 CPRs. So the number of submissions varies considerably from year to year over time, and there's never a schedule of what to expect in any year. These things come in as soon as the reporting company submits them to the JSE, usually at short notice and quite a surprise. So let's have a look at the number of submissions it's taken before the CPR was approved. And the first table shows you the data for every CPR for a total of 271. Note that we have no complete records for 52 of these, so nearly 20% we don't have full data for. But even so, the first submission, 17%, second submission, 35%, third submission, 23%, and lesser percentages for longer running review processes. If we take out the not recorded section, we get the numbers on the first submission, 21%, second submission, 43%, third submission, 28%, which leaves us, and I should add, as this is a SAMCODES course, all these percentages are rounded, so they don't quite add up to 100%. But 91% of all CPRs have been accepted following the third submission. If we break this up further, it's quite interesting to note that pre-2016, the approval rate was for first submissions, 22%, second submission, 35%, third, 34%, fourth, 7%, and more than 5%, 3%. From 2017, annual training sessions were instituted to increase awareness of the SAMCODES and industry standard reporting by professionals. And since then, annual courses have been undertaken, and indeed in some years, more than one course relevant to reporting is launched. And I'm pleased to tell you that from 2017 onwards, we've noticed a marked improvement in reporting standards, in that we now get 94% of all CPRs approved by the third submission, and a large number of these are in fact make it through by the second submission. So there's been great progress in response to the training courses that has been run by the GSSA, SAIMM, and various MSc courses at WITS. Moving on, who submits CPRs? Well, looking at the submissions by consulting group, we can see that SRK is a major submitter of reports with 18% over time, followed by VenMin, 16%, Minexcon, 7%, Mineral Corporation, 6%, Snowden, 4%, and IRES following on with 3%. Individual company consultants are quite numerous, and those submitting 7 or less are listed in bulk form in the panel below the table, and individual consultants are too numerous to fit on the page, and these are listed in no particular order, so that I wouldn't like you to think there was any fear or favor going on here. And it's quite interesting to see how these have changed over time. There are still smaller consultancies and individuals who are reporting to a very high standard. So it's not necessary for you to be a member of one of these major consulting groups in order to successfully complete a CPR and get it approved. Moving on to a commodity breakdown, here we can see that PGM topped the list. 23% of all submissions have been PGM related, followed by gold with 17%, coal 14%, industrial minerals 14%, diamonds and gems 11%, chrome 6%, base metals 7%, ferrous metals generally 4%, uranium 1%. We very rarely get any uranium actually. And then multi-commodity stroke dump retreatment CPRs 1%. Lithium has popped up at last, although none of these deposits are in South Africa. Antimony gold 1% and tin 1%. So in general, it could be said that the commodity base is representative of the importance of the minerals industry to South Africa. Moving on to annual reports, this is a sample of annual reports reviewed last year. There were 5 of them listed here, and they're all anonymized, so we don't reveal who these companies were. The green bars show those that had no emissions in them, which is having a 60% success rate is remarkable and to be applauded. Company C had one area where they were incomplete, and Company E had not previously submitted an annual report for review by the JSE, and they need practice, and there were a number of areas where they were deficient. The various sections of section 12.13 are the top 2 horizontal bars, and we can have a look at what these were in detail. Because people have really got up to quite high standards of reporting, there's really a case, only one instance of poor reporting is noted for each of these items. There are far too many here to recite for the benefit of this course. They will be in this presentation and in your course notes in due course, but it's worth noting that 12.13.3.1, a brief description of any exploration activities, expenditures, results, and feasibility studies. This is sometimes overlooked by many companies. Some seem to think that the geological setting and geological model is a matter of some indifference. A brief description of the type of mining and mining activities. It's not enough to say it's an underground mine or it's an open pit mine. We need a little bit more detail on what you're actually doing. Production figures, including a comparison with previous financial years. That is sometimes skimped by simply giving gross numbers rather than a breakdown. Descriptions of the methods and key assumptions and parameters by which mineral resources and mineral reserves are estimated and classified. Some people seem to think that this is not something that they can fit into the limited space of an annual report, but it's very important that this information is provided in summary form as a series of brief sentences, which is all that required. The comparison of year-to-year reserves and resources. Sometimes people are a bit lax with that. Appropriate locality maps and plans. These have become increasingly sketchy in recent years, and it's become a matter of irritation to be presented with a cartoon rather than an actual map in an annual report. Let's move, let me move on now to competent persons reports for 2022. Now, there were 15 of these, in total. And as a point that I'll be making later on in this presentation, I've listed the page count for each of these. And as you can see, the page count varies quite widely. But there were two very large CPRs, one with 1,476 pages, and the word count was just a shade under 500,000 words. And the number 14, which was a valuation report, that was also very large at 1,691 pages. The point to make here is that you've got to sort of steer a fine line between what amounts to a data dump and what is essential information. And in the case of big companies with multi-commodity operations scattered around the world, it's probably inevitable that you're going to get very large document sizes. But even so, for members of the panel to, the individual members are identified by green blocks showing who did what, you know, to 3,755 pages is an awful lot of work to get through. And it's reading these and reviewing them by the panel is not a simply flipping through the pages. You actually read it from end to end. So it's actually a hard task. And in an 8-hour day, I challenge anyone to get through more than a couple of 100 pages at best in a CPR. I should note also that the one number 1, there was no valuation with this. It was a JORC compliant document for a secondary listing on the JSE. It was an ASX format ITAR report, which don't require a valuation. And number 14 was an unusual document for us to review. It was a SAMVAL compliant valuation supported by a number of National Instrument 43101 reports. So they were quite complex documents to work through. So what have we got to say about all this? This is just a sampling of readers' comments. If I were to put in the readers' reports in here, we'd bloat this presentation to about 100 pages at least. But this is just a summary of certain highlighted comments. Metal equivalence, poorly understood and applied. Corporate identity versus the competent person as the person as the competent person. The large volume size of some CPRs, increased regulatory burden, to which ESG and plain language summaries may soon be added. And this is likely to bloat document sizes further if it's not carefully managed. Tables not checked for correctness before submission. This really means that the contents of your tables don't add up, or down columns or along rows. And the other thing is sometimes the tables in the body of the document don't correlate with the tables produced in the executive summary. Expiry dates for mineral rights and mining rights are not disclosed. First submission not compliant with SAMREC, SAMVAL or Section 12. It's quite startling to receive a document that was written by somebody who perhaps didn't realize any of these things existed. The CP showed poor understanding of Table 1 compliance. non-compliant terms, e.g. residual resources, the extension of inferred resources to property boundaries exceeding drill hole coverage, SAMREC Table 1 compliance incomplete or vague, SAMVAL Table 1 compliance incorrect or incomplete. If not, why not? Not followed. Combining mineral resource categories, supporting information out of date. In other words, it's no good writing a document in 2023 when your backup information perhaps dates from 2005 or 2010. Moving on, coal reserve parameters were confusing. Use of unusual and non-compliant terminology, additional coal, potential coal. Conflict between the executive summary and the main report. Resource estimate parameters not clearly described. Editorial cleanup of the CPR is often a bugbear, and it's very tiring for a reader to have to go something that's not very coherent or contains numerous spelling and grammatical errors. Moving on, the quality, purity of the proposed product is not defined. And lastly, no discussion of ESG matters. As has been remarked earlier, ESG is of increasing importance in reporting and often demanded by investors. If they don't see a full ESG statement, they tend to lose interest. So moving on, okay, I think we covered some of this. Tables did not add up, figures and diagrams not compliant, reserves not well justified, modifying factors unclear, and the basis for geological losses unclear. As I say, this is a sampling of things reported by the readers over the last year or so. Valuation reports, again, this is simply a sampling. It's by no means a comprehensive survey. Post-closure costs, obscure. SAMVAL Table 1 compliance, incomplete. Basis for the valuation, not clear. Basis for the tonnage in the valuation, confusing. Contributors to the valuation, not clear. No site visit even after COVID restrictions were lifted. Ranges of values, taking the median to the maximum to select your preferred value. The CV did not display competence to undertake the valuation. Incorrect valuation methods applied, and no PFS support assumes just using assumed costs and revenues.
5 minutes, please, Rob.
Okay, challenges for the future. Accommodating SK 1300 TRS requirements within the SAM code and JSE requirements, exposure to reporting codes other than the SAMREC SAMVAL codes, inward secondary listings on the JSE. This refers to Section 18 requirements. Companies moving primary listings from the JSE to the NYSE, etc. Awareness application of JSE requirements, Section 18. Further challenges, is the page count of CPRs too much or too little? Does the investment community and the interested investor need so much information and detail in a CPR? And who, apart from the competent persons, editors, and the readers, reads a CPR from end to end? A good question. further issues in future, a plain language summary of the executive summary is likely to be a requirement for technical reports. In South Africa, there's no standard or guide for achieving this, and engagement of the consulting community will be essential to make this a success. A few comments on report writing. Make sure you set your MS Word language default to English, South African or United Kingdom, and not English United States, which is the default. If you're writing for the United States, then of course you use United States, but in South Africa, it's English South Africa. Multi-author CPR should use the same English version. Often they don't, and this is very confusing. Make use of the built-in editor in MS Word 365 to tidy up spelling and grammar. A premium version is also available on subscription. Or you can subscribe to editing software such as Grammarly, which is the one I use, which will aid you in deep cleaning your reports. And finally, an appeal from the heart. Please, people, proofread and edit your reports before you send them to the JSE readers for review. We are not an editorial service and will not correct your errors and mistakes. These are your responsibility. And thank you.
Let me start off by introducing the panel, which is moderated by Stephen Ruprecht. Steve is a professor of engineering at UJ and is on the SAMREC committee and has extensive experience in all aspects of compiling CPRs. Our panel is Jeremy Whitley, Kevin Davies, Godknows Njoa, and Sefa Mark. They have experience in competent persons reports, competent valuation reports. They come from consulting backgrounds and corporate backgrounds, and between them have pretty much seen and done everything there is to see and do. So with that, let me hand over to Stephen, and we look forward to the conversations, not only with your panelists, but also with anybody who wants to contribute to anything going forward. Thank you.
Thank you, Tanya. Yeah, we've highlighted a few starting points, but I would ask the audience if there are burning issues that that you have that you would like to put to the panel, questions that you would like to put to the panel, to please put them up on the comment section, and or we can raise them verbally. I'm sure we would love to address those issues. It's a good form. As a starting point, I would like to open to the panel. Hopefully you can still hear me. My computer went blank there for a second. I'd open up to the panel. One of the topics that have been coming up of recently, and I'm not sure how much some of the other speakers spoke about, is RPEEE, reasonable prospects of eventual economic extraction. And I might add that the Americans have, with their SK 1300, have dropped the eventual out of the RPEEE. But I'd ask the committee, I guess you say the committee, what they're feeling. How has, and maybe I can start with Jeremy, how has he seen RPEEE change over the last 10 or 15 years to where it is now, and maybe commenting on good practice, on what a competent person should be ensuring that they're including in a competent person's report. And then we can follow with the other members to maybe add to what Jeremy has to say. So I'll pick on Jeremy and then move on to others. Over to you, Jeremy. Hopefully you're there.
Yeah, I'm here, Steve. Good afternoon, everybody. You can hear me okay, I assume?
Yeah. Sorry to put you
well,
on the spot.
Thanks, Steve, for putting me on the spot somewhat. But it's an interesting question that you ask about, how have we seen RPEEE, its application changing over the years? I think probably 10 years ago or so, most reports you would read didn't even consider RPEEE in a mineral resource at all. And then things became simplistic in terms of, okay, $10 a ton mining, $5 a ton metallurgy, value of my rock is $30 a ton, therefore. But I think today the reporting of RPEEE has become quite refined in terms of the amount of information that's required. It's still viewed very much as a cutoff grade equation by many, but I think if during your SAMREC discussions over the last few days, it should become quite clear that there's a lot more to RPEEE than just a cutoff grade calculation and the pit shell. Many considerations are required in terms of community, environmental, logistics, infrastructure, a whole range of factors that essentially the CP must discuss in order to say this deposit or this mineral resource has a reasonable chance of eventually being mined. And I think having done some CPRs for SAMREC and others, it's always RPEEE that comes back from the readers panel about more explanation of the other areas and not just the cutoff grade calculation. So it's certainly becoming, a much bigger consideration than it used to be. And I think what it now requires is a much higher level of knowledge for the competent person in all aspects of mining and metallurgy to be able to address these items.
Yeah. Saif, would you have, from your experience, especially recent reviewing of competent person's report, anything to add in that regard, or even from your experience in corporate, perhaps from what has changed in your time with the company, or like I say, with reading other CPRs?
Stephen, yes, I think I agree with Jeremy that it's become more to the fore, but I think if one critically review reports, I think there's still scope for significant improvement, even if you just look at the SAMREC requirements in SAMREC Table 1, Section 4.3, I think there's not great compliance with it. And it's obviously mostly related to inferred mineral resources or those that doesn't form part of a mine plan. But I think overall, what my experience is that RPEEE is not purely only technical consideration. It's not an event, but it's a process. So it's actually a dance-off that starts with the company corporate strategy, looking at the broader picture, things like the market outlook, the geopolitical scene, governmental, ESG, capital allocation. And once that picture is in place and the CP understands that, then one can move on through a decision tree to look in detail at RPEEE, starting at aspects like the legal tenure, etc., including cutoff grades, importantly, risk assessments, and then ending up with the prospects for what is actually eventual. So I think there's, particularly in the area of inferred mineral resources, from reports that I've seen, I think there's still scope for improvement and more transparent disclosure on how RPEE is applied. That's my 5 cents worth.
Yeah, thank you. If I could add, and maybe to, I don't, is God knows here, Tanya? I might ask.
Yes, sir.
Okay. My feeling is, and maybe I should just ask you, with the way we're bringing in RPEE and we have to look at modifying factors, it's implying, well, it's actually asking, we should be considering the modifying factors, perhaps not as much detail, but considering it. It almost, means that perhaps we need to look at figure 1 and maybe modify that a little bit in regard to modifying factors. Any comment, God knows, in your mind on whether that is a true reflection that we need to make some modifications to somehow bring in these modifying factors, to bring them in? It's not just the conversion of resources to reserves anymore. It really is looking at modifying factors in the resource category. So any thoughts on that?
Thanks, Steve. So maybe let me start from a perspective of, as a mining engineer, EEE, I think is from my view, and I agree with Jeremy and Steph that in the beginning it wasn't, it was kind of implied. For example, and I'll give you a simple example. An example would be, let's say if someone in South Africa is mining 3 grams a ton at 500 meters below ground or 1,000 meters, that was good enough to say, okay, fine. If someone is mining this economically, the RPEE has been kind of considered. That was then. But on the other end, which I think we have also seen in recent years, was for RPEE, a competent person goes to town and do all the work that, all the descriptions that is required, as if he's converting the mineral resource to mineral reserves, which I don't think that was the intention of the code. In my view, the intention of the code was the competent person needs to consider all the factors that could affect the reasonable prospects of eventual economic extraction. However, there hasn't been any guidance. So that's why you see in the reports that I think have been published, some of them are to the extreme end, some of them are on the extreme end. In my view, I think maybe the correct answer is somewhere in the middle. But currently, there is very little guidance to say, okay, what is that middle ground? Back to you, Steve.
Yeah, very good point. Yeah. And then Kevin, from your coming from a different side, as you say, the accounting background, do you have experience in running into problems with RPEE in any aspects of your area of expertise?
Well, thanks, Steve. All I can say is that 15 years ago, I was writing reports for the Securities and Exchange Commission on this topic, except that we called it value beyond proven and probable. Because I've been in financial reporting on major mining companies for the last 20 odd years. And I can say without doubt that every single one of them was producing more ounces than they ever thought was there at the beginning of the mine plan. And so this thing actually exists. And so from an accounting perspective, if we're trying to work out whether we should impair, we have to go even further than what is disclosed under RPEE or potentially going to be disclosed under Competent Persons Report. We actually have to ask the geologist, where does the seam finish? And are we ever going to get there? And if we are, under what circumstances? And if the answer is, well, if gold is $50,000 an ounce, then we're very happy to say, okay, it's not going to happen. But if we're within 100, 150 of the figure used for the reserves and the resources, well, then maybe it is. So from an accounting perspective, maybe I've got an indicator that an impairment isn't indicated. It's not in any of the reports that the geologist has prepared, but it's in the stress testing of the CPR report. And I've been there for the last 15 years.
Yeah. Okay. Yeah. And I think probably, in the same vein, and again, maybe one of the panel members would like to comment. I mean, probably our biggest concern, or my biggest concern, is, the estimation of a inferred resource. We still see, although the definition has been modified and improved upon, we still finding in my mind a lot of stretch in inferred, which maybe challenge sometimes the RPEE. I don't know if Jeremy or one of the panelists would like to comment on that, if they feel the same or not.
Yeah, Steve, it's Jeremy. It's interesting you come across you mentioned inferred. I was just going to talk a little bit more about RPEE and something that God knows was mentioned about, some people are going to quite a lot of detail in the RPEE. And, how can that RPEE detail be warranted in an inferred resource for which you don't have sufficient information to think about? I don't like the term modifying factors, but to think about how you should be mining it. But then also, if you don't have sufficient information about how you should be mining it, how would you ever say this got RPEE? So it's a bit of a circular conversation. And when I look at RPEE, I like the guidance. I think it might be in JORC. Correct me if I'm wrong, where they mentioned more likely than not that it will eventually,
yeah, I think
be subject to some form of extraction. Sorry, Steve.
I say I think both SAMREC and the JORC have that you would expect with further exploration drilling that it would be increased or
yeah. There's some specific some specific guidance in one of them that says more likely than not. And I think one should remember that the RPEE conversation is about assumptions. If you've got to the point at which you're demonstrating the so-called modifying factors, you're well into reserve territory. RPEE should be about, given this deposit, it's reasonable to assume that. And that's the kind of conversation I like to have when you're looking at dilution, extraction, mining method, metallurgy, costs, etc. It's reasonable to assume that. Obviously, if you've got something that's an impediment, like an environmental consideration, then that's a slightly different conversation. But I think to me, that's the best guidance that I can take myself, is reasonable assumptions and more likely than not. But yeah.
I think the key is it does state you're looking, you're investigating, and again the modifying factor is the word that they use, whether we like it. But not at the same level that you would to convert a resource to a reserve, but that kind of a vague term. But I think what it's trying to highlight is that you need to go through those checklists to make sure that there aren't any outstanding or red flags out there that would put your RPEE into a doubt. That is not just a cutoff, that you have to look at environmental, social, and the whole range, the whole gambit. Do I have power, or is my deposit under a major power line or under a city, or, you know, those type of things, where in the past some of those factors weren't even looked at, you know, just kind of, well, that's somebody else's issue. Anyway, that would be my take. Seth, anything else you'd like to add on that, or anybody else?
I think I'm in agreement with everyone. I like the idea of it being balanced and not in the extreme. But I think overall, like anything else under SAMREC, is to be transparent, to clearly indicate how one is considered RPEEE. And yes, there are extremes without naming and shaming. So there are quite a few inferred mineral resources of vast quantities being reported without any drill or sample intersection. So I would question how that would actually go through a decision tree of satisfying RPEEE if one has just got to go by the rule of thumb that elsewhere maybe there was a success that, in my case, I think that is stretching it too far. There should be a more reasonable decision tree process without going to the nth degree, but be transparent and balanced.
I would agree. Maybe just to kind of roll out a little bit on that, when we're doing, and I'm going to ask God knows to comment, you know, from his experience, when we're looking at RPEEE, and the comment I would say to people out there is, as a competent person, you know, you've got to spend quite a bit of time collecting data, and you're reliant on the registrant or the company to give you information. Perhaps God knows if you could, you know, give from your experience to the younger competent persons out there that are starting out, the kind of due diligence one requires that when one's looking at, whether we're talking about resources or reserves, but if we're talking RPEEE, the due diligence one needs to undertake when one's doing these reports to ensure that you're getting enough information. Because I don't want to, you know, I don't want to say it, but at times the companies that we work for aren't always transparent and aren't always telling us things that we need to know, that as a competent person we should know. And you know, sometimes it's up to us to make sure that we uncover or roll the rocks to see what's underneath. So if you understand what I'm saying, and maybe you could comment with your experience, how we as competent persons, especially young competent persons, how do we ensure that we are doing enough due diligence?
Thanks, Steve. So for me, from a simplistic perspective, I kind of look at when you're doing a CPR, or whether you're considering the RPEEE, it's like you are putting a puzzle together. You need to have a clear picture of what you are putting. Imagine if you are working with a puzzle of, let's say, 9 by 9, and you don't have 5 pieces. That picture is not a complete picture. So you need to have a complete picture in your own mind that everything has been covered, and this is what the picture looks like. Then the second, so in terms of gathering the information, it's like it's always comes to, you need to get all the pieces of the puzzle together. Then there is a second point where you now say, okay, now you've got the picture in your own mind. You haven't started writing anything down. You now need to write or to report whatever you have found in a way that I think Steph spoke about, being transparent, in a way that someone who is of equal experience or equal knowledge would be able to come to the same conclusion that you have come to. Because the idea of a competent person's report is you are supposed to communicate the picture that you have created based on the information that you have gathered to an investor or an intelligent investor. That's why I think Rob was talking about simple English. and you being the kind of the middleman translating complex geological terms to simple English in the CPI. So due diligence would depend on the different commodities and the different specific items that might be more important in one area. So if you look at it, some that might be very critical in gold might not be as critical in coal. So you need to consider what commodity and what would a typical person would require to see in this particular picture. Because, for example, if your picture is missing just 2 pieces, it's still not complete. You need to make sure that that picture is transferred to the report that you are writing as the competent person. Steve, I hope I answered your question.
Thank you, Gardners. Okay. Is there any from the audience, any questions that you would like, if you'd like to ask around RPEEE to the panel? It is open if someone would like to ask. Joseph, I think you have your hand up, if I'm not mistaken. Go ahead, Joseph.
Thanks. Thanks a lot for the discussion. I think also from my end, it's been really a difficult one. For open pit or surface mine, I think it's I wouldn't say fairly easy, but compared to underground, when you are defining the RPEEE, for open pit, normally, let's say you take a pit shell based on your optimization, and then you get assistance on that. The geologists take that and then they process, and then they get something out of it. But for underground, I think it's been really quite a bit of a challenge. And I just wanted to hear the opinion of the panel on how, based on those differences, how we can maybe define that, considering now that at least there is some requirement of some information to determine or to indicate that there is eventual prospects of extraction, and how we would go about it in the underground context.
Okay, we'll see who wants to quickest hand, or who would like to answer that one from the panel.
Okay, I can.
Okay, go ahead, Jeremy. I'll let Jeremy go, and then God knows.
Yeah, that's a really great question from Joseph, and I think I can just talk about the way I've been seeing trends towards dealing with underground resources is very much towards mineable shapes. There's quite a lot of software around that does mineable shape optimization, and it's becoming more and more commonly applied in a very similar way in which a Whittle type pit shell is applied. You run your mineable shape optimizer, and it gives you the general area in which you can expect to be able to mine, and then you can extract your mineral resource from that general area. So that's just really the trends I've been seeing, and I think also with the underground, what I find one of the biggest challenges is dealing with deposits that aren't very contiguous at the chosen cutoff grade. So you might not have these continuous zones of mineralization, and sometimes I've seen people reporting isolated blocks far away from the main mining area, and I think in those cases the CP should ask his or herself whether those blocks that are far away from the rest of the area have RPEEE. Do they have any chance of covering the capital associated with accessing them, for example? So I think there are similar approaches that can be used to open pits, but yeah, certainly there's a lot more considerations and other challenges, and particularly in South Africa, where we have these critical depths at which you're going into cooling, or you're reaching a different rock engineering regime, where your costs will change, and you end up reporting with the different cutoff grade at different depths, for example.
Yeah, refrigeration and platinum. Yeah, as we go deeper. Okay. Gardeners, go ahead. Maybe you want to add a comment.
So I think, in my view, I think like the Joseph said, in an open pit, I think the critical items are maybe not as rigorous as what you'd expect from an underground operation. To say you might be looking at currently, I think environmental is one of the things that I think you need to consider, given the emphasis around ESG. And then if you can do what I would call a scoping study kind of level pit outline, that should be good enough to then demonstrate that from an economics perspective, you have considered things that would be potentially economic at a particular commodity price. For argument's sake, if it's gold, you might say, okay, your resource estimate is based on a 2,000 gold price. Given that we breached the 2,000 mark 2 days ago, so it should be reasonable that the price could go beyond 2,000 in the next year, next 2 years, or next 3 years, or whatever the case might be. Thank you.
Just Gardeners, just a comment on that. It reminds me of a few years ago, and as we get older, a few years ago, it might be 5 or 6 years ago, that a consultant was raked over the coals for using an eventual gold price of $2,000. And when we talk about eventual and we talk about the code, we talk about 10 years and 50 years and 30 years. I'd go to broach that perhaps that maybe that competent person wasn't incorrect to have put in such a high. It's one of those weird and wonderfuls. I'm sure when he was doing it, or he or she was doing it, the gold price was maybe sitting at 1,400. But when you talk about eventual and you look at the code, it is talking about 10 years or something. And I would argue that we are definitely within that 10-year period, that perhaps, I probably would have chastised the person as well, being too optimistic and perhaps declaring resources that aren't there, knowing also prices, fuel goes up and everything else goes up with the gold price. But while you're there, maybe you could make a comment about eventual, or you could pass it on to one of the others if you incline.
So Steve, that's a very interesting comment that you make right there. And looking at what the industry has evolved to be, at that particular point, I think people would have thought that the person is crazy. But looking at the true sense of definition, I think they were right. However, we also consider what, which I think this is maybe a wrong concept, and Kevin can also maybe jump onto this one, is we consider the market to say, what is everyone doing in the market, right? And sometimes we can all be wrong, but if someone is just doing something that is out of sync with the market, they are kind of considered to be wrong. So that's why I think it maybe, let's say 4 or 5 years ago, when the gold price was at 1,400, when everyone was using maybe prices for resources, maybe that was around 1.6, 1.7, 2,000, I think, was kind of stretching the string too far. But like Stephen has spoken about, according to the definition, we're saying a reasonable prospect of eventual economic extraction. And the eventual economic extraction does not give a time to say it should be in the next 3 years, or it should be in the next 5 years, or it should be in the next 10 years, or it should be in the next 50 years, which I think is something that I think as professionals, we need to have it, a balanced view of these aspects. And maybe it would be important to have some kind of guidelines to say, okay, maybe this is what you would consider. Maybe Dave,
Go ahead.
If you can, maybe if you can help well, from an accounting perspective.
Yeah, Kevin. Yeah, I do see the hand raised, so we'll get to you, Marlon, just now. I'll just let maybe Kevin comment, and then I'll go to the raised hand.
Kevin has been hit by load shedding. He's dropped out.
Okay, all right. Well, when he comes back, maybe we can ask him. I see Marlon, your hand is raised. Go ahead.
Thank you, Dr. Rupert. I would just like to put it to the panel. I mean, we've been playing with, similar to what was mentioned, looking at mineable stope optimizers and all of that for underground declaration. But I think it's prudent to what was mentioned is that eventual. I think that is what is maybe plaguing us a bit, because we say eventual now. Is eventual 3 years or is it 100 years? Because some of the life of the operations could stretch for 70, 100 years. Now you play with that, and then you've got some more factors within that regards to eventual economic extraction. When you look at market cycles, like the platinum price back in 2002, 2003 was $2,000. Now, can it ever reach that? I'm sure if a use case comes along that drives the market sentiment and obviously use of the metal, what is that price you would use? Would you use a 1.2 revenue factor, 1.5, or a 2 revenue factor? But I think it's those market cycles where the analyst forecasts that we have to, sometimes we look at the number and try to normalize or average out these market cycles, because you could be reporting something at 1,000 and then 2 years later it could be at 1.5. Now I think all that plays into it, and it makes it a bit difficult. Obviously we do our due diligence on these metal price forecasts and try and understand what are driving these analyst forecasts. But I think it's still, what is your understanding, and explaining it to your peers to look at your view of what you deem is eventual economic extraction. And I think there's a little bit of that in resources and reserve statements. Obviously the resources, your level of information or your level of confidence is a little bit lower than as when it gets to reserves. So I think that's what's been plaguing us at the moment, but I'm sure we'll work our way through those arbitrary stuff for the resources over the next year or two.
Yeah, yeah, and I think God knows raised a very valid point of, I think one tries not to be I guess an outlier. You know, you try to fit in within the realm of everybody else. Otherwise, you know, you can be open to, I guess, criticism. You know, it's not an easy answer. And then, you know, again, the other thing we forget about it, and about eventual, we see the gold price, or say the market price, go up, but we also have to realize with that, so does the fuel price, electrical price, you know, so our cost inputs also go up with it, you know, sometimes not in a straight line or in the same path, but yeah, and that becomes tricky as well, because, you know, inflation is not linked to maybe the market price.
Yeah, I think the last point I wanted to make is, it's extremely difficult to look at these let me say deposits over the long term, because in a way you need to factor in your technology improvements and new technology coming on stream, improving these mining costs like mechanization, automation, new ways of mining. And I think the amount of options or scenarios just blow out, because it's almost like almost exponential if you have 5 or 10 levers which acts together. So that new technology coming in, I think that's even adding another dimension of yeah.
And again, we're moving a little, which is fine. We're moving off of RPEE, but you mentioned new technology, and again, for those that are perhaps newer in the game, again, SK 1300, the Americans, the SEC, is in our code as well in metallurgy, but new technology, whether it be metallurgy or even mining, one has to be very careful about it when one's using and applying that, whether it be RPEE or even in the reserve, because often, there's mines that have tried to introduce narrow vein, long hole stoping and failed dismally. And a lot of shareholders lost quite a bit of money on this, technology that we were hoping that would save, I don't want to say save, but it would make a marginal project profitable. But in fact, it diluted the ore body so much, or diluted the run of mine grade so much, it made a marginal project not profitable. Any comments from the panel regarding, experience with new technology, making, maybe optimistic predictions in some of our modifying factors?
I'll go first, Steve, and I just wanted to also let you know that I've got a hard stop at past, and I'll just jump off. So I think in terms of technology, Steve, that's a very something that I think we need to consider, and it has been, I think, with us. For example, if you consider the old days where we have got the refractory ores, especially in gold. Previously, I think you could maybe get your recovery at best at around 60% or something like that. And I think there was a lot of deposits that could not be mined, or that were mined, but the recoveries were very low. But with the new technology, or the improvement in technology, we have seen companies going back to the tailings of those refractory ores and reprocessing them, and being able to recover most of the gold or the mineral that was left in this old technology. So that becomes and I think the idea of, or the concept why the codes spoke about eventual. I think the idea was you need to consider it might not be exactly economic now, but there is reasonable prospect that it will be economic in the future, with maybe 1 or 2 or whatever changes that might happen. So it's not far from or outside the realm of potentially happening. I think that was the idea, and I think Jeremy used some ways to say, okay, it's more than likely that it will happen than it's not likely for it to happen. So I think that's my what I've seen happening in the industry. Thanks, Steve.
Thank you, Godness. Jeremy, any other comments, Saif, on that idea?
Yeah, I think.
Go ahead.
I think in terms of technology, I agree with God knows it's got to be likely, and I think it would be quite. I don't think it would be very responsible for a CP to have a deposit that isn't currently, where the technology doesn't currently exist to extract that mineral or to mine that mineral. I think it would be very irresponsible to say, oh, well, you never know in 100 years' time what might happen. I mean, that's just irresponsible. So I think that my guidance on this would be, it has to be technology that exists and is in a reasonable point at which it's going to work for that deposit,
Yeah.
So,
yeah. I think
Stephen, CFA, I fully agree with that. I think we've all, one way or another, burned our fingers of being a bit over-optimistic. But I think in a transparent way, there's a ways around it where one can do sensitivities and reflect in a transparent way, ranges in the sensitivity, what the potential impact of new technology could be in future. But I think the actual mineral resource reserve statements should be on proven technology.
Okay, good. I think that's the guidance to the audience. Yeah. Okay. What I'd like to do, I still haven't seen any new questions for the panel. One of the things that I would like to bring up, and something I think we might want to look at from a code point of view. What I like about the SEC SK 1300 is that they definitely make sure that the registrant, in other words, the company that we're writing the CPR for, the technical report, has a role and a responsibility to play. Whereas I sometimes, and perhaps I'm incorrect in saying it, but I sometimes feel, although yes, the JSE may be, directors have a responsibility to the JSE, but I sometimes I'm concerned, especially for the younger CPs, that we are, that they may be, or we as CPs can be pushed by companies, registrants, to maybe be more favorable than what we should be in our reporting or our valuations. Saif, I see you're still up on my screen, so maybe you would like to comment, and again, perhaps advice to the younger guys, guys and girls, how one handles perhaps undue pressure that can be put on us as competent persons, whether you work for the company or whether you're independent. I think that pressure is there on both sides.
Yeah, Stephen, I mean, I think this has been a traditional thing through all the scandals in mineral reporting from many years ago. I think the fallback position that supports a CP is that you're part of a team, and it's a team concept of which you may be the lead CP or part of the team. So the individual pressure can somehow be absorbed by the group at large. So talking from a specific company perspective, I think what is very useful is to set up a clear set of standards underpinning the SAMREC code. While the SAMREC code gives minimum standards, so it's a very good practice in your case to devise what I can call a whole process for estimation and reporting, where you can have this handbook and then no one can argue with you that this is the standard over and above the SAMREC code that we as a team adhere to, rather than some pressure of call it a director or a chairperson. So I think yes, it's possible, but I think working within a team and with the support of additional standards may work well.
Sorry, I muted myself. I was going to say, God knows you're going to leave in 2 minutes. Let me just ask you, God knows your farewell kind of commentary on that, your experience. I believe you never get pressurized, eh? If you could comment.
So Steve, that's a very difficult question to answer. That's I think pressurized. I think it is always going to happen, right? But how I've been able to stay out of the muddy waters or the deep seas is I always consider myself or consider this circumstance and say, what would a reasonable person do under the circumstance? Because at the end of the day, if let's say something goes wrong, the judge, this stick that is going to be used to measure against is, if we put exactly the same circumstances with someone of equal knowledge, experience, and exposure, would he have come to the same position? If the answer is yes, then fine. But if it's no, then you are playing around in the deep seas, and if you are not careful, you are going to sink. And like Steph said, there is always safety in numbers. So if you are not sure, call a friend or call someone that has got the necessary experience that will be able to give an independent judgment to help you to navigate these rough waters, or high waves. Thanks, Steve.
Thanks, Gardner's. And I think, highlight again, Gardner's hit a very important point of, phoning a friend. I think we do, or I don't know if you want to say phone a friend, or phone a peer, but we often, we will call people and say, look, this is what's happening. Can you give me your opinion? And so I think we definitely, being in committees helps in that we know quite a few people, and we do call up. And to this date, I haven't had anybody ever say to me, no, I won't give you an opinion. I've always had colleagues assist in queries. So I think, if you learn one thing, if you can be in these committees, and it's a good way of meeting people. And even from this, workshop course, there's people that you could send an email and say, this is my problem, what do you think? And most people will help and not say, listen, you need to hire me for an hour. Obviously they're not going to write the report for you, but they'll give you good advice. Jeremy, from your experience, I know you're not one to be intimidated, but maybe you could provide advice again to the younger guys up and coming. Perhaps how do you manage? I used to, before I let Jeremy go, I used to work for an executive, and he would push you. I would say he would try to push you and bend you, but he would never break you. I mean, I remember once he pushed so hard, and the CP gave in, and he said, no, I'm not gonna put you on the spot like that. Even though you agreed, he stepped back, and I'm not going to do that. But it was a good example where the CEO actually broke the CP, and he would have given him what he wanted. But he was nice about it. But you do run across these characters that will push you as hard as they can. And it's not so easy, especially for as we're older and more confident, it's easier. But yeah, if Jeremy, you could maybe give advice for the younger guys and girls, how does one handle that, perhaps? Or if you have any experience that you could share.
Yeah, it's quite a wide topic of discussion, in independence and not being coerced into giving certain answers. And I think one of the areas where we perhaps need a bit more experience as geologists, I know many of us are geologists, I'm talking about mineral resources now, is in terms of RPEEE, because the area that the clients will normally push you the hardest on is lower the costs, lower the cutoff grade, get the biggest resource that they can possibly imagine for their investors. So I think firstly is we need to be empowered with the right level of knowledge and perhaps education to be able to say to that particular person, this is just not correct. It can't be real. But probably your best weapon out there is when somebody comes along and says, well, I've got an underground resource 2,000 meters deep. It's please report it at 0.5 gram a ton cutoff grade, and you'll have to say, well, I can do that, but in order for me to do that, you must show me and demonstrate to me why you think your number is good, you know? So you've got to push it back. You basically push it back to that particular person and say, you show me, I can show you mine, now you must show me yours. And generally speaking, that's normally when the guys start taking a step back, because they know, you know what you're talking about, and you're not going to bow down to that kind of pressure. So yeah, so the more knowledge and the more skill we have, the better. But I really like the view of phone a friend, get advice from people, find out what is reasonable, what's not reasonable. But eventually we just have to say no. I think, you know, we have long careers in this job, and we have many clients. And some of the time the clients are going to be upset with you. If you're a consultant, just get used to it.
Perfect. Thank you. Thank you. All right, we've got another question for the panel. I might, if I need, I might ask Joseph just to clarify, but the question is, can we touch a bit on annual reports versus CP reports? I'm sure we can, especially when a mine doesn't run a full mine plan in the year in between. Now that part I'm not quite sure. For how long can that run without generating another CP? CPR, I think is what. So how long can we run it? Run with our CPR and keep it good. I'm open to. Okay, so Joseph, yeah, I'll let you just explain that what you're looking for, and then yeah, we'll ask.
Yeah, thanks a lot, Stephen. So I think we touched it, I think, a bit in I think Tanya's presentation, but I just wanted to put a scenario to say, in 2023, I do a full mine design, and I've got supporting schedules and all the financial analysis that I do have, and then I compile a full CP report, and then I submit that. But next year, what I only do is I decide that I'm not going to redo everything. So I would consider that my schedule that I did this year is valid. The only thing that I will do is I will move my first position and update my schedule in a way, and then I run that again. And then obviously, when I run that, I'll get the new numbers and then submit those numbers. But in such a case, and I can do that process, you know, I don't know for how long, hence the question to say, how long can we still do that? Because I submitted a full CP report now, and then in between, I'm doing my annual reports, but are they complying with what's required, or are they not complying? Is my CP report that I do in 2023 valid for the next 3 or 4 times that I'm just going to rerun the schedule? I think that's where I'm coming from. That's the background.
Okay. All right. Open. Anybody want to field that one?
Stephen Seif here. So maybe from what I read is that the competent person's report is actually only valid for 6 months, as we've heard, because of all the changes in prices and costs, etc. That we've also heard the trigger to compile a new competent person's report, apart from listings, is if there's been a material change. So you don't have to update your competent person report unless there's been material change. But in terms of updating your mine plan and your annual report, obviously that will be impacted by your commodity prices, your other modifying factors. So you have to update your mine plan and come up with different mineral resources and mineral reserves. Whether that triggers a competent person report will only be in the case if there's been material changes. That's my understanding, but certainly you don't have to do competent person's report every year. But if you declare mineral resources every year, you need to consider the changes that's happened over the past year.
Yeah, I would agree. Jeremy, would you like to put your
Yeah.
Your hand up on that?
I'm not sure if I might understand it from a slightly different angle. And Joseph can correct me if I'm wrong. You know, it's quite common practice for people to run resource models and life of mine plans, etc., at a point in time, and then apply depletions thereafter until the point of reporting. And I have seen some companies carry that on for more than one reporting period. So they just run a depletion because they think the amount of tonnage that's moved isn't material, and they don't see that any of the modifying factors have changed, etc., etc. Is that something you're also thinking of, Joseph?
Yeah, it's certainly along those lines, Jeremy.
Yeah.
Yeah, it's certainly along those lines. Yeah.
So again, you know, personally, I think good practice on any mining operation is you have a planning cycle, and you should be running these things, you know, according to your planning cycle. But I also understand that in some cases it might not be possible. But again, I think it really boils down to materiality.
Yeah. Yeah, I mean, I think, you know, I think in reality there may be, I think you've got the good and the bad and the ugly. Some, you know, ideally we would like to update our CPRs with the new information annually, and some companies try to do that. And others maybe don't have the resources to do that and wait until it's material, and perhaps maybe not even when it's material. Because nobody's asked to see the competent person's report in 10 years or something, who knows. But you definitely, you know, from a budgeting point of view, you have your life of mine plan and things like that. But I think it's, you know, from my experience, I have seen companies maybe not updating as good as they should, and for various reasons. And not only is it for an investor or potential investor asking for it, but it might be that, Jeremy works for a company and then he leaves. All his knowledge might go with it, and if it's not well documented and things changed, you then find that there's a void, and certain aspects of the reporting hasn't been properly documented. So, you know, I think in this day and age, it's wise to try to keep things up to date as much as possible, noting that, you know, a lot of the things in a CPR are, you know, the same. You know, you don't have to describe the mining method over, you know, you're not going to rewrite it, but, you know, results and things like that, modifying factors change, you know, those things do come in, and I think it's a good best practice to try to keep your documentation up to date if one can. Yeah. Any other comments? Okay. Any more? You know, I guess the other comment I think a lot of us probably use for listed companies the integrated annual report as our source of information. And over time, I think things have gotten better, but you know, I think we probably tend to use that as our go-to for the most part. But nothing stops us from asking the company secretary, you know, like to see, you know, a little bit more detail. Anyway, all right. Joseph, is that, I think is your hand still up, or that's from the previous question, I assume?
No, it's a new question. But it's
new question. Okay. All right, go ahead then.
Yeah, probably not directly related to, you know, the technicalities or technical content you guys are talking about, but more to say that just want to understand, maybe from a SAMREC perspective, or maybe you guys, you know, a lot of I would say the young guys coming into resource reserve reporting, it's something you later on discover at the mine that it exists. And I just wanted to understand, also Stephen, you at UJ, how do we sort of define, because this seems to be like something that traditionally it has been taken as an add-on of someone's job. You know, you're doing it as an add-on, and probably it's what contributed to what Rob was indicating about the quality of the reports. But what we are seeing on the nature of what's required, the level of information required, the amount of work that's needed to put into that, although it's a teamwork, but you're still responsible on it. What are we doing towards maybe to identify or to help maybe the young guys to sort of be prepared as we are training them to be competent person, but there are also other maybe courses, or I don't know how academics is aligned to also assist in terms of that, maybe short courses or all those things, so that we know at the end of the day. I've not heard of a course about a competent evaluator or something like that. You know, it's things that you learn through the industry, through the guys that have been there all the time, and then you got that experience, and then eventually you sort of take over or you get appointed for that. So I don't know what the panel has to give a comment around that.
I'll make one comment, and then I think what I might pick on Tanya, because she's at WITS as well, and I think probably the best person to answer. But I can tell you, I teach the SAMREC code to my students, my undergraduates, and part of the reason I do it, it's part of the mine planning process and understand it. But to be honest, I find that often it's one of the questions that they get when they do job interviews. And so I often do that. And I know WITS does, postgraduate. So, and I know, from the GSSA and the SAMREC, we have courses, but I think I'd rather hand that over to Tanya, because she's been running with that for, I don't know, it seems like the last 10 years on a lot of our, training courses, and maybe it's time for one of our competent persons training courses. I'm not sure, but anyway, I'll hand over to Tanya on that one.
Thanks, Steve. So yes, we run a number of different levels of courses. There is this one, which we try to do at least every second year or so, which is really an introduction to the SAMCODES and the listing rules. And it covers the very broad range of everything that the SAMCODES has to offer. So it's obviously not in a great amount of detail, but it's great as an introductory course. Then the other course that we offer is a more advanced course, where we look at SAMREC, SAMVAL, and a few other things in a lot more detail. That course it was always planned to be an in-contact course, and we used to do it quite regularly before COVID. And there are plans to look at doing another one again next year. That's not a course that can be done online. That's very much a hands-on workshop type of course. And that is the courses that we have through the SAMCODES committees. Various universities have various different courses. As Steve was saying, he teaches it to his undergrads and also, I assume, to the postgrads. At WITS University, not so much in the undergrad, just a very brief introductory course in the second year. But through the Department of Mining Engineering, we run a number of courses, not only SAMCODES, but various different valuation courses, geostatistical evaluation, and so on. I think there are half a dozen different courses that you can do. You can do this both as a university student, and you can do it from the outside, just elective courses. Later in the year, through the GSSA, we are running another course on valuation and the use of codes and a bit more how to. So keep an eye out open for that. The short answer is there are a number of courses out there at different levels. You do need to keep an eye out on the different university websites, the SAMCODES websites, the GSSA and SAIMM websites. That information is available. But having said that, if there are any specific training needs that you do have, please send me a note at the GSSA. If there are enough people who are interested in a specific kind of course, we might be able to put on a course specifically to cover your interests. Oh, and also further on that, one last comment is we've got the ESG, hopefully an ESG information session a little bit later in the year as well. Keep an eye open on the website for it. And as I mentioned earlier, there's a geoscience communication course coming up at the end of May. One of the things in there is going to be talking about simple language. A number of people have spoken about the importance of simple language. And so we're going to have a session on readability and textual choice, how to make what you say straightforward and simple. There are all these courses, GSSA, SAIMM. Look at your voluntary associations websites and see what is available there. Thanks, Steve.
Thanks, yes. Okay. And then there's another question, which I think is a good one. Could we please discuss dealing with financial provisions for closure, which always comes up. Seth, I'll pick on you first, and then maybe Jeremy can comment as well. How that influence. Maybe it's unfair, Jeremy. You're normally doing resources, but I'm sure you're capable of commenting on the other side as well. Seth, if you would like to comment on financial provisions for closure. I mean, closure is important.
You've thrown me the deep end. Maybe my few comments is that it's common practice to do the assessments through external expert parties and not just a thumb suck anymore. And the key issue in this is that it's not only for eventual closure, but also for unplanned closure if it happens before. Because typically there could be a sizable value, it comes at the very end of the mine, and if you do your discounted cash flow model, whatever the cost, it hasn't got a big impact. So I think best practice that I understand is that one's also got to plan for unplanned closure before the end of the life of in 30 years. I think that's, but it's certainly a very important thing. It's got to be done. It's required by the JSE, by the codes. It's certainly high under the agenda also from an ESG perspective.
Jeremy, any comments?
It's a really great question or a great topic, provisions for closure, and I'm just going to discuss it in terms of resources, because I know of a couple of instances where it is not possible to report a mineral resource despite the fact there is mineralization remaining at these particular mines I'm thinking of, because the value of the mineralization underground cannot possibly be enough to cater for the huge environmental provision that is in place on these deposits that have essentially become environmentally stranded. And I think if we think about it, we can all think of quite a lot of mines that are in a care and maintenance closure situation where, for whatever reason, there's no environmental provision available. And in order for somebody to open that mine up, they would have to take on that responsibility. And in some instances for a mine that's been operating for 50, 100 years, that responsibility can be massive. So, you know, just from a resource point of view, it's certainly an RPEEE consideration. Is the likely environmental provision of such a magnitude that would make that deposit uneconomical for whatever reason? So, yeah.
So very good point. Where, yeah, you can, you know, I've seen some small coal operations where your acid mine drainage, you know, becomes a major liability, and yet, you know, the operation's going. I think, you know, for the most part, you know, ongoing mines, having a mining right, you have to have your provisions for closure. You're doing your annual closure costs for unexpected closures, and you know, definitely in the operations that I'm working with, that comes into the life of mine plan and equation. I think, you know, I know Tim Rowland brought it up about a year ago about, you know, having more. We should be looking at this in more detail and making sure that, you know, one has accounted for it right, correctly. I know when we're doing a you know, BFS, you don't see a closure cost associated with the operation. We don't have a provision for it at the end, you know. So after 20 years of, or 14-year life of mine, we don't see a capital expenditure for closure or anything like that. It's, you know, typically worked into your operating costs, but not as often as it should be, and probably not as accurate. I don't know if anybody else has comment. Answer, you know, I think, you know, it's quite important, and it is looked at, and I think with ESG it's becoming more and more. Look, it's always been important, but making sure people are doing things right, and I think we do know that there's some horrific stories in recent times of that environmental provision being stolen or misappropriated, but in, you know, and we do have some historical issues, but you know, ongoing, you know, it is one of the things for at least the listed companies to ensure happens. I think, you know, so it you know, it is accounted for ongoing operations. So, you know, if there's more to that you'd like to ask, go ahead.
Yeah, thanks very much for the discussion on it. I agree with the panel with a lot of what's been said. One of the critical issues, a couple of critical issues really, is that the earlier that you are in the process, so if you're doing what do you call it, a peer, you know, one of the initial scoping level studies on a project, for instance, there's very little data on closure and the cost of closure, even the activities that will be carried out at closure. So there's no visibility over real costs of that. As you get through to feasibility level, even at feasibility level, the closure aspects of a project are generally still at a scoping phase. And it's only after the feasibility is finished and generally within the context of the environmental stuff that you know, you start to get a level of understanding of closure costs at coming up to a feasibility level. And there's obviously a huge reluctance on this part of the clients to disclose to a reasonable level what they understand to be expectations of closure costs, and it's usually lowballed by quite a bit. So, and then you have the problem, which was also noted by the panel, is that anything out at sort of 20 years on a discounted cash flow basis is meaningless in the whole financial equation. So it's the how one goes about putting a reasonable cost to closure and accounting for it quantitatively, if possible, within the context of the studies. That's really where I'm coming from with this.
So in my opinion, you know, I think you're dead right. When you get to scoping, pre-fees, and even many feasibility studies, I think we're probably, and I'm not saying in all cases, but often we're not really looking at it as much as we should, or definitely, in my opinion, probably underestimating some of the costs associated with it. I think once one starts mining and implementing your project, the reality sets in, because you're definitely putting a value and putting money aside based on you know the area of impact that you've made, and you know, you have the people like Digby Wells that will come and do that annually for you and have rates and all that, and you need to put a provision aside for that. But I do agree, and I think, like I said, Tim Rowland had the same kind of comment. I think at feasibility level, although we do look at acid mine drainage, do we have rock that will create it? I don't think we have the level of confidence that perhaps we would with mining or metallurgy and things like that. And I think hence that we sometimes can get a surprise and perhaps underestimate the closure cost and for that matter, other environmental and social impacts that we often may underestimate. So it's I think it's something with the ESG that we've highlighted that we probably should sharpen our pencils a little bit better on it, because environmental is starting to become more and more of an issue, and there's people out there and investors out there that might not invest in your company if you haven't addressed it properly. Yeah. So Tony, any other comment, or if you're happy with that? But I think it is a very good point that you raised. From the panel, anything to add?
I was going to say thank you all very much, especially to the panel, Steve, Jeremy, Theof, and also to Godnose and Kevin, who've been hit by load shedding. Thank you all for attending. You will get your CPD certificate. You will also get a copy of the recording, as well as copies of the presentations. That'll happen only next week.
And then
I hope you've found it worthwhile. Before we go, Steve, you have a comment, but after that, I need to just run a poll.
Yeah, I was going to say, you know, I'm okay with it. I don't know about the rest. Maybe you can ask, but you know, maybe sharing emails. So if someone has a query or something, like you say, phone a friend or phone a colleague. I think in general, most of us are open to, you know, assist with a small question here and there if it comes up. I don't know how you want to handle it, but I'll leave that to you.
Well, any question that you have, you can send it through to the JSSA, and we will send it out to the relevant person that you identify that you wanted to ask the question of. Okay, thank you all, everybody. Have a good evening and a good week further, and we look forward to welcoming you to another course sometime.